That has been in focus around allegations of links between its Roundup weed killer and cancer cases buyer being ordered to pay more than $2 billion in one case in a state court in Georgia. So we watched that company listed in Germany. Talking of Germany, RWE, the energy company, under pressure from Elliott Investment Management to raise its buybacks. So we watched that company as well. Pretty.
Absolutely. Certainly, there's so many stocks that we're going to be keeping a very, very close eye on. At the start, we are, of course, looking at the opening trades across Europe. Futures were pointing higher, so wait for a few minutes for that to shake out when it comes to those European indexes. I'm looking at a FTSE 100 that is flat right now. I'm going to call it higher by 0.1%, but not a major move to the upside. We should mention that in the futures picture, the FTSE 100 was underperforming, but there it is, our first read on the stock 600, higher by 0.3%. Not the same optimism, however, that you saw in the futures picture, and I think that's crucial because we really want to see whether or not the Kekkeron and the DAX are going to be really pointing to the gains, the outspoken gains that you saw in the futures picture. It looks like the French index opening up right behind me, Tom, higher by 0.7%. Does it hold, and what's driving it?
Yeah. Currently, the Kekkeron up 0.8% here in the UK, as you said, slightly more muted, but still seeing the gains up 40 points so far. On the sectors, we've seen some upside and something that Chrissy's touched on in terms of the pricing around iron ore and copper in the commodities space. Basic resources then, the leading sector as we continue to wait the DAX to open. Basic resources gaining 2%. Travel and leisure also seeing some upside, up 1%. Banks also gaining around 8 cents. Just one sector in negative territory, and that is the defensive telecoms space. We've been talking about Telecom Italia, and we'll break that move down for you. Currently, telecoms is just on the margins in negative territory. Every other sector so far in positive territory. Basic resources now up more than 2%.
Well, we're also waiting for the DAX to open, but some of these defence names eking out gains again across the sector. I would note Rheinmetall up 2.8%, Thales 3.5%, 3.7% up for Saab. And so we have all of these talks, as we've been discussing, on the situation in Ukraine continuing and the defence names having another positive day as we wait for the broader DAX index to open, Chrissy. But all of these major indices are up as things stand at the start of the trade.
They absolutely are. I should also point out that we have one eye on, you mentioned the defense sector, but the tech sector as well. I'm looking at ASML and SAP as some of your biggest index contributors, and I think that's going to be a really crucial story. But take a look at what on some of the individual movers are. Mining seems to be outperforming and helping out the UK a little bit, not to the same margin in the other areas. You are also, and I said we talked about the tech sector a little bit, we're talking about what's moving the French index. Schneider Electric is a big piece of that outperformance, so that's going to be one we're keeping an eye on. And the UK side, one of the movers that's caught my eye is National Grid, given those comments they made about Heathrow as well, and having that, those shares down about 0.4%.
Yeah, JP Morgan with that positive call on the miners to that point as well. So that could be proving and tying into the optimism around that space. Let's get a broader take on these markets and bringing the analysis right now. Fabiana Fedeli, CIO for Equities, Multi-Asset and Sustainability at M&G Investments. Fabiana, great to have you around the desk with us this Monday morning. And I'll zoom back out to the tariff story, which is leading, it seems, in terms of the market focus as we lead up to April the 2nd. Do you buy the optimism that's come through on the reporting that maybe the tariffs are going to be more focused than the broad-based commentary from President Trump? Or is it a reminder of the volatility and the mismatch between President Trump himself and some of his advisors? How are you thinking about the tariff story this morning?
Good morning, Tom. I do think it's just a sign of the volatility in news flow, in policy, and generally the markets will follow that volatility. So in the first, I was looking at some data, in the first 58 days of the Trump administration, we had 93 executive orders compared to 17 in the first Trump administration and 37 in the Biden administration. There's an enormous flow of policy news, and this is just, you know, creating some market jitters, particularly in the U.S. So we don't really know what's going to happen to these tariffs. Will they be better? Will they be worse? At some point, they'll probably be better than the initial fears, but there will be a lot of news flow in between.
Where do you stand on the recession risks of the U.S. with the tariff overlay?
You know, that is actually something that worries me, and it worries me more than has worried me in the recent past, because recession can be triggered by confidence, and we're starting to see that all this uncertainty in the U.S. market has created an impact on consumer confidence. You saw the Michigan University data, but also you've seen ISM new orders, and you've seen commentary around that saying that companies are unwilling or incapable to start new long-term contracts. So we're not there yet. The economy is still solid, and possibly the Trump administration can look at what happens and change tack, but clearly there is a heightened risk.
I mean, when you see the DAX performance, does that not give you some confidence that actually there won't be a US recession? When you see in China their performance, that maybe the demand is still there for the US?
The demand is still there at this point in time, but again, confidence is different because it also starts from the U.S. consumer and the U.S. companies. And don't forget that the DAX is actually rising on different reasons. Is rising on the infrastructure package or on the defense package. And by the way, those are all solid reasons for Europe to rise.
And therefore, when you talk about all this volatility, how long do you think that stretch is going to plague Wall Street? How long do you think it's going to last? Have we bottomed when it comes to equities yet?
That is a difficult question, and that's the reason why what we're telling our clients right now is don't try to time the market, don't take bets that are market broad, but really focus on the idiosyncrasies of the different stocks, of the different credits.
So you brought up a crucial point when it comes to the fiscal playbook here, and we talked about it in the United States, of course, where perhaps the fiscal playbook in Germany will be something reflected similar to, say, the CHIPS grants, for the example you saw under the Biden administration. Let me challenge that. The difference here is that in the U.S., you saw it show up in the chip sector, for example, among other places, because it was active money from the U.S. government being handed to corporations for investment in the U.S., and then there was the trickle-down effect. So that made a lot of sense. In Germany, it's a little bit different, where the grants aren't actually directly going to companies just yet. There is still an assumption that over the next 10 years, the fiscal multiplier and the trickle-down effect will be larger. Does that mean the markets are pricing in some sort of exuberance that hasn't yet played out yet? How do you quantify that when the approach is different?
So you have a very good point there. There is a lot that now is priced in, for example, in defense stocks. And you never know what can happen with the actual payments, right? They might be slower than the market expects in the near term. Longer term, this is still a very solid foundation for demand in Europe. On the other hand, one big difference between the U.S. and Europe, and Germany in particular, is that this package comes at a time when the economy is very weak. You know, the IRA was coming at the time when the U.S. economy was still solid. So I think that multiplier effect is also triggered by that.
Isn't it dependent, though, on a strong European consumer at the end of the day, or strong European businesses, and not just German businesses? But you see, I mean, we had a great conversation, I want to say, back in December when Michel Barnier's vote, kind of confidence vote was happening. And he talked to the CEOs on the ground and the lobbies on the ground, and they're saying, we're not even paying attention to what's happening in the French budget. We're paying attention to what happens in Germany, because that's where the more even French companies or Italian companies are more exposed. Is there a second round kind of bid for companies outside of German defense companies in France and Italy that are due to benefit from that push?
Absolutely, yes. So the European economy is incredibly intertwined. The supply chains are across all of Europe, and this means that many more companies will be able to benefit. And there is also a second derivative of that, which is the consumer. If all of this improves consumption sentiment, don't forget in Europe, and particularly in Germany, has been extremely depressed, that would be an extra multiplier.
Fabiana, we're just getting a redhead across the terminal, and I won't ask you directly about this specific company, but it's a reminder of what's happening in technology. SAP surpassing Novo as Europe's biggest company by market value. Part of this, talking of idiosyncratic stories, part of this is about SAP and re-rating around Europeans, the tech prospects for a company that sits at the heart of European tech, even if we have, of course, question marks about how far Europe can go, competing versus the US and China. But another story as well Novo and some of their challenges around getting more of the pipeline to market. How are you thinking about European tech and whether or not that is a story? Would you ever make the case for rotating out of the Nasdaq 100 or rotating out, let's say, rotating out of US tech and into the small and slim basket of European tech that we have, whether it's ASML, SAP? Again, without having to name names, how are you thinking about European tech and whether that is a story that can get the uplift from the defence piece that Kriti was talking about?
So we actually like many European technology companies, many of the software names, but we wouldn't make a conversation around let's move from one basket to the other, because this is really idiosyncratic. And what you're seeing right now in the MSCI all country world, actually the dispersion in the technology sector is extremely high, and also in communication services. So that means that different companies have very different fundamentals, and that is reflected in the price action. We do like tech. Tech is not that. Tech is transforming. And actually what we see also in AI simply means that most likely we're going to have more and more applications, and that's going to be good for the whole sector.
Fabiana, specifically on European defence, how much more upside is there? Like, we have this fiscal boost expected. If it is actually targeted at European defence companies, are we actually going to see even more of a boost because that isn't money spent on US defence companies? Are we underpricing that, if one could even believe that?
Look, the story on European defence is solid, but many of these stocks have already run quite steeply. So in the near term, for example, if payments are not as fast as everyone expects, you could expect some disappointment. But on the longer term, the story is intact. There is still a lot to go.
What's the hedge here, Fabiana? If you're worried about geopolitical risk, what is the immediate go-to hedge?
You know, the truth is diversification is the best hedge, because how many times have we spoken about we're moving everything to fixed income, we're getting out of certain sectors and equities, and that hasn't worked. So a balanced portfolio where you have some fixed income, particularly now that there is a possibility that the macro picture is going to weaken. So you're staying both near the short end of the curve, and then you have your barbell position at the long end of the curve, and then do still continue to invest in equities. There's so many stories, particularly linked to innovation, to infrastructure, that have room to run.
All right. Fabiana Fedeli, CIO for Equities, Multi-Asset and Sustainability over at M&G Investments, saying diversification is the trick to navigating this geopolitical environment. We thank you so much. Let's get a quick check on the Core 6. Tom mentioned it there, of course. The SAP is now, of course, rising in market cap over Novo Nordisk. We shot a great chart there just a moment ago. So SAP and ASML are going to be your biggest contributor to the Stock 600. ASML there higher by 1.7%. Schneider Electric also on that tech outperformance train, higher by 1%. I'm also looking at LVMH here, higher by 1% as well, moving the CAC 40 and moving the outperformance, I should say, of the CAC 40 right next to Schneider Electric. Novo Nordisk not having a great day, though, down 1.6%, with Nestle also on the back foot. Let's get a little bit more on those individual stocks on the move. Joe Easton is all over it. Joe.
So another stock not having a good day at all. Kriti is buyer over in Germany. This stock hit pretty hard, actually harder than some of the market makers were calling it before the open. This coming, of course, as we get this ruling out of the state of Georgia saying the company has to pay around $2 billion to somebody in the state who claimed that their Roundup weed killer had been the cause of their cancer. And this really shaking the market in terms of that reaction on that stock today. JP Morgan out with a note saying that it is a bigger than expected sum than expected. So keep an eye on that one for any potential extended losses. Then in terms of a German name doing pretty well, RWE getting that investment from Elliott, potentially going to be pushing for them to increase their share buybacks. They said they like what they've been doing on cost, but they want more money returned, and that taking positively for the energy company in Germany. So we're up around 2% on that one today. Then over in the telecom space. We got that news late Friday of Vivendi reducing its stake in Telecom Italia, coming down to 18%. But then, as was mentioned earlier on the show, there is a report in Italian media about potentially selling even more of that stock. So we're seeing a little bit of action in these shares at the moment. Telecom Italia actually coming up a little bit, potentially a bit of a defensive move in terms of the sector breakdown today, but those ones seeing a bit of action following that bit of news flow there. Then in terms of the morning calls, really interesting out of UBS changing their ratings on the defence companies today. They have got Saab at a buy. They upgrade this one to buy. Even after the huge rally we've seen, they think this is the best way to play the super cycle in defence spending. They don't like Leonardo. They think that one has gone too far, though, so they have cut that one down, and we're slipping around 0.3% for that one. And then finally on Siemens, that one was downgraded at Deutsche Bank. They reckon that all the spending news that we've seen from the German government, that's already priced into the stock now, and also the potential exit of Healthineers potentially already priced in. So they actually downgrade Siemens, but we're holding up not too bad after that downgrade. We're up 0.4%. Keep an eye on Siemens on the DAX index this morning.
Joe Easton from our equities team, we thank you so much walking us through some of those early pre-market movers, or excuse me, stock market movers. But let me get to the pre-market as well, because it is that wonderful time of the year where we do have a little bit of those U.S. pre-market movers as well. And it's a similar theme you're already seeing kick off over in the States as well. A lot of the tech names are in the outperformance category. NVIDIA higher by 1.5%, perhaps taking its tune from ASML as well. Palantir Technologies, which is another big AI trade, higher by 2.4%. Remember, one of the things that we've been talking about here is the Ant Group offering from China. That has, of course, pushed the tech stocks over in China as well. It's been a positive. It feels like almost for the European tech sector, if you can make that connection. It certainly is a positive for the U.S. tech sector as well. So that reaction function that we saw around the DeepSeek news, perhaps not as large. Tesla shares, though, that's a different story. That's a momentum trade. That's a retail trade, higher by 3.4%. I wouldn't necessarily put a kind of pinning to that one just yet, but it is coming on a very positive day. U.S. futures, for example, also higher by over 1% this morning.
Yeah, interesting that maybe you could get a Tesla boost from the BYD earnings if that stock is priced to perfection. They're coming out later today, but just breaking across the terminal, we also have the French PMI numbers. And so when it comes to manufacturing, 48.9 is the reading for the month of March. These are the preliminary numbers, and that is a beat on the estimate of 46.1. Also a beat when it comes to services, and also a beat when it comes to the composite number. So if we look to the euro-dollar reaction, the euro is stronger, 0.3%, still at a 108 handle, but this is more of a gain than we were seeing right before these numbers dropped. We're still waiting for the German numbers to come at 8:30 a.m, and we get the euro area read at 9 a.m. London time. But perhaps this gives a helping hand in terms of that debate on the Governing Council at the ECB as we look ahead to the April meeting. The Governing Council had been seeing the risk skewed to the downside, but actually these PMI numbers are pretty positive reading on the French economy.
Both still in contractionary territory, 48.9 for manufacturing, services at 46.6. The divergence is still there between manufacturing and services, but a slightly less bad picture, as you say, than the estimates have suggested, Kriti.
But the fact that that is considered a positive reading just tells you how much pain the French economy is in, and that's going to be something that's going to be crucial as well when you talk about not just the market impact, but whether or not the German-French divergence as well, it shows a similar theme and a similar reaction function. Of course, those Germany numbers, as you said, coming up shortly.
Coming up, Heathrow says it plans to operate a full schedule of flights today, but questions remain over how a power outage managed to bring Europe's busiest airport to a halt on Friday. We discuss that next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Welcome back to the opening trade. We're 20 minutes into today's session, and it's green across the screen when it comes to European stocks this morning. The stocks Europe at 600 is currently higher, 0.5%. You've got relief on both sides of the pond on the expectation that Donald Trump's tariff measures could be more measured than previously expected. That's what the reports suggest. Will that be the case actually on April the 2nd? But particular outperformance when it comes to the DAX and Wall Street futures higher as well. Basic resources, the best performing sector this morning, higher 2.3%. But lots of earnings that we should be watching for Critty today, in particular BYD.
Absolutely, one that might have a little bit of a read-through effect into European trading. China's best-selling automaker BYD, as Lizzie said, due to report full-year earnings today, where revenue could top, get this, $100 billion. It would be a first for BYD and put it firmly ahead of Tesla. Joining us now for a preview is our Asia transport reporter, Danny Lee. Danny, walk us through these BYD potential numbers. Could the hot streak continue?
Yeah, I mean, we're looking at revenue and net income that's going to hit all-time highs, and, you know, off the back of a very strong 2024, even despite the headwinds of being pushed back in its overseas push, you know, stuff like tariffs. And so therefore, it has finished 2024 on a very strong marker. And as it entered 2025, we've already seen sales hit really high levels, elevated levels already. So it's had a very strong start. So, you know, all in all, it's been a pretty good start to 2025. And with all the product launches it's got out already, to really put a spotlight on what it can just do compared to Tesla and other auto majors in Europe in particular, and the US. Therefore, there's a lot of a tailwind, and you've seen its share price rally almost 50% year to date.
Yeah, 50% year to date, almost 100% in the last 12 months. I'm looking at some of the models, Danny, kind of marine focused. You've got the Dolphin, you've got the Seal. You're seeing some of these on the road in London now. The financing as well looks pretty attractive on the BYD UK website. It's not all positive, though, for this automaker. There are some challenges. What are they?
Yeah, I mean, there are still operational and delivery challenges. If you believe them and they think that they can deliver 6 million units this year, which would put them at a level close to General Motors, or if not beat them, frankly. And so, you know, the targets it has set itself, that's going to be something that's going to be closely watched. Can it deliver on even more elevated levels of sales, but still amid the backdrop of of tariffs, the risk of whether other countries follow suit, not just in Europe, but we've seen in Mexico where there's been some pushback because of Donald Trump there. And so, therefore, there is more risk around that. And with more competition, more than ever, particularly in its home market, there is that risk that as it pushes overseas, it could still lose focus on one of its core markets where its playbook has worked so well.
Okay, Bloomberg's Danny Lee, thank you very much indeed with a preview and a setup ahead of BYD's earnings. Thank you.
Well, let's go from cars to planes now. Heathrow saying that it plans to operate a full schedule today following a weekend of chaos at the London airport. A fire late on Thursday at a nearby electrical substation cut off Heathrow's power supply, bringing flights to a standstill for almost all of Friday. Now, the UK's Energy Secretary has since ordered an investigation into the outage at Europe's busiest airport. And we can get the latest now by Benedict Camel, who leads Bloomberg's global aviation coverage. Benny, just take us through the back and forth that we've had since the outage between National Grid and Heathrow. What's the latest here?
So on the plus side, traffic is back to normal. There were a couple of hiccups over the weekend, but by and large, Heathrow is up and running again. But now sort of the long discussion begins about what went wrong, who's to blame. You know, one of the phrases that's sort of been bandied around is slightly stilted, lessons will be learned. A lot of people saying that. Who exactly will learn which lesson? That's probably the more interesting part. The National Grid CEO came out and said maybe the full closure and the length of the closure, the full day on Friday, could have been avoided. There was enough power at other substations that could have been pulled in. Heathrow came back this morning with a statement saying, look, this is a complex operation. We use about as much power as a small city. You can't just sort of quickly turn a switch. Moving from one substation to the next would have been very complicated. You have to reboot the entire system. So this is something that will have to be looked at closely. As I said, lessons will be learned. That will probably take days, if not weeks.
Benny, just how much pressure is the CEO of Heathrow under? I mean, can this ultimately be chalked up to a government fallout or an electric fallout, the points that you just made, or does it squarely fall on the CEO of Heathrow?
Yeah, the CEO, he came under considerable pressure. One person who's effectively almost called for his head is Willie Walsh, who leads the IATA industry group, the aviation industry group, former CEO of IAG, a man who doesn't mince his words. Other than that, nobody's openly said that he needs to resign. There was an interesting story over the weekend in the UK press that said that the Heathrow CEO had gone to bed shortly after the fire broke out. Now, Heathrow's defended that, saying, look, we had teams that sort of worked sort of through phases, and everyone needed a little bit of a rest to be fresh again during the day. So there's probably two ways to look at this, but it's not a great look. We know from from British Airways, the biggest customer, that they worked, and their CEO, Doyle, he worked through the night. So, you know, that's something that they'll have to try and defend. Right now, there's a lot of pressure on Heathrow to explain this. The government is looking into it. There doesn't seem to be foul play or sabotage. It does seem that that substation had an unlucky mishap, but just how it could cascade into something this big, that's going to be a point of the investigation.
Okay, Bloomberg's Benny Carmel, thank you very much indeed. Yeah, we expect that government investigation to take about 6 weeks, so we'll continue to monitor that as well. But with the latest and the update on Heathrow, Benny Carmel, of course, our global aviation czar. Thank you. Coming up, German PMIs breaking in the next, 4 minutes, a little under 4 minutes. We're going to discuss those numbers with James Turner, co-head of EMEA Fundamental Fixed Income for BlackRock. That is next. This is Bloomberg.
what is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Welcome back. We have breaking news right now on the health of the German economy, with manufacturing PMI for the month of March coming in above the survey, 48.3, still in contractionary territory, but better than expected, at least versus the economist's views. Services, meanwhile, a little softer than had been previewed. 50.2 is the print versus the survey of 52. So just above that line when it comes to expansion versus contraction. When it comes to services, on the composite level, it's 50.9, also slightly softer than expected. So a bit of a diversion again in terms of a little bit of divergence between manufacturing and services. Services, though, arguably going to be a concern, you would have thought. 50.2 for officials in Berlin as they continue to work through the discussions around a coalition government that some are hoping could be formed as soon as Easter or thereabouts.
Absolutely. So softer than expected, but still a bit stronger than the numbers we got last month, at least when you look at the composite numbers, the 50.9, as you mentioned, it was 50.4 in February. So again, some marginal positivity there. You are seeing that, as you said, reflected in Eurodollar 108 handle there. Let's talk about how it shows up in the in the fixed income space as well. James Turner, co-head of EMEA's fundamental fixed income over at BlackRock, joins us around the table. James, you picked a good day because we've had data that is really not very good data, frankly, but it's being interpreted as fairly positive data, simply in that it's not as bad as we expected. In that kind of environment, I'm going to keep it simple. Do you buy French and German debt right now?
Well, thanks very much for having me, first of all. And I think really we find a positive environment for fixed income generally at the moment. After the last decade of rates being close to zero, we now find that we're normalizing at a higher rate. And really in the past, whereas you had to take risk either on going long duration or you had to take increased credit risk, now you can really buy a really nice bucket of corporate debt and get a really good income and a really nice yield for investors. And that's been absent for quite a long time in the market.
How does that position you, though, for any potential inflationary shocks that may come from geopolitical conflict, tariff, reciprocal tariffs, or even just market pricing that has already been more volatile than, say, it was 12 months ago? Where in that kind of investment recommendation prepares you for those outcomes?
Well, I think the first thing is we're staying in the belly of the curve, shorter duration debt. That tends to be a little bit more protected from that. The other thing is that actually we're very focused on corporate debt as well at the moment. And really, it's really a market as well for credit pickers. Judicious credit selection is really the key to making these good returns at the moment. So a very nice environment for active managers. And particularly when you find volatility, you also find opportunity, and that's really enabled us to get the best returns from fixed income at the moment.
James, spreads have been tight, obviously, over the last, 18 months to 2 years. Is that a story that continues, or is that challenged by the change in economic fundamentals?
I think we'll continue to see. I mean, we've seen volatility really for the last 2 years. We've seen spreads generally come tighter over that period. I think we'll still continue to see them range bound because there's nothing really, I think, that will upset the market in the near term. But really from a point of view as, are they justified being that tight? I think the answer is yes, because really corporates are in a very good place fundamentally. They've termed out maturities, they've dealt very well for this interest rate rises over the last few years, and they're actually in a very healthy position.
Do you steer clear, do you vet your portfolio and steer clear of companies that have greater exposure to the tariff risk? How are you factoring that in to the credit exposure that you have?
I think talking about the volatility, I mean, really for the last 2 years we've had volatility and shocks and geopolitical risk all over the place, and tariffs is really another one of those that I think we just have to contend with. But from the point of view of tariffs, really I think they're much more profitability than a solvency issue. So from a fixed income point of view, I don't think we're really going to see any increase in defaults as a result of tariffs. It's going to cause volatility in sectors, and there's certain sectors that will probably do better than others. Clearly, the auto sector may be under pressure from that point of view, but let's wait until the 2nd of April because I think then we'll see a little bit more clear.
James, one country that's hoping at least to be sheltered from the tariff threat is the UK, and of course we're looking ahead to the spring statement on Wednesday. I've been thinking to myself recently that Rachel Reeves is more concerned about the bond vigilantes than she is about the left wing of her party, such is her focus on building up that headroom again. Do you think that she is safe from the bond vigilantes this week?
Well, let's see what the spring statement says. But when we're looking at UK companies and UK corporate credit at least, I think the government policy is a different thing. But when we're looking actually at the companies, many of them in the UK at least are globally exposed. They're in not bad shape. They've done actually extremely well during the sterling high yield has done pretty well, and sterling bonds have done quite well. I mean, there's been some exceptions, but actually it's in pretty good state, so we're not too worried about that.
I mean, the Debt Management Office, we've reported this morning, is expected to announce its biggest ever bond sales package on Wednesday, so reducing the share of long-dated gilts to try and sweeten the offer. How much help does that give Rachel Reeves?
Well, clearly she's got to sort out the funding of the UK, and I think that one of the things that really we need to switch to is to make sure that we try and stimulate that growth in the UK, and I think that's probably going to be her focus, to try and convince people that actually we can see growth, because the one way of making sure that we I suppose outrun the debt is to make sure that we actually achieve the growth that we talked about.
You talked to us a little bit about the commodity pricing as well. I mean, you are looking at it from a global point of view. American high-yield credit is so baked into the oil prices and the deleveraging plans that you're seeing from corporate energy players over in the States. Does the same apply to European issuers or European borrowers, specifically in the energy space, that are exposed to that kind of risk?
There's far less energy exposure in the European corporate market, for a start. So in terms of the companies, there's far less exposure. Energy costs are clearly a big input into European corporates, and we watch it carefully. But having said that, if we look back to 2022, European companies dealt pretty well with their increase in energy costs, and so we think that they'll be well placed to deal and make sure they continue to make those efficiencies in the future.
James, you're painting a pretty benign picture for the European credit markets. How far do you want to go along the risk spectrum? You talked about high yield. How do you want to be balancing your exposure to investment grade versus high yield in the current environment?
I think it depends on the risk tolerance of the investors that we're talking about, clearly, but we're comfortable with both asset classes. I mean, we think that actually in terms of high yield, it's offering an extremely good income. And I think the other thing is that what's happening is people, having seen quite high cash rates, there's over €1 trillion still in cash and cash equivalents at the moment. And I think what we're seeing is inflows into both the corporate credit IG market, but also the high yield market, and we're seeing particularly into things like fixed maturity products. But as ever, it's a time for judicious credit selection to make sure that we get those right, because there will be winners and losers from a region's point of view.
Have those inflows ticked up recently? What are the drivers of those inflows? It's locking in that high yield. How does that inflow story compare to the last 6 months, say? Is that a relatively new story?
We've seen inflows consistently over the last year or so.
Yeah.
We have peaks and troughs, well, not peaks and troughs, but things where we've seen ebbs and flows in it. But overall, the picture has been very positive, and it's presented a very positive technical demand for both asset classes. I don't think we see any let-up in that because people are looking, exactly as you say, they're looking in to lock in those yields now while they can.
So is there a difference between how private investors are behaving to institutional clients when it comes to this bond space?
I think actually it's rare that we're seeing universal flows into the asset class over the last year. We've seen retail investors keen to invest. We've seen insurance companies keen to invest to take advantage of the high yields. And we've also seen pension funds keen to invest as well. And I think it's really because they see that these yields aren't going to be on offer forever. The corporate market's in a very good situation. There's a lot of volatility in particularly the longer-dated credit and longer-dated sovereign yields. And so actually it makes sense to take your risk and to lock in those yields in the medium belly of the curve.
Let's talk a little bit about defense financing here. That seems to be the hot topic of the day, from Berlin to Brussels to right here in London. How easy is it, if you're a defense manufacturer, to one, issue, given the momentum in the sector, but also fighting perhaps the yield move you've seen when it comes to German debt? How is a defense manufacturer meant to think about that?
I think there's always going to be demand for those, but the other big story clearly is the infrastructure investment as well. And so when we're looking at sectors that we find attractive at the moment from the point of view of investing and where we're going to see lots of demand, I think we need to look at the broader picture as well. And particularly things like building materials companies, construction companies, and then actually a sector that also has been really in the doldrums for the last few years in Europe is the chemicals sector, and perhaps actually finally we see some advantages for that as well as basic materials become more needed for that infrastructure spend.
So that sounds very much like this is about to open the gates to a slew of issuance from a lot of corporate players in Europe. To what extent, though, and how dangerous is that in terms of things like debt distributions?
So I think we were talking about the technical strength earlier. There's still flows coming into the market, and actually with the Bund rate move or Bund moves recently, we've actually seen the yield increase. So it's actually attracted even more players probably into the market at the moment to take advantage of those higher yields. So I don't think there's going to be very little indigestion, if any, when corporates come to the market, because there's still a technical demand for all of this debt that's being issued.
Okay, James, thank you very much indeed. Maybe look to the infrastructure story of Europe when it comes to exposure to European credits and the issuance, not a big concern, at least for these markets. Still supported. James Turner, co-head of EMEA Fundamental Fixed Income for BlackRock, with some calls for you there in terms of European credit and how to get exposure. Now, Germany and France, PMIs moving up a touch, as we've mentioned, above the estimate. So what does that tell us about the state of the European economy? Are things starting to turn around? Are we starting to see some green shoots for this European economy, just as that stimulus starts to come through? We'll discuss next. This is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Welcome back to the opening trade. We are about 44 minutes and counting into today's session. Seeing green on the screen, this is largely in line with the global dynamic that you're seeing. Futures in the States higher by 1% as well, but the outperformer continues to be the DAX, at least in the European session. A lot of that has to do not only with the fiscal spend, the defense spend, but perhaps a little bit of a relief rally when it comes to that tariff agenda as well. Let's go there next, where Trump's tariff agenda and efforts to bring jobs and companies back to the United States has been on the radar for many countries as they brace for the rewiring of that trade relationship with the world's biggest economy. Irish Taoiseach Micheál Martin spoke to Bloomberg about how his country is assessing those very challenges.
We have to take a broad-based approach to it because we can easily be sucked in to sector by sector, and there's potential for significant division across the EU in terms of how we respond.
The Irish Prime Minister there, Micheál Martin, speaking to Bloomberg about the response to President Trump's tariffs. At the same time, in the last, I want to say 15 minutes or so, we've also gotten some data coming out from Germany. This is all tied, of course, positive numbers in some respect coming from Germany and from France as well in the last hour. How positive is that really? Of course, we're looking at euro dollar at a 108. Let's get more insight. Jamie Rush, Chief European Economist over at Bloomberg Economics, joins us around the table. What do you make of the numbers?
Well, I mean, they're painting a picture of an economy which is basically stabilising and okay. Like it's not falling off a cliff. If you think back to the turn of the year, the fear was that the Eurozone would slump into recession and that we'd be in quite a different place. That's not happening. The labour market's okay, inflation's on track, but we're only at the start, right? We know that there's a large number of shocks still to come down the pipe, and so the economy is waiting with bated breath.
Jimmy, to that point, how clean is this data? I mean, how much of the tariff impact has been factored into this data, and what are you, in terms of projecting out to the rest of the year? How able are you able to do? How willing are you able to do that? I mean, how clear are your views and your forecasts going out to the rest of the year, given those?
Well, it won't surprise you to hear that it's not very clear.
Yeah.
But I mean, so what we've got in the data right now, which we know is captured, is the uncertainty. The uncertainty is there. It's weighing on the economy. It's meaning that people will put off investment decisions, purchasing decisions. That's happening, and the economy is still holding up. So that's the positive side, right? When we think ahead, we've got tariffs on April the 2nd or around there, and we've got Germany's huge fiscal package, which is going to be meaningful. The investment side is going to add 1% to the level of GDP probably in the next year or two. So this is big stuff. So the question is, the problem is that these two things don't arrive at the same time. So the tariff, the disruption you get from that happens straight away. The Germany boost comes sometime later on. And so for policymakers at the ECB or even fiscal policymakers, they have to make a decision about what their horizon is. I mean, they don't have to decide just what the size of the shock is. They have to think about whether they're going to set policy based on 2 months ahead, 6 months ahead, or 2 years ahead. And it's actually not that easy anymore. I mean, you used to just always think 2 years ahead, but you can't these days.
But given the lag in monetary policy, surely that would make the case for placing more of a focus on the forward-looking data, the survey data, the PMI numbers, rather than the hard data already.
Yeah, right. I mean, you'd think that, right? But we just had the last 2 years where policymakers have been working entirely in the rearview mirror, and they're only just now starting to look further ahead and start to trust the forecasts again. So I think we're not yet at a position where they're going to be able to say, here's Germany, it's going to spend loads of money, the economy is going to be booming in a year and a half's time, let's set policy accordingly. I don't think they're in that position yet. I think we're still looking in the rearview mirror.
How much of the inflation expectations in these markets ultimately may show up in the data in the next few months?
Well, I think I think there's an element of a reflationary impact to what Germany is going to do. I think probably people are a little bit too excited about what defence spending may do to the economy. I think that's actually going to be very hard to ramp up in a meaningful way. But the investment is the element that we should be focused on. And that will start to feed through and it will boost the economy. So I'm reasonably optimistic on that side.
OK, well, we've had the French and German numbers. We look ahead to the euro area numbers coming at the top of the hour. But Jamie Rush of Bloomberg Economics, we thank you for that analysis. Coming up today, we also have more of these global flash PMIs. We've got BYD's earnings, as we were previewing with Danny Lee. We have German IFO data, US consumer confidence data on Wednesday. On Thursday... on Wednesday, we have the UK CPI numbers and the spring statement, so a big day here as well for Chancellor Rachel Reeves. And then on Thursday, we have the Norges Bank rate decision, and Friday, UK retail sales data and US PCE numbers. What's going to dominate the markets this week? Let's ask Bloomberg's Valerie Teitel. She joins us round the table. Val, I'm focused on, of course, the UK spring statement, as you might expect. Yeah. But what do you think the markets are going to care about?
Look, I think the spring statement is going to be a big one for markets here in Europe. Just how far is Rachel Reeves going to go when we get this announcement of how much she plans to borrow this year? We've reported that the Wall Street, the median estimate is now £302 billion for this fiscal year. But the estimates are quite wide, going from 290 almost all the way up to 320. So that number is going to be what the market, I guess the market reaction really hinges on. It should be noted, though, that the favored position right now in gilts is to be long gilts. You know, you have a weak economy. You have a government that's continually cutting spending. Even Rachel Reeves over the weekend saying, you know, they're almost doing their own Doge here in the UK, saying they want to cut costs of running the government by 15%. You know, those kind of backdrops make you want to be long gilts. So I think the market might be upset if they get a higher than forecasted number from Rachel Reeves in terms of the issuance.
Talk to us a little bit about what that actually looks like in terms of the issuance, though. If we start to see a market or a smaller amount than announced coming on Wednesday, what's the market reaction to that? Or is there any, I should say? Are we just waiting for issuance or no issuance?
Well, look, it's not just going to be the big number. It's also going to be where on the curve they intend to issue. There is some speculation that maybe Rachel Reeves will make it more palatable to the markets by issuing more short-term or medium-term gilts and instead shying away from issuing more long-term debt. That could make it a bit more palatable for the gilt market to digest and maybe lead to another gilt rally in the long end as well. But, you know, as well as the UK spring statement, I think we're going to be trading headlines around tariffs as well from the U.S.
As we build up to that April the 2nd deadline that Trump has imposed on himself. And then we have the inflation data as well, the PCE data on Friday, which Kriti Gupta said is relatively unimportant, controversial statement. Do you agree with that line? How focused are the markets on the PCE data? She said, to be fair to
Kriti, right?
she put it in the context of non-farm payrolls.
Yes.
Look, I think it's the week after, isn't it? Non-farm payrolls.
I think that we've gotten way better at forecasting inflation recently, and you know, PCE is a combination of things we get in the CPI and things we get in the PPI. So I think that PCE number has been, you know, it comes in line with what the market expects because we've gotten so good on forecasting inflation. So I'm not too worried about that data print. I mean, I'm more worried about the fact that there seems to be, not a lot of big data prints in the U.S., and that's just going to lead the market to really start to focus focus on this April 2nd date. I know there is a lot of exuberance in U.S. futures this morning on the back of those weekend reports of narrow and targeted tariffs, but I view that with a huge bit of skepticism because, yes, they're narrowing it down to, what, 15 countries? I mean, that's still a whopping amount of U.S. trade. A majority of U.S.'s foreign trade are with those 15, what they call the dirty 15, the most persistent trade imbalances with the U.S. It's something that the Treasury Secretary said in an interview with Fox News last week. So I really view this market exuberance with a bit of skepticism. I think the equity market is more likely to be disappointed this week than not.
Because ultimately it's aides and allies who are giving these stories to the news. But actually, Trump himself is pretty hawkish still, very hawkish when it comes to his narrative. So surely the market's listening to the wrong person.
Yeah, I mean, look, there was maybe some good news in some of the weekend reporting. We've reported that the sectoral tariffs, the ones on chips, the ones on pharma, the ones on autos, might be delayed to a later date. So maybe there is some relief that we don't get both reciprocal and sectoral tariffs released on one day. But it's still important to note that not only are we going to get this analysis out from the U.S. trade, the USTR, we're also going to get the implementation of tariffs. They aim to do that on the same day, and that could lead to a lot of volatility. But I think Trump wanted to do that in order to give some more certainty to the markets, which I guess the markets have told him they need more of. But, too much released at once might lead the market to react more in confusion rather than with a certain guise.
Can we talk about the currency picture for just a moment? There was a really, I thought, interesting piece in the FT over the weekend on the dollar. And the case that they were kind of making was that some of the safety and kind of reliance on the Constitution and those kind of things that made the dollar a safe asset from a global perspective as well. But as you start to see some of the domestic politics play out, and this is kind of where I brought up payrolls as well, because some of the federal kind of job losses could ultimately have repercussions for the market pricing internationally. Could you see the same show up in the dollar, where domestic policy in the United States may ultimately matter more than the tariff story?
Look, I do agree with the fact that maybe we can call the peak in the U.S. dollar kind of like what that FT article over the weekend was pointing at, because there's a lot of other dynamics now at play where other governments around the world are stimulating, either that's China or Europe. That's a weak dollar story. And then the tariff story has gone now to a focus of retaliation. That's a weak dollar play rather than, last year we very much viewed these tariffs as a strong dollar position. So in some way, I do agree that the trajectory ahead for the dollar is one of a downward nature.
Yeah, there's that central tension, isn't there, between the Trump policy of apparently wanting a softer dollar, but also wanting the dollar primacy to remain, and all the speculation around Mar-a-Lago Accords and such. From the macro to the micro right now, two big movers for us. SAP, the headline crossing, about 30 minutes ago or so, SAP in terms of market cap, now the largest company in Europe, topping Novo Nordisk. Novo Nordisk has had problems in terms of some of the testing around some of its drug pipeline. SAP, though, benefiting from optimism around its cloud business and particularly its investments around AI. So SAP, listed over in Germany, getting 1.2% in the session today, and now topping and taking the crown from Novo Nordisk in terms of the most valuable listed company in Europe.
We're also seeing a positive session for some of these defence names again, the likes of Rheinmetall up 1.3%, Saab up 2.1%, Thales up 1.8%. So still upside for these names across the defence space.
So let's talk about one place where there isn't that much upside, and that is Bayer. Shares are down about 6.2% this morning, trading very, very low here. I think I've got the wrong ticker. Yep, there it is, 6.7%. Had to double check that because, of course, it is such a massive move. This comes after that $2 billion verdict over in the States where they have been saying they are kind of responsible, or at least the judge has said they are responsible for a Roundup weed killer potentially having cancerous effects. Bayer disagreeing with the decision and will ultimately saying it's going to appeal it.
Basic Resources, top sector right now in the Monday session, gaining more than 2%. You've seen some upside for example, copper and iron ore, and a call from JP Morgan as well to get exposure to the miners. US futures also pointing positively, strongly in positive territory, Chrissy.
Absolutely, green on the screen. Let's see how long it can sustain in today's session. Speaking of, in case you're wondering where Guy Johnson is, let me tell you, he is speaking exclusively with Airbus CEO Guillaume Faury, company summit in Toulouse, France. That interview at 3:40 p.m. UK time. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Well, risk sentiment turns positive on reports the next wave of tariffs from President Trump may be more targeted, with officials saying some countries may be exempt. U.S. and Russian officials are meeting in Saudi Arabia a day after American and Ukrainian teams held talks as President Trump pushes for a ceasefire in the war. And Turkish authorities scramble to shore up the nation's assets after the arrest of President Erdogan's main political rival. Now, later this hour, don't miss our conversation with Reid Hoffman, the LinkedIn co-founder and partner at VC firm Greylock. We'll discuss AI, Silicon Valley, and his new book, Super Agency, What Could Possibly Go Right with Our AI Future. But first thing is first, let's take a look at the European markets map. Again, there's quite a lot going on as we approach that deadline of tariffs from the U.S. Now, stocks are pretty much rallying. Treasuries actually slipping again. There are more and more signals on the next round of Donald Trump's tariffs that would be more measured than previously suggested. So for the moment, we're seeing a bit of green on the screen. I'm also looking at futures in the U.S., and they're up. The CAC 40 gaining some 0.5%. Now let's go straight to cross assets. Always good intentions looking at euro dollar. Also European stock 600 actually opening some 0.5% higher thanks to commodity producers and automakers. I'd watch out for automakers and some of the commodities in general. S&P futures 1% higher. You can see euro dollar 108.45, and then we'll spend quite a lot of time talking about the energy complex. European gas futures at 41.715. They have risen quite a lot given everything that's been going on, but now down 2%. Data-wise, Eurozone March composite PMI rising to 50.4 versus 50.2 in February. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, markets have been gripped by fears of an all-out trade war. That uncertainty around President Trump's tariffs have rattled stocks over recent weeks, but risk sentiment is now turning positive. That's as reports suggest that the next wave of tariffs may be more targeted than first expected. Well, we'll discuss all of that, what that means for markets, with Grace Peters, Global Head of Investment Strategy at JP Morgan Private Bank. We're also joined by Ross Matheson, our EMEA News Director, to discuss the latest news out of Washington, as well as the talks aimed at achieving a ceasefire in Russia's war on Ukraine. So thank you both for joining us. A lot to talk about markets, but maybe, Ross, let's just start on politics. President Trump's, April 2nd tariffs are reshaping what we thought would be broader. It looks like they're more targeted. Is it geopolitical, or is there an economic reason at play?
Well, it's probably a bit of everything, but it's also just the way that Donald Trump operates as a businessman turned president, is that he always wants to keep things in the back pocket for later. So what we're hearing from our own reporting is that with these reciprocal tariffs on April 2, they might be, as you say, more targeted than thought. Not all countries necessarily hit. And also those sectoral tariffs he's been talking about, autos, chips, pharma and so on, those seem to be going to a later date in the back cupboard again. So the idea is that maybe Donald Trump wants to do something where these reciprocal tariffs take effect immediately, according to our reporting again, but in a more targeted way. He'll see how that goes, and then he's got more firepower, if necessary, to push further. So there's probably all kinds of imperatives going on there. We've seen he is willing to change his mind, sometimes very quickly. So this could be perhaps the opening gambit on April 2. He'll see how that resonates, and then maybe he's got more to come. So it's probably an economic imperative, maybe one clever eye on the market, even though they say they're not really watching the market, they probably are, and how the market is interpreting all of this, and then obviously strategic.
Yeah, I mean, Grace, this is $1 million question. Is it, does he look at the markets? Does he want, if you look at the longer-term strategy of President Trump, and if it's reshoring, he feels like the U.S. has been getting a bad deal, full stop, then it's not necessarily equities that he's looking, but it's longer-term growth.
I think he's playing the longer-term game, and he's willing to take a little bit of short-term pain in order to achieve those larger objectives. And I think for the markets, beyond the sort of tariff tennis that many investors feel they're playing at the moment, it has changed the profile of the rhetoric, which changes the profile of sentiment and market returns. So with a view on the longer-term game plan and gains, I do think that, U.S. growth is going to still continue at around a 2% clip. What's interesting now is that you could have European growth also elevated, reflated, so to speak. And when we try and translate that into markets, I'd say just a couple of things at the outset. Firstly, a 10% drawdown in the S&P. I think that's quite healthy. That cleans out, to some extent, some of the exuberance that we had. And actually, when you look at previous 10% drawdowns, correction territory on a go-forward return, you've got a very high probability that the market responds well, particularly if you avoid a recession. And then I'll just say, Francine, portfolio resilience is really our key theme still for this year, and there's many other portfolio actions that we can perhaps talk to.
I was going to ask Grace, I mean, if you look at the world now, how do you build a portfolio given a lot of uncertainties? We think we know what the president wants for the U.S. There's also a concern that actually he gets lower growth and higher inflation because of tariffs if they're not calibrated.
Yes, absolutely. I mean, part of that changing of the profile is changing of the balance of tail risks. And so if we think about our outlook for the next 12 months, 55% is this trend-like growth. The other 45 is therefore tail risks, which would be roughly evenly spread between recessionary risks and inflation risks. So how to build a portfolio in that backdrop? I mean, we still think the starting point of a 60-40 equity bond portfolio is a good place, and I think fixed income has really proven its worth over the last couple of weeks, where you've seen, as growth fears come in, that asset protect. But I think it's not enough. You really need alternatives. So gold is a key call of ours, infrastructure, hedge funds, and all of these assets add an uncorrelated nature of the return stream, and then obviously you've got private equity and debt as well. But it's those real assets, the uncorrelated assets, that I think are really apt for 2025.
And Ross, I guess the concern is that he's trying to do a lot, right? It's, trying to negotiate some kind of agreement with Ukraine. We also have officials from Ukraine and Russia meeting in Riyadh. And then there's all the stuff at home domestically, carving out education, but also looking to do more when it comes to, for example, the economy. What do we know about Russia so far? Is that a distraction, or is it one of President Trump's focal points?
Well, clearly it's a focal point. I mean, he promised repeatedly on the campaign trail and early in office he was going to get a rapid ceasefire in Russia's war against Ukraine. He's pushing overtly and publicly multiple times a day on that front. I mean, the talks that are happening in Saudi Arabia today, it was US, Ukraine initially, now it's US, Russia. They seem to be very technical in nature, very granular. It's about perhaps moving from getting away from targeting energy, but also to some kind of understanding about maritime traffic again in the Black Sea. So it's bit by bit, and they haven't really tackled the hard stuff. The really hard stuff is what to do exactly where the fighting is on the ground inside Ukraine. And it doesn't seem the conversation has really gone there in any great detail so far. So it's a little bit by bit. Obviously, Donald Trump will probably claim the win for every little development they get. But meantime, Ukraine and Russia are still attacking each other. We're seeing that going on. Russia is still firing missiles and drones into Ukraine and so on. The fighting is still going on. So whatever they're talking about so far has not really impacted what we're seeing on the ground.
And Roz, has there been any concessions from Russia at all?
Not notably so far. I mean, we know from our own reporting that Vladimir Putin has got some very maximalist demands here, and he's going into any conversation with the US sticking to those demands. Those are things that he says are not negotiable, and very clear that he's willing, if necessary, to drag these talks out for as long as needed to get to his maximum position, because these are views that he held before Donald Trump took office. These are things he wanted before Donald Trump took office. He probably knows how to navigate Donald Trump a little bit on it, and maybe they get to the point there's a proper ceasefire, but Vladimir Putin still has things that he just wants out of this. That's very clear, and a lot of that includes territory, and also clear understandings about what Europe can do or the US can do after in terms of peacekeepers and so on. That hasn't changed.
Grace, what does this all mean for Europe? Again, we're seeing this huge defense spending, and which we see stocks even being 200% higher in the last 2 to 3 weeks. Is this a space that you can get involved in?
I think you can. So one of our key themes that we initiated actually last year is security, and defence is a key part of that, as is cyber security, and also supply chain security and energy security as well. But look, I think the fiscal package coming out of Germany, which includes sort of that defence element, that is meaningful. It could be meaningful for growth, it's meaningful for sentiment, meaningful for corporate earnings later down the line, and it is part of this shifting world order that I think should be reflected in portfolios. So you can do that via global equities leading into themes like security. Industrials would be a sector that benefits, or indeed such as assets like gold, because I think even in, for humanitarian purposes, obviously we all desperately hope for a ceasefire. Even if that happens, geopolitical risk, I think, is not going away. I think it is part of what we should expect, in the world that we live in over the medium term, and therefore to have those hedges in the portfolio for more volatility, for geopolitical risk, I think is entirely sensible. So gold would be a good one that we still see upside related
infrastructure?
to that. Infrastructure as well, particularly, I mean, we divide infrastructure into two. Core infrastructure, I think, has got tremendous benefits because it's not correlated or very lowly correlated to both equities and fixed income. So as we think about those tail risks that we really need protection for, great. Income, it compounds income very nicely, and so core infrastructure to us is a key holding for the world that we see. And then you've also got new infrastructure that feeds into a lot of the AI build out, as an example, that I think is also quite pertinent, but arguably a little bit more bid up, sort of in recent years. But certainly I think core holdings in the portfolio for this backdrop.
And Roz, I guess the concern is that when you're an investor, you see a lot of hope for Europe given the low bases, but actually Donald Trump could really test a lot of these heads of state individually, and there's no clear channel by which they have a common policy.
Well, that's right, because all the understood norms are going. So the relationships that you have, which are based, it's a kind of a twee thing to say, but they were based on trust, and that seems to be going. And so, how do you now talk to each other in a way that you feel is an agreement that's going to stick? And who speaks for Europe in this minute? Who has Donald Trump's ear? It could potentially change. Is it the incoming Chancellor for Germany? Friedrich Merz has been very busy, very quickly, as we've been hearing on the defence side and the debt break. Is it Emmanuel Macron? Is it Keir Starmer? But how do they speak in a united fashion for Europe? Because we're seeing, again, the European Leaders Summit last week quite divided on even how to get more aid to Ukraine, a fairly basic question, and that got stuck despite many, many conversations and more calls that leaders are planning this week. So if Europe's trying to present themselves as having a moment, they're kind of challenged in terms of just some of the basic stuff still.
Roz, thanks so much. Roz and Matheson there, our EMEA News Director, Grace Peters from JP Morgan Private Bank, stays with us. Let's also go to Turkey, where capital markets regulator has banned stock short selling and relaxed buyback rules to prevent further market turmoil. Now, the move comes in the wake of the arrest of President Erdogan's main political rival, which sent the lira to an all-time low. Now, for more, let's bring in Bloomberg's Onur Ant from Istanbul. Onur, thank you so much for joining us. So what do we expect to see in markets today?
Francine, as you said, regulators, including the capital markets regulator and the central bank, have moved swiftly over the weekend to prepare for expected market volatility on Monday. And judging by what's happening to stocks, CDS, even Turkish bonds, it seems to be working. The drop in the lira is definitely much less than what we've seen so far since the detention of Ekrem İmamoğlu triggered this latest political turmoil. And elsewhere in Turkish markets, we are seeing signs of stabilization. Now, to be sure, the stable levels are not the same as the levels we have seen just a week ago, but it looks like Turkish markets have or are about to find a new equilibrium where there will be more stability thanks to all these steps and measures by the central bank and other regulators we just mentioned as well.
Yeah, and Onur, we're looking at pictures, of course, of a lot of anti-government demonstrators clashing also with police through Sunday following the jailing of İmamoğlu. What's the significance of this arrest?
Well, the arrest is very significant because this is the first time Turkey is jailing a politician, not just maybe representative of a somewhat marginal or smaller party, but a politician who's really, really nationally popular, someone who has the ability, who has the potential to defeat Erdogan in the ballot box. That's why Ekrem İmamoğlu's detention first and later arrest, formal arrest by Turkish courts, is so much more different than anything else that we have seen in Turkey. And it kind of marks a shift from what everyone used to think of as a possibly flawed democracy, an autocracy of some sort, to something different, where President Erdogan, if he chooses to run for office again, would probably be able to run against someone of his choosing, so to speak, someone that he could find more favorable to run against. That's why Ekrem İmamoğlu's detention and arrest is very significant.
Yeah, thank you so much, Onur, our managing editor for the Middle East and North Africa, Onur Ant. I have to say we have some really great people on the ground bringing you the very best coverage. There was a story saying that, look, President Erdogan was betting that the world turned pretty much a blind eye to this turmoil in Turkey, but so far we've seen a surge in Turkey's borrowing costs, a slump in stocks, a decline in the lira, and investors, of course, being the only force providing a check on Erdogan's aspirations. Now, coming up, China says it's prepared for tariff shocks as the U.S. calls for more action on fentanyl as a precondition for trade talks. We'll have the details next, and this is Bloomberg.
It's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
In case you missed it, on Bloomberg Technology.
You did say basically $100 billion run rate
for CapEx expenditure. Can you give us even like a percentage breakdown of how much that goes to distribution, logistics, and how much goes to AI?
The lion's share is,
more than 50%?
Tell you most of it. Most of it. The lion's share is more than 50%, yes.
Is it more than 80%?
We're playing the warmer and colder game?
Yes, exactly. I love a game.
Don't miss Bloomberg Technology live every weekday.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the U.S. has said China must stop the flow of ingredients used to make fentanyl before any trade negotiations can begin. Now, the exclusive comments were made by Republican Senator Steve Daines, who met Chinese leaders, including Premier Li Qiang, in Beijing over the weekend. Now, in just a moment, we'll look ahead to earnings from the Chinese car maker BYD with Bloomberg's Craig Trudell, and we're also still joined by Grace Peters from JP Morgan Private Bank. Let's begin with Bloomberg's China Economy and Government editor, Alan Wong, to have a look at exactly what's going on. Alan, so on the tariffs, talk to me a little bit about what this Republican senator said. How can they stop ingredients used for fentanyl from going to the U.S.?
Yeah, so the U.S. has pegged the issue of fentanyl to trade tariffs. And the most recent development is that Montana Senator Steve Daines came to China and met with several Chinese leaders. And he said that he communicated the request from the U.S. that China must stop the flow of fentanyl precursors into the U.S. before they could talk about tariffs and other non-tariff trade barriers. So Steve Daines said that in meetings with Premier Li Qiang, China's #2 leader, which is injects some uncertainty into the prospect of a leadership summit in the near future. As you may remember, Trump recently said that he expected to have President Xi Jinping of China coming to Washington in the not-so-distant future. But given that China has said that it has done all it can for the U.S. in terms of fentanyl, it remains in doubt what China can further do to curb the flow of these ingredients in the U.S. to fulfill that condition for talks.
Alan, I have to say I'm a little bit confused about how aggressive the Trump administration wants to be with China. So we've heard also the premier saying the country is prepared for shocks that exceed expectations. Again, as the whole world, frankly, braces for these extra tariffs, possibly targeted, possibly not, from President Trump. But does he want to hit China hard, or does the president want to have a relationship with President Xi?
I must say both tracks are happening at the same time. I think Trump would loathe to show weakness in the negotiation, and there are several major events coming up that will give the U.S. an opportunity to make any moves it wants directed at China. On April 1st, we know that a report on China's compliance with a Phase 1 trade deal struck during Trump's first term will come into being, and then on the next day, Trump has promised reciprocal tariffs globally, and although the extent of those tariffs and the scope of them remain to be seen. If Trump moves hard on China using those reasons, then we can expect to see China responding in kind. And at the same time, China also needs to figure out exactly how it will respond to the U.S. request for it to more aggressively crack down on the flow of fentanyl precursors into the U.S. Given that China has said that it's done all it can, what China does next will determine how the U.S. will, what kind of attitude the Trump administration will show to China in realizing some sort of a high-level talks between the two countries.
Yeah. Okay, so I want to talk about BYD, which is launching this EV to rival Tesla's top seller at half the price in just a second. But Grace, I guess always the $1 million trillion question is what kind of relationship does China have with the rest of the world? Will China change enough to keep Trump on side, but also maybe be a force for good for Europe?
Yeah, I mean, the European angle is the one that really interests me, because I think from an investment perspective, people still feel quite cautious, a little bit bruised perhaps from investing in the region. But I think if you invest in China through Europe, actually you've got really nice optionality around, should consumer sentiment improve via luxury goods stocks, you can benefit in Europe. Should the housing market or construction, sort of be reinvigorated, you've got good exposure via the materials, sort of mining companies. And so to me, that is a way to invest in a region that, yes, it's had a rally, but it's still reasonably under-owned. There's upside from domestic now, as well as these international drivers. And that is the preferred way from a risk-reward perspective, in our opinion, to get exposure to the Chinese market and some of these drivers.
I mean, changing the Chinese economy is not easy, but do they start consuming significantly more as soon as growth, picks back up?
So much of it, I think, is still around the housing market, because so much of household wealth is tied up in the housing market. And so I think that really is the structural thing we need to see change in order for consumers to feel better, to spend more. First and foremost, that's what we'd look to. But I do think that the GDP is on a declining trajectory structurally. If we think over the next 10 years, China GDP will likely fall, and thus this note of caution really around reading too much into short-term dynamics as well.
And I'm quite excited, actually, about learning more about BYD, because this is one of the most important electric vehicle makers in China, and they come up with some pretty good propositions, Craig.
Yeah, I mean, today we'll get earnings from them where we are expecting for BYD to actually report more revenue for this past year than Tesla did. And so, this is a company that has really been on a roll. I think last week their announcement of 400 kilometers worth of range in 5 minutes really turned a lot of heads. If they can really,
that's a lot. Even I know that. Is it better than Tesla?
Better than Tesla, better than anybody. I mean, this would essentially have the potential to eliminate range anxiety. I don't know that you would necessarily want to do this with your car all of the time, but if you can, in a matter of 5 minutes, get enough range to, fill quite a lot of EVs actually, to essentially a full charge, this is potentially game changing. And so, not only have they been delivering, I think they are giving investors reason to think that they can continue this momentum based on some of the innovations in the product that they're delivering for the market.
And I think they had 2 new cars, right, which they announced a short while ago, even just yesterday. Are they primarily sold in China, but in a view to really export significantly to Europe, or will they also be sold in the U.S.?
I think it remains to be the case that BYD is primarily doing most of their business at home. Are they growing internationally? Absolutely. Are they, on the other hand, maybe struggling a little bit with some growing pains, needing to do a lot of brand building and awareness building? And are they running into some real resistance? I think in the U.S. we're not going to see BYD until and unless trade policies change. I think the likelihood of that seems a bit low. But here in Europe, even with the tariffs, giving them some trouble, they are managing to grow and outgrow some of their peers among other Chinese manufacturers here in Europe.
And Grace, there's still so many question marks about whether tariffs in a certain way are deflationary or inflationary. Again, can China help with balancing things out?
I think it can to some extent. I mean, the first round impact of tariffs do feel to be inflationary, but the downside risk to growth, kind of is more the second round impacts. And so I think when we look at inflation, which is obviously significantly lower in China, that can help to some extent. But I think really it's the key metric to me on the inflation front is where U.S. consumer inflation expectations are, because the last few months we have seen those tick up to actually reasonably elevated levels, and those dynamics will impact the Fed and are not the kind of thing that China is going to influence on a 3 to 6 month basis.
Great. Thank you both for joining us. Grace Peters there from JP Morgan Private Bank, and Bloomberg's Craig Trudell with all of the earnings coming up from BYD. Coming up, we also speak to Victor Kozla, founder of one of the biggest opportunistic credit investment firms, SVP. Some say it's investing in distressed companies, so we'll ask about the level of distress out there. We also had to look at what's happening overall with markets. Again, there's a lot of focus on what Trump does next for these targeted U.S. tariffs, which is why we're seeing a bit of a lift, especially with U.S. futures getting some 1% for the S&P, and you can see the NASDAQ futures getting some 1.2%. Markets definitely still on edge ahead of Trump's April 2nd deadline to impose reciprocal tariffs on a raft of other countries, but we've spoken to people familiar with the story saying, look, the announcement is shaping up to be more targeted than previously thought. This is Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Risk sentiment turns positive on reports that the next wave of tariffs from President Trump may be more targeted, with officials saying some countries may actually be exempt. U.S. and Russian officials are meeting in Saudi Arabia a day after American and Ukrainian teams held talks as President Trump pushes for a ceasefire in the war. And Turkish authorities scramble to shore up the nation's assets after the arrest of President Erdogan's main political rival. Now, we'll also focus on the UK. Of course, it's a big week today. Well, big week on the 26th because of the financial statement from the Chancellor, Rachel Reeves. We're also getting some data right now. UK March services PMI rising to 53.2 instead of 51 in March. Again, the composite PMI rising to 52 versus 50.50 in February. So a touch better, but again, nothing huge. Of course, the UK aims to slash the number of civil servants by 10,000. So that's as the targets of 15% reduction in the government's operation costs. Now, the planned cuts come ahead of the Chancellor of the Exchequer's key update on public finances on Wednesday. For more on all of this, Joe Mays, Bloomberg's UK government reporter, joins us. So, Joe, thank you for joining us. What can we actually expect to hear from the Chancellor in the spring statement on Wednesday?
Yeah, so the big thing we're expecting is a significant reduction in the overall level of public spending. We're thinking billions of pounds will be taken off that figure so that the Chancellor can continue to meet her key fiscal rule, which is that day-to-day government spending has to be covered by tax receipts. Her problem is that growth forecasts have deteriorated since her budget, her borrowing costs have gone up, and that's left her on course to miss that key fiscal rule, and that's why we're in the world of talking about spending cuts. We think on balance we can see about £10 billion worth in cuts. £5 billion of that will come from reducing the welfare budget and £5 billion from other government departments. She also tried to have some more positive announcements about funding for various initiatives, but really the big picture is that reduction to spending.
What kind of pressure is the Chancellor facing from her own MPs?
A lot of pressure, and it's really around this commitment that Labour had during the election campaign, which is there'll be no return to austerity in government spending, and yet Rachel Reeves is clearly doing something here which has the airs of being austerity. So she's facing pressure from Labour MPs to do things like perhaps relax her fiscal rules, not be so kind of hardcore with this approach of sticking to those numbers, perhaps increase a wealth tax. Might that be a better way of balancing the books? There's a lot of concern also around the welfare reductions that we just talked about. Many MPs opposed to that. So there is really a growing split on the backbenches of the Labour Party who don't support the action that Rachel Reeves is taking. For now, a majority are with her, but it's something that she has to watch. And yes, it's a politically sensitive moment for the Labour Party.
So the UK is also considering easing the digital services tax to appease Trump. Why?
Yeah, so this is a potential quid pro quo where the UK is clearly trying to avoid being hit by more tariffs from the US and indeed to try and remove the tariffs that have already been imposed. I think that on the negotiating table, they can see that there is this digital services tax which imposes a 2% levy on revenues from UK users for social media platforms, and that is not liked by the likes of your Googles, your Facebooks, and clearly they are pressuring the US administration to have this tax removed. So the US are using this as a bargaining chip or an attempted bargaining chip in these talks, and the UK is open to this, and we're having discussions at the moment between UK Business Secretary and the US Trade Secretary, Treasury Secretary on this issue right now. So we'll have to see what the UK does. I mean, clearly this tax will raise about £800 million for the UK, so that's really of value. But then also, if it can be used to remove those tariffs, that can have a bigger economic value for the UK. So those are the kind of discussions that are happening in Whitehall at the moment. We'll have to see where that ends up.
Joe, thanks so much. Joe Mazer, Bloomberg's UK government reporter. It's going to be a busy week for Joe and the team. Now, for viewers in the UK and Europe, we have a special coverage of the UK Chancellor's spring statement on Wednesday. That's at 12:15 p.m. UK time, with the Chancellor set to speak from around 12:30 p.m. Now, subscribers will also be able to watch on the terminal, and we'll be live streaming our coverage on YouTube. Now, the relentless demand for corporate debt is showing signs of fading under the pressure of global trade tensions and geopolitical uncertainty. Now, in the U.S., junk spreads have widened by the most in 6 months, but remain near historic lows, meaning they could move out significantly more if a recession hits. Now let's discuss the debt outlook with Victor Kosla, founder of opportunistic credit investor Strategic Value Partners. That's an elegant way of saying distressed. The firm manages around $22 billion in assets across areas including distressed debt and private equity. Victor, thank you so much for joining us. I mean, you're so busy at the moment because actually I imagine what takes up most of your time is understanding the policy going forward, which means how many companies will be distressed or where there's opportunities for you.
We were really busy last year, even before all this started this year, right? So, and I think the way I'd kind of say it is, last year, in a way, Francine, you had very strong equity markets, you had strong credit markets. Very unusual for us, somebody like us, to be so busy. And if anything, with the U.S. almost taking a completely different path to what it has done, right? If anything, we've gotten kind of a lot busier. So it wasn't like January wasn't the starting gun going off. No, yeah. The starting gun went off a year ago.
And this is what? Because of rising interest rates?
Rising rates, maturities of debt, in a way, trillions and trillions of dollars of deals have been done in a 0% rate environment since 2008. And as that debt matures, you can extend it, you can amend it for a little while, but as that debt matures, you have higher rates. You just have had much higher defaults than you would expect.
But Victor, so I'm still surprised, that we haven't seen, more distress, that we haven't seen anything big going under or anything big going ugly. So is the overall health of a lot of the companies better than even you thought?
No, it isn't.
So we're just not seeing it.
We are seeing it.
Yeah.
Because under the surface, right? And this is even before this January, there were like if you take last year, there are 6 businesses, Francine, worth about $1 billion each, where we took over the business and today are the majority equity owner. There's $1.5 billion of real estate investments we bought. There are some very large investments we made in real assets. So all this, it's not the headline grabbing $15 billion bankruptcy. It's not Lehman Brothers. It's not that. But what is happening underneath the surface is just frantic activity.
So where do you see the most opportunities, in the U.S. or Europe and the UK?
Europe has been struggling economically. So as a firm, we are about 60% US, 40% Europe. We're almost equally balanced. And Europe has been struggling economically now for the last few years. So we've always felt, so when we look at our pipeline of kind of deals today, it's more 60% Europe, 40% US. So if anything, we're leaning more towards Europe. Now, the US is doing a good job catching up. Right, so please don't get the wrong idea, right? But Europe has just provided us with just a steady stream of opportunities for the last 3-5 years.
Victor, what's your strategy in the UK? I think you just bought a sizable office in London. Is that because you want to grow in the UK?
We've always, for us, we've always been a steady investor here for the last 20 years. So for us, it's just
so it's a cherry on top. It's not like
it's 40% of our portfolio.
Fine.
We have almost 50 investment professionals in London. So as for us, it's just like as an opportunistic credit person, it's just been like the last couple of decades there's been a lot of stuff for us to do.
There's been a sea change when it comes to European defense. How do you play that trade?
We are not a defense investor. So for us, we don't really look at buying defense companies, running defense companies. So it's just kind of a modest interest to us.
Is there a sector that you think is particularly
I think
good?
For us, the manufacturing businesses, industrial businesses, business services, consumer brand businesses, very much the sort of investments we look to make.
Yeah.
And then there's a moment in time when real estate gets really interesting.
Now or soon?
Now. It's here. We bought, look, we recently bought a property in London. We took over the largest shopping mall in Ireland called Blanchardstown, and we did that late last year. So for us, if anything, it's time to get rolling on the real estate side.
Even in Germany, or do you really break it down in terms of countries?
No, we're very focused on Germany. The opportunity set so far has been more England and Ireland for us. But I think our sense would be these high rates. High rates, which, when you borrowed money with German bunds in negative territory, to now German bunds close to 3%, you just have a problem, especially when you are buying properties for 3%, 4% cap rates.
Do you think we had credit complacency?
Of course we did.
And is that over?
Yeah, I wouldn't go quite that far. There is still, when you think of the credit world, spreads are incredibly tight, as you started out saying. But you can make 8% in junk credit today. I think equity markets today, you'd say, hey, if I get 8% out of it, I think it's kind of pretty good. So when you think about 8% and those sort of returns you can make, I think people are, I don't think the complacency, I wouldn't go so far as to say it's over. There is a reckoning, and it is here.
And it's starting. Victor, where do you see opportunities in the U.S.? Because there's a lot of noise, there's a lot of news. Does that give you an extra layer of opportunities?
It does. The U.S. has always been fortress America. It doesn't have very much in the way of these economic events or economic cycles. In Europe, when we contrast it, Francine, every 2-3 years, there's a crisis in some way, right? But what is happening in the U.S., this upending of kind of how the U.S.'s relationships with the world work, tariffs. You look at how we are remaking the U.S. economy, right? That uncertainty, and it won't go away after April 2nd, after the tariff thing either, right? That uncertainty, it's dropping consumer sentiment, it's dropping industrial growth.
So do you see opportunities in everything linked to consumer? Is it retail?
Consumer, industry, manufacturing. Those are the sort of investments we've been making over the last 6 months. And if anything, we're just leaning much more into those kind of deals.
So interesting, Victor. Thank you so much. Don't be a stranger. Every time you're in London, you should come back on so we try and keep pace with what you do next.
No, I don't mean to be overly doom and gloom and scary about it, but there are parts of it which are really problematic. But thank you. Thanks for having me.
Thank you, Victor. Victor Koza there, the founder of Strategic Value Partners. Coming up, we'll also be joined by the LinkedIn co-founder, Reid Hoffman, who's written a book arguing that AI will enhance human agency rather than eroding our thinking skills. Stay with us for that conversation. That's next, and this is Bloomberg.
I guess the most dangerous words in the English language are maybe get your affairs in order.
No, I think it's a reasonable thing. I think it's an important thing. There's nothing wrong with it. And I'm not saying it as an alarmist thing. I just believe in
it. Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Now, earlier this month, an AI model called Manus went viral for its apparent ability to act more independently than AI chatbots. Now, the development of the so-called artificial intelligence agents have raised concerns that they will erode human ability to think. But Reid Hoffman, the LinkedIn co-founder, Microsoft board member, and Greylock partner, thinks the opposite. Now, he's just published a book in which he basically argues that AI systems gain greater abilities. They will enhance human agency, hence the book's title, Super Agency. What could possibly go go right with our AI future, and Reid is here with me. Thank you so much, Reid Hoffman, for joining us. I mean, this is a fresh of breath air, because there is a lot of concern, a lot of worry that AI takes over, the computers will be in charge, and will basically stop using our critical thinking.
Yes, but actually, in fact, if anyone plays with AI today, it is the most amazing educational technology we have created in human history. If you want to learn anything, I use it to learn everything from quantum mechanics to like, I wonder what cooking sous vide in this way looks like. It's everything.
But I guess the concern is that, you know, especially people that go into a first-time job, or students, or like, you know, college kids, don't use their critical thinking anymore, because if you just go into a chat box and say, write me a sonnet with this, this, and this, it does it for you.
Well, it definitely can do a bunch of things for you, but that can help you elevate your game, right? So it's a little bit like if you were just copying Wikipedia as handing in your essay. Sure, you could do that, but actually, in fact, you should use it to inspire you, to make you think better, to say, hey, like, for example, when I was writing Super Agency, I would put in sections and say, how would a history of technology specialist critique what I've said? And then I understand it, and I can decide whether or not I change or edit and so on, and therefore the book gets better.
So, Reid, it doesn't reduce cognitive capabilities, right? This is a big concern that you know, we stop thinking, that we think less, that we think differently.
Well, I think it makes it, just like all technology, you can approach it being lazy. And so if you just say, okay, I'm going to outsource it, just like, for example, I'm going to say, whatever the first search result on Google is, that's the answer. And if you do it that way, then of course that doesn't help you extend. But if you do anything in terms of having it be a dialogue with you, having it extend your capabilities, asking a question, getting an answer, asking another question, then it greatly amplifies your capabilities.
How do you get rid of the biases? Because if you have too many biases, then it skews, of course, democracy.
Well, so all of the major AI labs are trying to get it as, kind of call it, unbiased as possible. Now, within human perspective and human knowledge, there's always some things of bias. We're always learning. Like if we kind of look at human beings 50 years ago, or 50 years past, and we look at them and say, oh, they were biased about this, I'm certain humans 50 years from now will be looking at us the same way. So it's an ongoing process with us as well as the technology.
Reid, is there anything that worries you about AI?
The primary thing that worries me is I call AI the cognitive industrial revolution. It's both for the upside, which is this whole society we live in, middle class, education, medicine, all comes from the Industrial Revolution. That same amplification is coming, but the transitions are difficult. So the thing that primarily worries me is to say, look, we're going to have to navigate this challenging transition, just like the Industrial Revolution was a challenging transition, but that's how we have our children and our future generations be prosperous and have amazing societies, and so that's the challenge we need to rise to.
So what's the right way of either designing AI or designing safeguards for AI?
Yeah, well, part of it, there's kind of a two-part audience for Super Agency. One is the people who are AI fearful or concerned, to help them become AI curious. But it's also for technologists, which is designed for human agency, designed for increasing human agency. That should be your design principle and fundamental, and the book is also, I hope, helpful for them.
So, Reid, this is basically putting, you know, the human at the center still of everything. So how they fit into the next decade.
Yeah, well, AI, I think, can be amplification intelligence, not just artificial intelligence, and that amplification, the superpowers that we get. And it's not just part of Super Agency is if you get a superpower, that helps me too. That's how we have Super Agency together.
As long as it's democratic and everybody has it, or is that a question for in a second phase?
Well, I think one of the good things about it, and that's part of the reason why the first chapter is about humanity enters the chat, a la ChatGPT. When we build technologies for hundreds of millions and billions of people, that's broadly inclusive. So your Uber driver has the same iPhone that Tim Cook has. That's the kind of inclusion that we're targeting.
Reid, I mean, I guess evolution is not necessarily progress, full stop. So how do you make sure that this means progress for the majority of humans?
Well, so I think Look, I think as we iterate and we participate, we make progress. And for example, even though you say, well, we have a whole bunch of cars and that creates climate change, the cars also create our industrial society. And by the way that we tackle climate change is we add carburetor emissions, and we add, we invent new kinds of clean energy, and we do EVs. And so, I tend to be very, as we do iterative deployment and as we bring humanity into the loop, I tend to think we do make progress. Now, I think, again, you make better progress by having the right kind of design principles, by accepting criticism, by talking about it. So, I describe myself as a bloomer, which is not that technology is just great. It's technology engaging with people is great.
But it also depends on the people in charge. What do you think of Sam Altman's performance so far in leading OpenAI?
Well, so I think Sam's great contribution to humanity will be OpenAI. And that's with having done a number of amazing things before and done amazing investments like Infusion and all the rest. And I think that his ability to think very big and to have bet very hard on this, a little bit of technological thesis of scale compute and scale learning systems is what matters. And that's why OpenAI has brought this current revolution to us. And it's these machines learn, and they learn things that we help them learn and help teach them.
Is there someone, I know you've also had your differences with Elon Musk. Who's the person in the space that you, if not admire, listen to the most?
Well, Sam Altman is definitely one of them. Kevin Scott at Microsoft is another. Dario Amodei at Anthropic is another. James Manyika at Google is another. I mean, I think part of the thing that's very important about making AI for humanity is people who listen to others and talk to others and accept criticism. And I think that's one of the things that all of these people are very good at.
Do you need to regulate it, or is it something that you need to see how it runs and then think about regulating afterwards?
So I think what you do is you start with the absolute minimum regulation you could do for the things that could be really bad. Not for, oh, look, it might have a biased picture or it might have a biased statement. Like, we can iterate, we can fix those as we're going.
Really bad is what? People taking over planes to crash them and things like that. It's
terrorism,
like terrorism.
Cybercrime, et cetera. Regulate for that, right? And then do iterative deployment. And by the way, even with iterative deployment, you eventually get to further regulations. So like, for example, if you tried to make everything perfect with cars before you put them on the road, we'd never have cars. So you put them on the road and you go, oh, this for bumpers, this for window wipers, and occasionally, like, the market doesn't want seat belts, the car manufacturer doesn't want seat belts, and then of course the regulators come and say, oh, no, seat belts is good, we're going to add those.
But if you regulate for things, terrorism is bad actors, bad state actors, so it's, how do you regulate it unless you have to protect yourself? So it's basically finding the technology that blocks them.
Well, I think the regulation is, if you're releasing the technology to the general public, which could be to the bad actors as well, you're doing red teaming and safety. You're putting the right security measures to make sure that you're not bleeding the technology to rogue states, terrorists, etc. That you have a safety plan that if you go, okay, why is the technology I'm building, if it does leak or anything else, why will it still be safe? And how do we continue to have the technology that makes anything that's in the wild as safe as possible?
On Elon Musk, do you think he has too much power being so close to the president?
Well, so, look, I think he's a celebrated entrepreneur, but I think that governments are not companies. Like, for example, risking a company, like, for example, say, oh, our 10 rockets blow up. Who cares? It doesn't matter. The financial system of a country blows up. That's the Cultural Revolution. That's terrible. So you actually have to say, we take less risk here, even at the price of some inefficiency, because it's more important for us to not have things blow up.
So do you worry that things are going too quickly with the Trump administration?
Well, I worry that very bad risks are being taken. Speed is not a problem. Risks are a problem. And, for example, it's like, well, we're just going to fire a whole bunch of people. Oh, oops, we fired a whole bunch of nuclear safety inspectors. Like, that's the kind of thing that's taking risks that is unwarranted.
Reed, I also want to talk to you about China, because DeepSeek kind of got everyone, at the edge of their seats. But do you have a good understanding about where China is on AI?
I have a reasonable understanding. I do a fair amount of talking to various people in China in order to make sure. Part of the thing that when last year I was going around saying there was actually an economic race with AI between the West and China. People are like, oh no, you're overblowing that because you just simply don't want to be regulated. And I think with DeepSeek and everything else, we see that race is there. And the Chinese government has said that they want to be, AI leaders, like leading the world by 2030. I think the race is on. I think it's very important for us and our industries to actually, in fact, be winning.
But is this the new arms race?
Well, I don't call it an arms race because it's primarily an economic race. There is arms stuff components to it, but yes, it is the economic race.
Reid, thank you so much for joining us. That was Reid Hoffman, a LinkedIn co-founder, Greylock partner, and of course author of Super Agency. It's a good book, it's well written, and it's to the point. Now later today we'll also have an exclusive interview with the chief executive of Airbus. He is Guillaume Faury at the company's summit in Toulouse in France. You can catch that interview with Guy Johnson at 3:40 p.m. UK time. Now before we go, let's also have a look at what a lot of these markets are doing. Look, they're expecting a lot more targeted tariffs from Donald Trump, certainly not the kind of bravado that we were talking about just a couple of days ago. If you look at a couple of the other things, pound nearing a session high after the services PMI beat, and then also Eurozone private sector is picking up as Germany is trying to fuel its recovery. Up next, Bloomberg Brief with Danny Berger in New York, and this is Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
I prided myself, probably wrongly, having worked in many countries, been brought up as a child in the Middle East and in the Far East, having a mother who was not British, she was Hungarian, she was a survivor from Auschwitz, and I was the son of a Holocaust survivor, and being involved with lots of people, I thought to myself, I know a lot about diversity, and I know about inclusion and not being included. But actually, when I came out, I realized that my level of understanding was not very high. And actually, I could see both the support and the rejection of being different, and what you had to do to live a life where you were different. And I'm immensely pleased that I was outed when I was 60, just under 60. Because had I not been outed, I probably would have said I could stay in the closet and still believe that I knew everything, which I didn't. And that was a very important moment for me.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
The next couple of months is going to be a really rocky road.
We are at an unprecedented level of uncertainty. Gold is a perfect manifestation of policy uncertainty.
The uncertainty effects are much worse this time than they were in 2019.
It's almost impossible for me to say, we've seen the bottom, we can break out of this trading range, and it's time for us to add.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. Bloomberg surveillance starts right now. Coming into Monday with stocks bouncing after snapping a 4-week losing streak. Sentiment improving as officials familiar with the matter indicate the president's major tariff announcement may turn out to be far more targeted. That's leaving investors focused on the incoming data, looking ahead to taking the temperature on consumer confidence later on in the week before getting another read on U.S. inflation.
Yeah, this to me raises the question, what's going to be more important, the current economic data or potentially what the tariffs may or may not be? Honestly, how much credence can you put into headlines that whip around markets when you talk about maybe it's only the dirty 15% that we're talking about with respect to tariffs? Those dirty 15 include China, the European Union, some of the U.S.'s major trading partners. So it really comes down to where the economy is now and how susceptible it is to some of these shocks.
I would frame this as the following. This is a snapshot of where current thinking is, and things are always best described as fluid. It always comes down to the mind of one man, President Donald Trump, and that mind can change repeatedly between now and next week.
And the reporting from Josh Wingrove is that the negotiations behind the scenes are continuing to happen. Even Scott Bessent, the Treasury Secretary who talked about these dirty 15, also said these countries or these unions could come to America first and maybe strike a deal before April 2nd. What I would say, though, is overwhelmingly the reporting is talking about reciprocity and about selective tariffs. I don't think you're going to get the sectoral tariffs come April 2nd. It is going to be country specific. And what I would say to those people is, if you have a trade deficit with the United States or your tariff is much higher than the U.S., then you have a problem. But potentially, if you lower your tariff rate, you may be able to be in the clear.
There was a massive focus on this over the weekend, whether April 2nd was the date of peak uncertainty, where we could move past this and equities could deliver somewhat of a relief rally. The day when we have certainty could also be the day when we appreciate the economic consequences of it. Peter Cheer of Academy over the weekend with a thoughtful note.
And this, to me, really goes to the heart of the anxiety right now. No one expects certainty on April 2nd. Let's be very clear. Question is, what is the new paradigm that we're trading within, and how much is that going to have ramifications on the hard economic data? That's why I think that this week's PCE report and personal income and spending report is going to be interesting. That said, it's likely to be more of the same. The hard data showing just everything is status quo and chugging along, maybe a slight deterioration, where the soft data deteriorates much more significantly. That's what Deutsche Bank thinks. That's what a lot of people are thinking.
Kicking things off with a better tone this Monday morning. Good morning to you all. If you're just joining us, equity futures firmer by 0.9% on the S&P. Coming up on the program through the next 60 minutes, we'll catch up with Keith Lerner of Truist following a winning week for equities, Terry Haynes of Pangea Policy ahead of Trump's Liberation Day, and Michael Dada of Roth MKM Partners on positioning for the end of the business cycle. We begin this hour with stocks higher on signs that President Donald Trump's next round of tariffs may be more targeted than expected. Keith Lerner of Truist writing, on a shorter-term basis, markets are becoming stretched to the downside, and our work suggests the market is in the ballpark of a bounce. Keith joins us now for more. Keith, welcome to the program, sir. What gives you the indication that maybe we are in that ballpark for a better bounce from here?
Yeah, well, hey, great to be with you. Great to see some green on the board this morning. You know, back in February when we last were on the program, we actually downgraded equities when we were around 6,000. Around March the 11th, a lot of our work suggested that the market had gone too far, too fast to the downside. We looked at, we had a two-point contraction in the multiple for the S&P over a 2-week period. Historically, outside the pandemic, the last 10 years, we haven't seen something more aggressive really than that. We saw some technical indicators become extremely stretched. And we also saw some things like the put-to-call ratios also spike as well. So you put that all together on a short-term basis, as we were closer to 5,500 in our work, suggested things had become overdone. But we do think it is a balance within a choppier range at this point, Jonathan.
Keith, credit to you. You downgraded equities back in February. A lot of people were freaking out about tariffs at the time. It's not just tariffs, though. This is what Bank of America and Michael Hartnett have to say going into the weekend, that DeepSeek and Doge are much bigger Wall Street drivers than tariffs in Q1. And Keith, this is where things get complicated going into next week. How relevant is April 2nd? Have we already discounted the tariff story or not?
I think it is relevant. I mean, it's many different factors happening at the same time right now, but the tariffs are certainly a factor. And if you think about a market multiple, a valuation or a P multiple is based on confidence. And the key word we keep hearing is the word uncertainty today. And that uncertainty has led to that kind of quick contraction in the multiple. Now, the markets are not cheap, And by the way, uncertainty, we always live with uncertainties. Are you being compensated for that uncertainty? So listen, I think that tariff, even right now, we reset expectations a bit. We're getting a relief on just something that's perceived to be better than expectations. But I also, going back to your original question, I mean, DeepSeek was a competitor that opened up a different view of the Chinese technology companies that we didn't have, 6 months ago in this market. So I think altogether that also suggests the upside of the multiples relative to the beginning of the year is likely somewhat constrained as well.
To put these ideas together, there's a real kind of question about U.S. exceptionalism based on that uncertainty tax on valuations that already are elevated. And that, I think, is what a lot of people have been grappling with. How much is this just, you have to have a different kind of a risk-adjusted metric in the United States with this level of uncertainty that removes some of the luster of former U.S. darlings? Do you think that is an appropriate way to look at market valuations? Is it a reason to be a little bit skeptical of U.S. equities here?
Well, again, I mean, on a short-term basis, we do think we have a bit more upside. I think we can probably rally in the S&P. We're around 56, 67 this morning. I think maybe we can get up to 5,900, 6,000, and then I think we'll see maybe some selling pressure, some choppiness. But to your point specifically, listen, the U.S. still has some of the best companies in the world, no matter what, and some of the best free cash flow, earnings growth, and so forth. I just think you came into this year where you had an opposite as far as expectations, and you've had a little bit of good news go a long way, in Europe. On a short-term basis, you saw it in the fund manager survey about a week ago. You had the biggest 1 month reduction in U.S. overweight. So in some ways now, everyone's kind of this U.S. exceptionalism kind of collapsed relative to the beginning of the year. I think on a short-term basis, with this short-term rally that we're talking about, I think you'll see money rotate back into the U.S. and probably led back to the Mag 7 and some of these technology names.
So, Keith, can you give us a sense of what the trigger is for that? A number of people have come on and said maybe this flow into Europe is overplayed. Maybe people have gotten over their skis with optimism that Germany really is going to unleash the taps of stimulus and really change structural aspects of their economy that have hindered growth. Are you saying it's a ruse, it's over, it's done, go back to the U.S.?
No, listen, I do think that the fiscal changes from Germany is significant. And I think as you think about, and a lot of what I'm talking about, timeframes matter. If you think over the next year, I think at your allocations, you probably want to have more weight to international than you had, say, a year ago. I'm just saying on a short-term basis, you kind of went to such an extreme. Europe outperformed by about 20% since December, and basically, markets don't move in a straight line. So I think you kind of reset the bar for the U.S. You have an elevated bar for Europe in a short-term basis. A lot of that outperformance in Europe has been defense names specifically. So they've just moved so much that I think they're due for a breather, maybe a little bit of an unwind. But as you kind of have this little bit of the short-term reprieve, I do think, that fiscal stimulus is a big change. DeepSeek is a big change. So again, we're overweight the U.S., but basically what we're saying is like an accordion. You want to kind of bring in those bets as you see this kind of short-term rally that we think has some short-term legs here.
Keith, putting the short-term rally aside, long-term, how do you view the United States? Right now, we're really discussing only one pillar of the Trump agenda, which is tariffs. What happens when you get potentially more deregulation and the extension of tax cuts?
Yeah, and that's the big question right now. I think ultimately, I think that is a positive. After the election, the market was all focused on all the positives. Now, the last month or two, we're focused on all the negatives. In a couple of weeks, we'll start talking about tax policy again. So I think it'll be more of a measured picture as we move deep into the year. So to your question, I still think the U.S. on a relative basis, especially as you look about, longer term, 3 years, 5, 10 years. I mean, the majority of the most successful companies are still in the U.S., so we still want to be overweight U.S. longer term. I'm just saying that relative to the last couple of years, the magnitude of an overweight likely has to come in somewhat because of how much we've outperformed and some structural changes, like we talked about in Europe. The other thing that's interesting, going back to China, Chinese tech and U.S. tech moved, basically in tandem from 2015 to about 2021. That's when China started to accelerate, or the government started to crack down more on the Chinese technology companies. So as they've kind of eased up now, those markets have performed better. And I think, again, you're seeing some better innovation out of China as well.
So basically, another way of asking my question is, you upgraded cash from less attractive to neutral. You think you need a slightly higher cash level. When would you actually say, no, that cash needs to be put to work now?
Yeah, well, So again, I think we're going to have a bit of a bumpier just road this year in general. So we're still, our overall allocation is, Lisa used to joke with me last year, at some point we were there strongly neutral again, and we have that cash. We're not really ready yet to deploy it. But, you know, part of this kind of short-term call that we had a few weeks ago that we had to bounce is, you know, when we downgraded stocks, it happened so quickly. Some of the advisors we spoke to, or they couldn't move that quickly. So it's kind of saying we're down 10%. I want to be selling here. Wait for a bounce back to 5,900, 6,000 on the S&P, and try to dial back exposure more towards a neutral overall exposure. I still think at this point I would hold that cash. I think we'll have some better opportunities because even with the tax policy debate that comes up, we have such slim margins. I think it's going to be a kind of a choppy period.
Hey, Keith, appreciate the update and your view, sir. Keith Lerner there of Truist. Big week coming up. Looking ahead to next week, April 2nd, and so-called Liberation Day. For who? Liberation Day for the equity bulls or not is something we've got to figure out.
Liberation for the uncertainty tax or not necessarily. A lot of people are looking past this. They don't expect this to necessarily be some sort of conclusive moment. What I do find interesting is we are getting challenges to this idea that U.S. exceptionalism is over, that the money that's flowing into Europe is going to stay. Mike Wilson this morning talking about how a weaker dollar will actually support S&P 500 earnings and should bring returns back to the U.S. So a really muddled picture on multiple fronts.
Equities bouncing back this morning to kick off the trading week. We're positive by around 1% on the S&P 500. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Hackett. Say, Yahara.
Hi, John. President Donald Trump's incoming wave of tariffs is poised to be more targeted than originally expected. Sources telling us the president's upcoming Liberation Day tariff announcement set for April 2nd is set to exclude some countries from widespread reciprocal tariffs. Meanwhile, SAP has unseated Danish pharmaceutical giant Novo Nordisk as Europe's most valuable company. Shares of the cloud-based software company rising in the current session, giving it a value of $344 billion US. Meanwhile, Novo Nordisk shares are down over 17% year to date as it faces pressures in the weight loss drug market. And Disney's Snow White fell short of box office forecasts on its opening weekend. Disney saying the live-action remake delivered ticket sales of $43 million in the U.S. and Canada, shy of its estimated range of $45 to $55 million. That's your Bloomberg brief. John?
Cost $250 to make. Absolutely bombed. Yahara, thank you. Appreciate it. More on that story a little bit later. Wanted to get you up to speed on this story quickly. The Women's March Madness bracket. Guess who's leading here at Bloomberg? Do you even know? No. Anne-Marie Hordern is winning. 1 point behind. 1 point behind Mark Rowan of Apollo.
As you can tell, she's paying a lot of attention.
No, I will admit, I cheated. Bria, the producer, sat with me.
Oh, Bria did this for you?
And she, we did it. It was a joint effort, but we went line by line together.
She typed, Bria talked.
Wow,
you're at the top of Bloomberg LP. Worldwide, globally, including everybody else, you're just 1 point behind Mark Rowan of Apollo.
Thanks for that news, Jonathan. Happy Monday.
Let's see if this sticks. Up next on the program, we're counting down to the tariff deadline.
April 2nd is going to be Liberation Day for America. We've been ripped off by every country in the world, friend and foe. That money's going to be coming back to us in the form of tariffs. They're tens of billions. It's going to be numbers like nobody's ever seen.
Up next on the program, Terry Haynes of Pangea Policy, live from New York City this morning. Good morning.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Anne-Marie didn't know, and now it's the only thing she's talking about.
I'm leading in the bracket, have you heard?
Yeah, seriously. The rest of the day is wrapped.
Equity futures on the S&P just about positive. A nice bounce. We're up by 1% on the S&P 500. Yields are higher by 3 basis points. The 10-year 4.28. Under surveillance this morning, we're counting down to the tariff deadline.
April 2nd is going to be Liberation Day for America. We've been ripped off by every country in the world, friend and foe. We've been ripped off on trade. We've been ripped off on military. We protect people, and they don't do anything for us. It's just so unfair for years and years. And now some of that money is going to be coming back to us in the form of tariffs. There are tens of billions. It's going to be numbers like nobody's ever seen.
So here's the latest this morning. The White House narrowing the scope of tariffs set to be announced on April 2nd. Sources telling us here at Bloomberg the levies will now exclude some nations, and the president's previously announced sector-specific tariffs are now on hold. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, some of our reporting over the weekend, why don't you give us the headlines and what's changed relative to expectations going into next week?
Well, John, the biggest headline appearing to be that the White House is no longer planning to implement those sector-specific tariffs on April 2nd. As you know, these were tariffs against specific sectors that President Trump had singled out, including on autos, pharmaceuticals, lumber, and chips. To give you an example of how quickly this has changed, it was exactly 1 week ago today, March 17th, when President Trump told reporters coming back on Air Force One that we could have expected those sector-specific tariffs to be stacked on top of the reciprocal tariff plan. Now, at this moment, it does not appear that they are moving ahead with that on April 2nd, but it could come later. And then the other important part of this reporting is that it now appears that the broader reciprocal tariff plan could be pared back and that some countries could be excluded if they don't have tariffs on the U.S. or they run a trade surplus. Importantly, NEC Director Kevin Hassett said on Friday that he felt that markets needed to change their expectations because not every country cheats the U.S. with trade, as he said. But to be clear, that has not been the messaging until really last week when we saw Treasury Secretary Scott Bessent say that we could expect them to target the so-called dirty 15, the top 15% of our trading partners that make up the bulk of the imbalance with the U.S. here. John, importantly, though, we should note that these tariffs could still result in levels not seen in the U.S. in decades, and this White House really is banking on tariffs bringing in revenue. But at the same time, this is considered to be a more tailored and narrowed down approach.
Tyler, when it comes to how the president is thinking right now, he did say something along the lines of, I don't change, but I like the word flexibility. You have to be flexible. How much are we seeing negotiations play out now before April 2nd?
Right. Well, for one example, one thing that's still held from over the weekend is that we're not expecting carve-outs as of now come next week, even as these negotiations continue, particularly with private sector companies coming in and out of this White House for negotiations. We did see one serious step in talks, particularly when it comes to China over the weekend. U.S. Senator Steve Daines, a Republican from Montana, returning from Beijing, becoming the first top U.S. official to meet publicly with a Chinese diplomat since this administration has started. But still, as we move forward, as of now, this administration saying that it is going to particularly target those countries, and we know that President Trump, when it comes to how he feels that countries are either cooperative or being more combative, will be factored into this. That's why we're also particularly watching the European Union and those specific countries that we are expected to get hit with those tariffs. Just quickly, Anne-Marie, I would just add that we saw Australia, one of those countries that had been really hoping particularly for those steel and aluminum exemptions over the weekend. Their treasurer saying that they expect seismic shifts to the global economy as we start to hear that rhetoric ramp up ahead of next week.
They're not alone, Tyler. Appreciate it. Tyler Kendall with the latest. Thank you. Something we haven't given a ton of thought about, given the rally abroad we've seen, particularly in Europe and in China. But the weaker data started to emerge last week. Might just be a small data point for financial markets, but business confidence in Canada absolutely collapsed. This is not something the market is really traded on, but it's something we could be trading on in the months ahead.
And it's something that the Bank of Canada is maybe moving on or not moving on in response to that potential weakness, because they do see it coming down the pike, which raises this other question. People seem to be going into the rest of the world because suddenly they don't think that they're going to suffer as much as they did earlier this year in the heels of some of the tariffs that are about to be placed on. Will that get rethought as we do get some more details about what these tariffs are going to look like?
Terry Haynes of Pangea Policy joins us now for more. Terry, welcome to the programme, sir. Good morning to you. Let's just start with your base case. What do you expect to see April 2nd?
Well, really two things, John. One is I think your reporting has been excellent on the idea that these are going to be kind of less sweeping, less hammer-like. But I think markets trade one kind of uncertainty for another. My touchstone on this has always been Secretary Bessent's view that tariff direction is always path dependent. And what he means by that is the reaction of other countries outside the United States to what the United States wants in terms of lessening or rationalizing tariffs and economic behavior more generally. And, you know, I think what you're going to get is you may get less than meets the eye on April 2nd, but at the same time, what you're going to see is a lot of negotiations between an awful lot of countries and the United States about how to lessen tariff barriers and, or if failing that, maintain them, and maybe some non-tariff changes as well. So, again, one kind of uncertainty for another kind of uncertainty, I think.
Terry, Jonathan said earlier today the most correct word when it comes to situation, fluid. What kind of behind-the-scene negotiations are having, basically? What's Peter Navarro saying versus what's Kevin Hassett saying?
Oh, well, I'm sure they're negotiating among themselves, and Navarro, of course, is a hardliner, whereas Hassett so much isn't. I would look to what's happening outside the United States as well. I know full well that Commerce Secretary Lutnick's people have been giving sets of tariff and non-tariff requests and demands to different foreign countries so that they can react, respond, and hopefully change things. And that's one of the reasons why I say that I think going forward here, this is very much going to be an uncertain field. This doesn't end April 2nd one way or the other.
Well, when Scott Bessent was talking about the Treasury Secretary, the Dirty 15, he also talked about that some of these tariffs may not go into place because a deal was negotiated beforehand. Do you expect a number of countries to negotiate deals before next week?
Yes, I do. I think some do, and you know, and a lot don't, and that depends on their individual political and market situations as much as anything else. The nimbleness of their governments and the ability to react and respond to what the United States might want, and you know, on the other hand, the coherence of how the United States, frankly, communicates its own demands and requests. I mean, we've seen that before on, for example, on Canada and Mexico tariffs, and I expect that to continue here on a worldwide basis, frankly.
Terry, maybe this is inside baseball, but when I was reading all the stories over the weekend about how the tariffs wouldn't be as broad-based as previously expected, I was thinking, who's leaking this? What is the reason behind the concerted effort by the White House to send the message, hey guys, it's not going to be that bad? And I'm wondering, is this a message to markets or a sign that this White House cares more about some of the turmoil in markets than perhaps they're letting on?
I think probably a little bit of both, but I think more of the first, frankly. You know, the president's statements are fundamentally not for markets. Markets should pay attention to what the president says, of course, but they're fundamentally not for markets. Presidents are tone setters, and Trump is very good and, you know, almost over the top at tone setting. But what you're getting underneath that from Bessent, from Lutnick, from others, is a desire to tell markets that, look, you know, the reality of this is going to be somewhat different. It's not going to be, you know, completely different than what the president says, but there's going to be more nuance and sensitivity to market concerns.
Terry Haynes of Pangaea Policy. Terry, appreciate it as always. This is something we've suspected now for quite a while. The task was already pretty large to unveil all of this on April 2nd. Maybe you will see all of this unveiled on April 2nd, but to actually see the policies implemented may take months and months after that, which is something, Anne-Marie, you've indicated time and time again over the past few weeks.
Especially if we don't know exactly how they are going to enact these tariffs, meaning if it's IEEPA, Donald Trump can do it day one. That's a national security lever. But if it's 232, 301, they will need to have more of weeks or months to get public comment. What I think is very interesting is this week, Jameson Greer, according to Jenny Leonard, is getting on the phone with his Chinese counterpart. You see a lot of conversations taking place in the lead up to this Liberation Day.
The conversations, though, have different themes. You know, are they about fentanyl? Are they about immigration? Are they about trade imbalances? Are they about something else that really doesn't have to do with anything above? So these are the reasons why it's difficult. When you talk about the Dirty 15, we're talking China, European Union, Mexico, Vietnam, Taiwan, and Japan. So, you know, just that, just those.
It's quite a phrase, isn't it? The Dirty 15.
Yeah, it's not a small little group either.
It's pretty ugly stuff. Coming up on the programme, Frank Aquila of Sullivan and Cromwell as the FCC threatens to block M&A for companies with DEI. That conversation up next.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
Go.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
So a little bit of hope this morning, informed by a lot of reporting. Equity futures positive by 1% on the S&P 500. The hope, informed by our reporting, is that maybe the barrage of tariffs for next week you all feared might be more targeted than expected. That's unlocking some gains across the board this morning.
Yeah, talking about not necessarily on sector specifics, but more broadly on the ones, the companies, the countries that have the biggest trade imbalance. We keep talking about the so-called Dirty 15. Treasury Secretary Scott Bessent put it that way last week. A real question mark about what the Dirty 15 really is and how high the bar is, considering that they are our major trading partners. So it remains to be seen exactly how narrow these are.
Some of the biggest economies on a planet.
Exactly.
Still very, very important. Let's turn to the bond market. So equities just about squeezing out a week of gains on the S&P 500 and snapping that 4-week slide. In the bond market, yields at the front end now pretty much capped. The belief that Chairman Powell is going to go one way or the other, hold or cut. The 2-year 397.74, yields higher this morning by 3 basis points. Just locked in there, Lisa, around 4.
Last week, after Fed Chair Powell's comments, a lot of people just said this is a Fed chair who is more biased to cut than to remain on hold, because he does seem to be emphasizing the weakening in growth from inflation that he says is transitory. The bringing back of the T word was important. Right now, we're expecting almost 3 rate cuts for the remainder of this year. That is how much it's gotten up to in market expectations.
Let's turn to foreign exchange. Lisa mentioned FX just moments ago on this program. Euro dollar at the moment shaping up as follows. Positive on the session by 1/3 to 108.51. Mike Wilson of Morgan Stanley, the note that Lisa pointed to. Relative performance versus international developed equities can swing back in favor of the United States. A weaker dollar should offer a tailwind for U.S. revisions.
Because it makes their exports more valuable and more profitable as well. This is an argument people were making on the flip side, that first quarter earnings were likely not to be as good because the dollar had gotten so strong. So you can imagine, if you reverse it on its head, how much that could actually give a tailwind at a time where people are saying that the decline in the S&P 500 in tandem with the weakening in the dollar is some sort of recipe for the end of U.S. exceptionalism. Some people are using it as a contrarian indicator.
The dollar weaker again this morning, the euro stronger. On our radar this morning, President Donald Trump's next round of tariffs on April 2nd, shaping up to be more targeted than expected. Sources telling Bloomberg Trump is set to exclude some countries from widespread reciprocal tariffs.
So potentially this is more bark than bite. What I would caution is there's over 100 countries, and Jenny Leonard was talking to me about this, and she's one of the greatest trade reporters we have in Washington. But Trump really cares about the dozen that have massive deficits with the United States. The question we need to be asking ourselves is those 10 or 12. Does this mean that he's going to bring down that, he's not going to go as hard at them and bring down the reciprocal rate? Or is he still going to be very aggressive on those countries that really matter to him the most?
I just wonder if the cat's out of the bag in terms of getting some sort of deal with certain areas. I'm thinking about Canada and the European Union, where there's a lot of anger. And it isn't politically popular anymore to say, okay, you know what, we're going to come to the table and drop all tariffs. So I wonder how much it's going to make it difficult for there to be certain deals and, frankly, to remove some of the tariffs on the table.
Well, how many times has Howard Lutnick come on this program, the Commerce Secretary, talking about the fact that he's going to be having phone calls with his European counterpart, with the auto companies? The conversations are happening now. What gets done between here and now is still very fluid. But I would still remain, President Trump says he wants to be flexible, but he says there's no change. He's still tariff man.
Elisa, I think you hit on a really, really good point. I hope, and this is my hope, that it brings the two sides together and they can negotiate lower tariffs on both sides. That's the hope. But you're right to talk about public opinion. Public opinion has moved completely in the other direction. I'm not sure that's the centre ground in places like Canada right now. I'm not sure negotiation is what the Canadians exactly want.
It's hardening the lines and saying, actually, guys, no, we have a country and we are our own entity. I mean, to talk about the 51st state is sort of, a kick in the shins a little bit to some of the people in Canada. So, it just raises a question of how much people are going to be more entrenched, even if it makes economic sense to come to the table and eliminate tariffs.
And if the tariffs are going to hurt the United States, you've got to imagine the tariffs hurt Canada. The tariffs hurt Europe. You can't sit there in Europe and say it's only going to hurt America. If you're putting tariffs on too, it's going to hurt you as well.
So this is the interesting aspect. People have kind of ignored that over the past month and talked about European exceptionalism because there isn't a pall of uncertainty. The pall of uncertainty from the United States hangs over Europe as well.
A week away from April 2nd and so-called Liberation Day. Let's turn to foreign policy. US and Russian officials meeting in Saudi Arabia today as President Donald Trump pushes for a ceasefire in Ukraine. Ukraine's defense minister calling talks between US and Ukrainian officials yesterday, quote, productive and focused.
So yesterday, the technical teams out of the United States sat down with Ukrainians. Today, right now, they're sitting down with the Russians. They're really focused on two things, and this was already agreed upon by the leaders level, and this is basically a moratorium on strikes, on energy infrastructure, and potentially also Black Sea deal. Now, this is the easy part when you're looking at a truce, because these type of negotiations were already happening in 2022, 2023, 2024. They were, I would call, off-the-shelf deals. What is going to be hard is getting actual peace agreements on the 20% of land that's Ukrainian that has been Russian held through this war. And I have reporting from over the weekend with another group of Bloomberg reporters that they are very aggressive. This administration wants a deal by April 20th for 30-day ceasefire. That's just in a couple of weeks.
Look, we all hope that this ends up with some sort of resolution. Big question about whether Vladimir Putin will come to the table. That really is the key question at this point. My interest here, aside from that, is Saudi Arabia's role. That they are the epicenter of all of these negotiations time and time again. The sort of circle of power is shifting, and it's shifting to the Middle East.
The new Switzerland.
Yes, exactly.
It's a massive change, isn't it? We'll catch up with Norman Rule in the next hour on that story. Let's finish on this one. Snow White, missing box office forecast on its opening weekend, widely expected to bomb, and it did. Disney saying the live-action remake delivered ticket sales of $43 million in the US and Canada, lower than the estimated range of 45 to 55.
Okay, you could get into sort of the politics and some of the controversies over this movie and the casting and some of the views, political views coming out. It got a 44% on Rotten Tomatoes. Some of the reviews, I love this one. In short, hi-ho, don't go, by Pittsburgh Magazine film critic.
Brutal.
And this one from the New York Times, Manola Dargis, neither good enough to admire nor bad enough to joyfully skewer.
So, $250 million plus to make.
And I mean, what is it with these sort of remakes in human form of these classics that were lovely?
I think part of the problem is people want nostalgia of the classics. David Hand, this American animator, his son, he had passed away, worked on this. His son said that his father would be turning in their graves, the original team that worked on this. He said it's a disgrace that Disney is, quote, trying to do something new with something that was such a great success. They're making up new woke things, and I'm just not into any of that. And it seems that the viewer isn't either. And I think part of the problem you have here is businesses, potentially, there's a lot of controversy around quote-unquote woke, what they should be doing with nostalgic storylines. The issue comes that maybe viewers don't want it and just becomes too controversial. And then at the end of the day, you spend $250 million and no one's going out to watch it.
They become so worried about offending someone, they offend everyone. It's a movie nobody wants to watch. And a bigger issue right now with the Walt Disney Company, and this is a massive issue for them, this is not just sort of cultural identity politics and all of that stuff. Let Washington, D.C. have that fight. This is about business. You've spent almost $300 million on a movie, and it has absolutely bombed. And why? You come across as embarrassed by your own source material. That is not a good position for Disney to be in, and they seem to find themselves in that position time and time again.
If you are going to remake something, you can't just replace certain characters with virtual imagery because you aren't sure exactly how you want to deal with it. It is a question of dealing with source material head-on rather than simply around the edges. Oof, we'll have a virtual image instead.
I was looking at some of the movie theaters across the country, just going to various ones and going to like the 8 p.m. in Houston just to see how empty it was. No one's buying tickets for this thing.
You were going around the country?
I was doing my research on the apps last night.
You were doing sort of live mapping.
Honestly, it was absolutely shocking.
That's really interesting.
The channel checks were just not impressive at all. Let's move away from this story. We could spend a lot of time on this. Let's turn to M&A. Under the Trump administration, the U.S. Federal Communications Commission threatening to block mergers and acquisition proposals from companies that promote DEI policies. That move could impact billions of dollars worth of deals in the communications sector. Frank Aquila, the senior M&A partner at Sullivan & Cromwell, joins us now for more. Frank, welcome to the program, sir. It's not the M&A boom that we quite expected, so let's take a step back. Can you give us the 35,000-foot view? Just what is happening here and where are things going?
Well, a number of things. Well, first of all, thank you for having me on this morning. A number of things are happening. I mean, Secretary of the Treasury Bessent 2 weeks ago proclaimed MAGA does not mean make M&A great again. And I think the expectations that we all had going into this administration, really have been let down. The statement by the FCC chair, I think, indicates that their broader policy focus, is going to be reflected on M&A, and DEI is clearly something that's extraordinarily important to this administration, and the fact that they may, and I think this is still a may, bring that lens to certain transactions is reflective of that. But this is not Ronald Reagan's FTC or DOJ when it comes to merger review. This is much closer. This is a populist version of what we saw with Lena Khan in the last administration.
Frank, one of the criticisms from Lena Khan's administration was that it was inconsistent and that it went after certain companies like affordable luxury that seemed like random made-up concepts that really undermined the confidence that different corporate executives could have about what deals would be signed off on and what wouldn't. Is that something that you're seeing continue in this administration?
I think there is a hesitation on the part of senior executives and boards of directors. I don't think it's necessarily about the merger approval, because I think most of these transactions will ultimately happen, which has historically been the case. The issue is really around the broader economy at the moment. And I think that there are concerns. You were talking a minute ago about rate cuts and the weakening economy and what's going to happen with exchange rates. M&A is not going to happen where there's uncertainty, whether it's about tax rates, exchange rates, the economy. Once there's greater clarity, and I think as we get into this administration in the course of the next few months, there will be greater certainty. And my expectation is that the back half of the year will be quite busy and quite robust, because there is that certainty that is lacking to some extent at the moment.
Frank, I'd love it if you could give us a reality check, because there have been a lot of articles and a lot of histrionics about the undermining of the legal system and this question about how much that's really going to challenge some of the deals and some of the other corporate actions that take place. Do you think that that is all noise, and that essentially what we are seeing is just corporations acting logically to an uncertain economic environment, but will come around and will ultimately operate business as usual later this year?
My expectation is that it will be very much business as usual. Will certain companies de-emphasize DEI and some other policies? Absolutely. But by and large, what we're going to see is what companies do today, U.S. and non-U.S. companies. They adapt to the political and economic realities of the moment. And that's what boards and managements are paid for, is to evaluate that and look at what's in the best interest of their shareholders. How do they create the most value for their shareholders? And to me, that's ultimately business as usual. And so I certainly am seeing that and expect to see that going forward.
Frank, we're already seeing that from the likes of last week, JP Morgan. They came out and they're no longer calling it DEI. They're calling it DOI, diversity, opportunity, and inclusion. Is all of this just about companies rebranding for the Trump world?
Well, I think that, there is largely a misunderstanding maybe created by politicians that somehow DEI was discriminating against certain people or classes, people like myself, older white men. The reality is that it was just making sure that people who were underrepresented, who were talented, had opportunities. So, to some extent, it may be rebranding. I think to some extent, it's also education to the fact that, we are, that companies, law firms, investment banks, whatever, aren't discriminating, that they're in fact simply making sure that the best and the brightest have opportunities, are retained and promoted. I think that's what's been happening, and I think that will become clearer as time goes on. So it is a bit of a rebranding and a refocusing.
We appreciate your opinion on that, sir. Thanks for joining us. Frank Aquila there of Sullivan and Cromwell. I wish they'd rename it Development, Opportunity, Investment. And I wish they'd go and focus on socioeconomic status and invest in those communities and in education and get all of these massive companies just to do that. And just accept that this is going to take 10, 15, 20, 25 years to do something about, and that you can't just do it at entry-level jobs. You can't just go to a certain group of universities and say, no, we only want one kind of person from one kind of college, and this is who we're going to hire. Because how this worked in practice is not exactly how this worked in theory over the last 4 years.
There are a lot of companies who are doing that. And there are a lot of companies that have programs that go into middle schools, that go into elementary schools. I've seen it. There is just a question of how it's being messaged at a time where the previous regime had one image. This regime has another image. What are companies actually going to do to reach those goals that you laid out? And I think a lot of people would agree on.
Equities right now on the S&P 500, if you are just joining us, positive here by 1 full percentage point. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hakez. Hey, Yahara.
Hi, John. Newly elected Canadian Prime Minister Mark Carney calling for a federal snap election to be held April 28th, while giving a stark warning about President Trump, saying, quote, Donald Trump wants to break us so America can own us. Carney looking to convince Canadians he's the right person to defend the nation against U.S. aggression. Meanwhile, a U.S. delegation that includes Second Lady Usha Vance and National Security Advisor Mike Waltz will visit Greenland this week. The territory's election winner said the trip, quote, shows a lack of respect and is seen as a move to exert pressure on Greenland as President Trump ramps up his rhetoric that the U.S. should take control of the island. And the surprises kept coming during this weekend's March Madness action. Number 10 ranked Arkansas upset St. John's amid another legendary run for head coach John Calipari. Meanwhile, UConn's quest for a third straight title was denied after falling to number 1 ranked Florida. With all the surprises, there are now 0 perfect brackets remaining, according to the NCAA. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on in the program. Up next, navigating a regime change.
The Fed, like so many others, are navigating a regime change. Communicate in a way that convinces people that you will have the possibility of rate cuts, not because inflation is coming down, the so-called good news cuts, but because growth is problematic, bad news cuts.
That conversation up next with Michael Dowda of Roth MKM Partners. Live from New York City, this is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Equities on the S&P firmer here by a little more than 1 full percentage point, bouncing back. The hope that we can avoid a barrage of tariffs next week, informed by our reporting, suggesting that maybe that effort on April 2nd will be more targeted. Bond yields are higher by 4 basis points. The 10-year still around 430 at 428.64. Under surveillance this morning, navigating a regime change.
The Fed, like so many others, are navigating a regime change. Communicate in a way that convinces people that you will have the possibility of rate cuts, not because inflation is coming down, the so-called good news cuts, but because growth is problematic, bad news cuts. Do so without fueling inflation expectations, which already are pretty worrisome. So that is what they need to do.
So here's the latest this morning. Investors preparing for a total shift in global trade. The next round of Trump's tariffs are planned for April 2nd, with Wall Street lowering expectations for U.S. growth. Michael Dada of MKM writing the following. If trade war leads to the end of the business cycle, cyclical sectors will fall hard. However, we feel more comfortable buying these groups on weakness if one can adhere to multi-year timeframes. Michael joins us now for more. Michael, welcome to the program, sir. Let's just sort of back up and get an understanding of where you think we are in this cycle. The soft data has rolled over aggressively. The survey data looks weaker. Is it inevitable from your standpoint that the hard data will come next, or do you think that's avoidable?
Hi, John. Thanks for having me on. That's really the risk here, right? We've seen a really large and pronounced pullback in both business and consumer confidence. Obviously, we know there's not a direct read-through from those sentiment measures into the real economy, but the risks obviously have gone up here in terms of growth slowing, or the business cycle potentially coming to an end. And markets reflect that with the 10% correction that we've seen so far this year. I think we need to be a little careful here. I would not just be buying the whole index here simply because we had a 10% correction. The investment sentiment surveys have crashed. Usually that's a bullish contrary indicator, but S&P 500 valuations as a whole still remain elevated, more than 20 times forward estimates, and those estimates by our analysis are probably 8 to 10% too high here. So I think you got to pick your spots.
But Michael, that's exactly where I wanted to go. The idea that sentiment surveys have been so bearish that typically is a sign to buy, and why you don't think that is necessarily a buying signal today. I just wonder what you would have to see in the economic data to give you confidence one way or another, because a lot of people are saying don't pay any attention to the hard data because it's lagging so far behind some of the quickly moving soft data.
Yeah, that's really the critical question. And even these February releases that we're going to get this week, they're important, but maybe a little bit stale. So unfortunately, I think we're going to have to see a few more months of data to see if this uncertainty, which is really ratcheted up dramatically, starting to chip away at the real economy. Two things to focus on, I think, would be critical labor market indicators. Obviously, layoffs have stayed fairly low and stable here. First-time jobless claims are only about 10% above where they were right before COVID crashed the economy. So that's still a pretty good level. If that starts to shoot up, I think that's going to really dent confidence in the soft landing continuing. And we're seeing some cracks in the high yield market. Obviously, the spreads are still very, very low, but they've been moving higher. So I'd watch those two really carefully as we move forward.
Mike, just quickly, one thing that Jason Furman commented on over the weekend, who is former chief economic advisor to President Obama, he said, everyone always overstates how much presidents matter for the economy. Is what we're seeing in terms of the weakness what was already in the economy heading into this year?
Well, I think in terms of the hard data, for sure, definitely not in terms of these confidence measures. And I think those are certainly responding to the headlines. And I think that comment is correct. I mean, typically presidents don't have that much sway. I mean, obviously you have to work legislation through Congress. In this case, because you have so much of the policy changes on tariffs taking place through executive orders, I think it is a little bit different. And we can certainly see that in the behavior of financial markets, confidence surveys. Bloomberg has a really nice uncertainty index, which is ramped up dramatically. So, this is imparting risks to the soft landing. It looked like the Fed really low probability event, but had nailed the soft landing in this trade war. I think puts the Fed in a very difficult position and certainly increases risks to the outlook.
Hey, Mike, appreciate your time. As always, sir. Michael Dowda there of Roth MKM Partners on the latest. On that survey data, another few reads of consumer confidence later on this week at a time where Chairman Powell seems to have poured some cold water over recent reads.
Over the University of Michigan survey, simply because it's unreliable, it's just a couple people. He wasn't saying that back in 2022, but how much do these sentiment surveys keep on taking a sort of disproportionate amount of market interest?
Changed his mind on you, Mitch, right?
I think so.
Yeah,
I think
pretty
he doesn't
quickly.
Really care
yeah.
At all.
Okay.
Until he does.
Until he does. Precisely. It's so annoying, isn't it?
And then it'll be the key metric again.
Up next on the programme, Deepak Puri of Deutsche Bank, Henry Trace of Vader Partners, Norman Rule of CSIS, and Sharon Miller of Bank of America. From New York, the second hour of Bloomberg Surveillance. Up next.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
From the beating heart of global finance, economics, and politics, and wherever news
newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
The next couple of months is going to be a really rocky road.
We are at an unprecedented level of uncertainty.
Gold is a perfect manifestation of policy uncertainty.
The uncertainty effects are much worse this time than they were in 2019.
It's almost impossible for me to say, we've seen the bottom, we can break out of this trading range, and it's time for us to add.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equities near session highs. Your scores look like this. On the S&P 500, higher here by more than 1 full percentage point. On the NASDAQ 100, bouncing back as well. On the NASDAQ, up by 1.3. The hope, informed by our reporting here at Bloomberg, is that we can avoid a barrage of tariffs next week and that maybe April 2nd, so-called Liberation Day, will be a targeted day.
And so this is enough to release a little bit of that sigh that people have. What this shows to me is, A, there are still people lined up to buy U.S. equities. At the any sign of good news, even if it is just noise right now, and we're not getting a lot of details. And B, there is a structural change where suddenly people are saying, has the tantrum of is the end of American exceptionalism here over, and are we going back to, wait a second, there might still be value here.
So next week might be Liberation Light. The only thing I will caution is Donald Trump cares about the 10 to 15 countries, as Scott Bessent called them, the dirty 15. We don't know how harsh they're going to be on those 10 or 15 and the retaliatory measures those countries may take and the domino effects that may have on global trade.
We're only one headline away, one Truth Social post away from this market getting completely whipsawed the other way. We're at the mercy of the thinking of one individual, and that one individual can change their mind. And we said this earlier on this morning. This is a snapshot of where the administration might be right now. But things are very fluid and can change between now and a week away.
Which is the reason why I asked the question last hour, who is behind some of these headlines? Is it sort of the economic wing of the White House advisors who are saying, okay, we need to address some of the weakness and some of the calls that we're getting from some of the corporate executives? That, to me, is a real question.
Big week of economic data coming up. Consumer confidence later this week. We'll get 2 reads of that. The survey data has been really soft. It's been weak, Lisa, let's put it that way. Will the hard data follow? How much weight will this market put on? Another read of consumer confidence that reads absolutely dreadfully in the ways that they have done over the past few months.
Deutsche Bank saying that we're likely to see more of the same this week, in that hard data are unlikely to yet reflect the same degree of weakness as the sentiment data. And that, I think, is what a lot of people are counting on.
I go to the C-suite. This is what Mohamed El-Arian told us when we saw the spiral when it comes to inflation on the way up. What is happening now with consumers? What is Nike telling us? What is Target telling us? What is Dick's Sporting Goods telling us? What are the airlines telling us? They're taking a bit of a pause, and they're not going out and spending as much.
It's a wait-and-see economy. Wait and see. We'll see what happens. Coming up in the next 60 minutes or something, the next hour, we'll catch up with Deepak Puri of Deutsche Bank, with stocks pushing higher. Henrietta Trey's of Aveda Partners as Democrats muddle through an identity crisis, and Sharon Miller of Bank of America on why small business uncertainty is on the rise. We begin this hour with stocks higher on reports of a more measured tariff rollout than expected. Deepak Puri and the team over at Deutsche Bank writing, we believe that the U.S. equity market could move higher in a 3 steps forward, 2 steps back pattern this year. After the recent setback, we scaled back our S&P 500 target to 6,300, still implying double-digit upside from here. Deepak joins us now for more. Deepak, good morning. Good to see you.
Good morning. Nice to see you.
Liberation Day. What are the team expecting April 2nd?
Well, you know,
I think you need to establish the base cost of trade and tariff on the economy. And what I mean by that is, what is the impact on slower growth and higher inflation from the trade and tariffs? And I think the Liberation Day might give us some insight in terms to what that cost is going to be. As you said, I don't think it's going to be concrete. I think it's a moving target. I think it's a fluid story. So you really can't make too much out of it. But I think it is a pivotal moment in this first 6 months of the Trump administration.
Typically, it might be considered as a day where we can move by peak uncertainty. Move past it, that after April 2nd, it can't get a whole lot worse than this. Stocks start to move higher. Pitashev Academy and others have made the point over the last week or so that perhaps that's the moment we actually get the certainty and realize the economic consequences of it. And the rally that you've seen abroad, in Europe, in China, tells you that the moves we've seen in equity markets haven't really been about tariffs. They've been about other things. How much weight would you put on that argument going into next week?
Well, there is some credence to that. I think overseas, the markets have really been going up for a whole host of reasons. And I think the overseas markets are screaming in terms of pay attention, U.S. investors, to us, because we've had such a strong home bias over the last decade or so. Having said that, I think trade and tariff cannot be taken lightly, just because it has a very amplified impact to the real economy. And it might take a while for us to get grasp of that. So I don't think April 2nd means that it's a shelf life and there's a time point where after that everything is hunky-dory. I think it might take a while for us to really get a sense of what the impact is going to be.
What do you make of Mike Wilson's argument that actually some of the damage that we've seen to the dollar will help U.S. companies boost their earnings at a time where it's been sort of a headwind over the first quarter?
Yeah, I mean, it could and it should. Potentially weakening dollar, given that the S&P has 40% of its revenue coming from the overseas market, the translation effect should help. But then you also have the trade and tariffs, the impact, which in our mind can easily subtract another 1 to 2% from the earnings. And actually, when we revised lower our target from 65 to 6,300, one of the main reasons was the earnings for this year and next. So we revised lower from 275 to 270, and then from 303 to 295 for next year. So I think it plays both ways, Lisa. The other thing that we haven't really seen yet, which I think might be positive maybe in the second half of the year, with the deregulation story. That we haven't seen too much of, so I think that could also have a positive impact on M&A, on animal spirits, which would help the overall complex.
How much do you see this as a zero-sum game, where there's a ball of money and it's shifting from place to place, and it had been in the United States with exceptionalism. Now it's shifting to Europe and to China with the promise of fiscal stimulus and possible reform. Do you see it that way, that it's sort of one or the other at the expense of the other?
Not really. I think you can have, stimulative measures. I think what the market, especially the service, BOA survey that's just came out, is suggesting that you're seeing a lot of inflows into European equities. Actually, they're at the fastest pace since 1999. So that tells me it is really the changes in the fiscal policy, the monetary policy, that's really making investors take notice of Europe, of Germany, and putting money in. China is going through its own host of policy action that's been really positive. I think I wouldn't really make it a point that it's because of the lack of U.S. exceptionalism. I think it's just that the other countries have started to get their act together.
At what point is this idea that everyone's exceptional because everyone's spending money challenged by the fact that someone's got to pay for it? And at a certain point, you have to imagine if this does continue, bond yields are going to respond. Do they hamper that?
Indeed, and I think that's where you want to be very closely focused on what the rates market is telling you. The fiscal, capacity that a country like Germany has is completely different to where we are in the States, right? So Germany hasn't had this kind of fiscal stimulus that they are planning for. Unheard of, right? You're looking at close to €1 trillion, so 500 billion of the infrastructure fund, which includes decarbonization and infrastructure, then defense spending, which might be another 400 billion euros. So you're looking at a $4.3 trillion economy that might have €1 trillion of input over the last 10, 12 years. From our estimate, that's going to increase their GDP on an annual basis by around 1.5%. That is quite meaningful. I don't think at this stage in the U.S. we can afford that. We have just had a, post-pandemic, a byproduct of all that stimulus in case of with unintended consequences. I don't think we can go that route. So I think there are certain countries that have a much bigger capacity for fiscal change, and you're seeing that happen, which I think is positive for global investment. The other thing I would say is there is a rate-cutting cycle globally. ECB at 2.5 deposit rate, inflation at 2.3%. It's only slightly restrictive, compared to where the U.S. monetary policy is. You look at the 4.5% upper range bound Fed funds rate and our inflation rate. We are much more restrictive in a way. So both monetary and fiscal policies making, European countries, especially Germany, take notice.
Do you think there's still more upside when it comes to, say, German equities?
I would say a little bit more, but a lot of the easy money, quote unquote, has been made. When you look at when it started ever since over the last 3 months, you've seen the multiple for Eurostoxx 50 and both for DAX gone up 2 percentage points. So 15 times earning to 17 times earning. Historically, there's always been a discount vis-a-vis U.S. equity markets, around 20%. Right now, that discount is 30%, and it's coming from, 35, 40%. So I think the underperformance gap has been reduced, but I wouldn't be surprised that this continues for a while before you really start seeing a catalyst for U.S. equities to start bridging that gap.
You might have to look through some pretty weak economic data out of Europe in the meantime, anticipating a bounce back in German growth at some point in the 26, 27 kind of time frame. In 2025, when the tariffs really start to hit, Europe's going to feel it. China's going to feel it, without a doubt.
And it's going to feel it on top of an economy that already wasn't very strong. But people seem to have been discounting that effect because they've been blinded maybe by some of the fiscal promises and currently a little bit better than expected data that's been coming out of the region.
Deepak, appreciate your time as always, sir. Lots to talk about right now and think about. Deepak Puri there of Deutsche Bank. With an update on stories elsewhere this morning, let's cross over to Yahara Hackers with your Bloomberg Brief. Hey, Yahara.
Hi, John. President Donald Trump's incoming wave of tariffs is poised to be more targeted than originally expected. Sources telling us here at Bloomberg the president's upcoming Liberation Day tariff announcement set for April 2nd is set to exclude some countries from widespread reciprocal tariffs. U.S. and Russian officials are meeting in Saudi Arabia for closed-door talks. This follows discussions between American and Ukrainian teams the previous day, which Ukraine called productive and focused. The talks aim to achieve a ceasefire in the war and, according to officials, may lead to discussions on the line of control and permanent peace. And on Sunday, Pope Francis made his first public appearances since being hospitalized more than a month ago. The pontiff was discharged from Rome's Gemelli Hospital and returned to the Vatican after thanking crowds that gathered outside to see him. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, the fractured Democratic Party.
Look, I'm not stepping down. I knew when I cast my vote against against the government shutdown that there'd be a lot of controversy. I did this out of conviction. Our caucus is united in fighting Donald Trump.
That conversation up next with Henrietta Trays of Veda Partners, live from New York City this morning. Good morning.
Middle
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Equity futures positive here. Session highs up by 1.2% on the S&P 500. On the Nasdaq 100 up by 1.4%. The hope, and I stress the hope because things can change, it's informed by our reporting here at Bloomberg that maybe we can avoid a barrage of tariffs next week and perhaps things are more targeted, according to people familiar with the matter, as these tariffs come together on April 2nd.
What's interesting to me is that the NASDAQ 100 is leading after falling, actually underperforming the rest of the complex for a number of weeks now. Does this mean that people feel a sigh of relief? If it's less than expected, we can go back to the U.S., that the tech sector won't be as sort of affected or retaliated against, considering that the dirty 15 still include China and the European Union?
Let's go back to Michael Harnett of Bank of America. Let's sit on that quote from him. DeepSeek and Doge have been a much bigger Wall Street driver than tariffs in Q1, but April 2nd is now infecting the global data. China and Germany, stocks there up 20% or so since the US election, and a monster equity amount of inflows, say no one really believes that the trade war equals a recession and a bear market. Have we really been trading on these trade tariffs? That's been the discussion throughout the weekend in the notes that I've been reading going into next week.
And a lot of people say not really, because if you were just trading on tariffs, the reaction in markets would be slightly different. There are pockets of it. But if people really were looking at that, why is it such the opposite of the trade last year when the rest of the U.S. was supposed to catch a cold when the U.S. sneezed? Suddenly that was not part of the equation.
Futures right now up 1.2% on the S&P, up 1.4% on the Nasdaq. Under surveillance this morning, the fractured Democratic Party.
Look, I'm not stepping down. I knew when I cast my vote against against the government shutdown that there'd be a lot of controversy. I did this out of conviction. And look, in my caucus, we have a disagreement as to, some people voted one way, some people voted the other. But we've all agreed to respect each other. Our caucus is united in fighting Donald Trump.
So here's the latest this morning. Democrats calling for Senate Minority Leader Chuck Schumer to step down after he voted for the GOP spending bill. This is Senator Bernie Sanders and Progressive Representative Alexandria Ocasio-Cortez drew tens of thousands for their Fighting Oligarchy tour. Polling showing the party with a historically low approval rating. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, welcome to the program. Just where does Schumer stand now?
Well, John, Schumer's remaining defiant amid these growing calls for his removal and the stark criticism that's coming as it appears that Democrats are divided over how exactly to counter President Trump's agenda. Take, for example, the government shutdown vote, which is leading to all of this criticism. Schumer aides at the time told us they knew this was a lose-lose situation because on one hand, they wanted to negotiate those firmer spending guardrails with the White House, but they knew that they could be blamed for a government shutdown amid so much economic uncertainty, particularly when it comes to our federal workers. And we have to keep in mind that President Trump up to this point has enacted much of his agenda unilaterally, and congressional Republicans have set up the next big agenda item, the fiscal agenda, those tax cuts, to be passed through reconciliation, which means that they only need a simple majority, so Democrats aren't going to really have the chance to engage much when it comes to those negotiations. We should put into perspective, Chuck Schumer's not up for re-election until 2028, and at the moment there's no Democrat openly vying for his top leadership post, and that would really need to happen before we have serious conversations about a potential change in leadership at the top of the party. But we should just note that there is going to be a heightened focus on the midterms as we see grassroots groups start to put out that they are going to challenge Democratic incumbents with progressive challengers. But John, it's going to be a tricky math game here, and Democrats are going to have to tread carefully in some respects because, for example, in the House, there are currently 13 Democrats that represent districts that President Trump won. They're going to have to thread the needle in areas like that, considering there are such slim majorities.
Tyler, let's talk about the math. 2 weeks ago, NBC polled just over a quarter of registered voters, 27%, say they have a positive view of the party, the Democratic Party. Just 7% say those views are, quote, very positive. How much work do they need to do to close this gap?
Well, at this point, it's appeared that Democrats have sort of struggled with exactly how they want to counter the Trump agenda. First, we heard that it was going to be against President Trump's policies, but then we started to hear it shifting towards Elon Musk and those Doge efforts. At this point, we're starting to see Democrats, particularly Senate Democrats, go home to their home districts and hold those town halls, listening to constituents about exactly how they would like to see this move forward. And we have to keep in mind that President Trump won, particularly when it came to his economic plan. And we're starting to hear that rhetoric be folded into the tariffs, these heightened talks about recessions and what it could mean for inflationary concerns. Perhaps that is a part that we've heard some Democrats tell us that they are looking to capitalize on. But up until this point, they are really trying to coalesce around a broader message that can counter President Trump and his agenda.
Tyler Kendall with the latest from Washington, D.C. Tyler, thank you. If you are just joining us, equity market session highs on the S&P 500 kicked off by our reporting over the weekend that maybe we can avoid a barrage of tariffs next week, and that perhaps, according to people familiar with the matter, the effort on April 2nd from the President of the United States in this White House might be a whole lot more targeted. Henrietta Trays of Veda Partners joins us now for more. Henrietta, welcome to the program. I'm sure you read our reporting over the weekend. I'd love your opinion on what you made of it and what you're now expecting for next week.
Well, I mean, amazing reporting as always. Obviously, your trade teams are incredible. But I think that the targeted tariff idea is a classic walkback we've seen repeatedly from the Trump administration. It has been our base case that the universal tariff is not realistic and would never come into pass. That has been our position since President Trump rolled it out on the campaign trail. So it's not surprising that certain countries are carved out entirely. I think other product lines are going to be carved out. For example, we already have the lower tariff rates on energy and potash. What I'm watching for at this point is to see which countries are targeted with a more insidious, long-term looking tariff from something like a Section 301 investigation. In particular, I'd point out India as a nation that could be seeing its own Section 301 investigation. We know USTR Greer has been very focused on that country in the past, and that's something that really concerns me, along with the pharmaceutical industry, critical minerals. Once those tariffs come on, they do not come off, as we've seen.
Henrietta, the market might be breathing a sigh of relief because the scope, the net the administration is casting might not be as wide. But when it comes to the actual tariffs and what they would call repeat offenders when it comes to those trade imbalances, might be quite harsh.
Yeah, absolutely. I mean, I don't think it's really understood yet how insidious these tariffs are. Last week in D.C., I met with the trade associations for seed, for example. Their products cross the border 8 or 9 times from all over the globe, whether it's EU or China or Mexico, and they're not even a finished product yet. So before you even get your tomato at the grocery store, the seed that it's grown by has already crossed the borders 8 or 9 times. I mean, these stories are going to start to come out as the tariffs go into effect, and the economic feedback of that multiple round tariff and the complete lack of clarity from the Trump administration about what is and is not, USMCA compliant or subject to Section 301 tariffs. What's in List 4B? Where are those tariffs? None of that is clarified, and I think that lead is going to be months to years in the making.
Are there going to be any tariffs next week that come in on day one, say if Trump decides to use IEEPA?
Yes, absolutely. I very much expect for April 2nd to need to pack at least a little bit of a punch. I think particularly exposed to the EU auto manufacturers. We know that the president has had a very serious issue with them for years now. I thought, and I think everybody should remember how serious the risk of those tariffs were in his first term. So I'm expecting those to be ready to go on April 2nd, just as an example.
Henrietta, there are ongoing hearings with USTR from a number of different trade partners to try to understand the economic scope of some of the proposals, as you were mentioning. The latest 2-day hearing in Washington that's beginning today has to do with ships and ships built in China getting taxed in some capacity, or there to be mandates that some of goods shipped around need to be shipped on U.S. ships in order to avoid certain tariffs. A lot of people point to the fact that this is just infeasible given the number of U.S. ships. What are you expecting to learn economically from some of these hearings that we have underway?
Well, most importantly, I want to see which states come out in support of this, because there's going to be domestic shipbuilding that happens in the United States, and you want to watch what states those are in, which districts, where the ports are, who's going to be collecting the revenue or fees, or who stands to gain from those tariffs. Because I think that's underscoring another reality of this administration, which is that federal spending is about to explode. Whether it's the tax bill that's going to be $5 trillion, exclusively deficit financed, if the Republicans meeting with the parliamentarian this week goes their way. And we are seeing additional spending on defense, immigration, and of course shipbuilding, as you point out, to the tune of $342 billion in the current Senate budget. So there's a lot more spend to come.
Henrietta, as we look to next week, it does seem that the scope is not going to be at large, and we're not going to have the sectoral tariffs. But at some point, will we have those sectoral tariffs, say autos, say pharmaceuticals, that were supposed to be paired with this reciprocity on April 2nd?
Yeah, great question. What I would look at is any Section 232 investigation. So those are sector specific. The steel and aluminum tariffs, for example, are Section 232. We know that the president has the same kind of agenda on things like copper, uranium, lumber, dairy, all kinds of different components that target individual nations to a more extreme account. So watch for the investigation, because as I pointed out with 301, those may take 6 months to complete and hold comment period sessions and all those kinds of things. But once they go on, they do not come off. So the China tariffs under 301 have been in effect for 7 years now and rising. Another piece I think will happen is that we'll say that China is in violation of the Phase 1 trade agreement. They have not committed to they have not followed through on their commitment to buy $80 billion worth of goods from us in 2020 or 2021. Indeed, they were below 2017 levels per the latest Peterson Institute economic review. There's a lot that can change, even if some of these pieces are walked back, which they're just not ready to go on. I would align myself with your previous guest, which is to say there's just going to be a lot more here. April 2nd is not the beginning and the end. It's the beginning, and there's a long way to go before the end.
That's not going to be music to the ears of equity market bulls this morning. Henrietta, thank you. Henrietta Trace there of Vader Partners. This could go on and on and on based on those comments at the end.
Start of a conversation with a lot of these countries. Potentially, we are still going to be in negotiating mode this week as well as after April 2nd. So this could go on for weeks, and this can go on for months. And as we've been saying on this program a number of times, uncertainty is a feature, not a bug, of the Trump administration.
At the moment, some relief. Equity futures near session highs, up by more than 1 full percentage point on the S&P 500. Later on this week, another read on consumer confidence. You'll get 2 reads on that through the week, climaxing with you, Mitch, consumer sentiment at the end of the week. Just how awful are things for consumers right now? Based on the sentiment surveys, pretty dreadful, but you're not seeing it in the hard data just yet.
So can you dismiss it? And that's been an ongoing conversation a lot of people will continue to have.
Up next on the program, Bloomberg's Trade Trudeau on the auto sector, with BYD set to report earnings in China. From New York, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equity session highs up by 1.2% on the S&P 500, on the Nasdaq up by 1.4, 2 hours away from the opening bow with some morning movers. Here's Yahara Hackers. Hey, Yahara.
Hi, John. We start with a big mover, and that is 23andMe. It's down nearly 40% now after the genetic testing company said it has filed for Chapter 11 bankruptcy protection. Plus, it also said its co-founder and CEO and one of the biggest names in tech, Ann Buchitsky, has resigned. Next up, we have AZEK. That is an American home decking company. It's up nearly 20% on some M&A action. James Hardie, which sells building materials, has agreed to buy AZEK for $8.75 billion. But the CEO of James Hardie was actually forced to defend the deal after its shares plunged in Sydney trading because of concerns that there's just too much uncertainty to place a big bet like this on the U.S. But he says he's focused on the long-term opportunity and not the immediate risks he says are posed by this administration. And last up, we have Super Microcomputers. It's now up just slightly after Goldman Sachs just downgraded the stock to sell. They say the competition in AI servers is only intensifying and that Supermicro's competitors have done a better job capitalizing on the opportunity. So for that reason, they think Supermicrocomputers' market share leadership will decline. But the stock is up nearly 40% year to date, so something to keep in mind. John?
Yahara, thank you. Appreciate it. More from Yahara through the hour. On our radar this morning, Canadian Prime Minister Mark Carney calling for a federal snap election on April 28th, describing the vote as consequential and saying, quote, Donald Trump wants to break us so America can own us.
So can you make a deal with some sort of a feeling that seems to be galvanizing his party? I will just say it is a good time for him to call a snap election, considering how much sentiment has shifted away from the Conservatives toward the Liberal wing in Canada, and that seems to be what he's doing. Suddenly, he has a real chance and a likelihood of winning this election.
In January, the Conservatives had a 20-point lead that, whether it's through the rhetoric, through it's the tariffs, that have really brought the Liberal Party together and more of Canadian constituents backing the Liberal Party. So now he has a better shot because of the Republican in the United States, Donald Trump.
The former Prime Minister Trudeau, tremendously unpopular at the same time. So I think him getting out of the way, there's a relief rally for the party if the party was a stock. But I'm totally with you. We brought this up with Ambassador McMillan in the last week or so. It's kind of surprising to me, and it just works against what this administration here in the United States wanted to work towards too. You would have thought that a Prime Minister Poilievre alongside a President Donald Trump could have created a North American powerhouse with energy and energy abundance at the epicenter of it, and now they're going to have someone that's probably not willing to work with them. Based on the polling at the moment, things are a lot tighter than they could have been.
This goes to the ultimate question of what was the intent here? Was there some sort of collective intent to create something like a trade union, like what Nouriel Roubini was talking about with Mexico and Canada?
What we had talked with Ambassador McMullen about is this idea of potentially conservatives in both countries, and this is what the Alberta Premier had said to Breitbart, that she was trying to get the administration administration to pause the tone, pause the rhetoric, pause the actions on tariffs to potentially help the conservatives get into power. And actually, it's backfired.
And not everyone can do what Germany is doing. And what I mean specifically by that is the amount of fiscal easing you're about to see in Germany. They have the willingness to do it. They have the ability to do it. I'm not sure Canada and Prime Minister Carney can make the same bet. That's the problem Canada's got right now. This tit for tat doesn't serve them well either. And what you could see in the economic data in the months to come in places like Canada could be absolutely dreadful. And we got a taster of that in the last week.
With the economic sentiment among small businesses in Canada is absolutely plummeting. And it speaks to this question of how quickly is this going to trickle out where other economies other than the U.S. feel it even more than what's happening in the United States of America.
Let's take it back down to Washington, D.C. Senator Chuck Schumer saying he won't step down even as fellow Democrats turn up the heat. Schumer facing backlash after voting for a recent GOP-led funding bill that averted a government shutdown.
And when you look at Polymarket, will Schumer remain minority leader through 2025? Overwhelmingly, 77% say that's the chance he will remain. But I will say this, tons of rumors and chatters that when he's up for re-election in 2028, potentially Congresswoman Alexandria Ocasio-Cortez could be eyeing his seat. It annoyed Bernie Sanders so much over the weekend that when he was sitting down with ABC and was asked about this, he got up and he said, I'm not doing nonsense. I want to talk about real issues. But this is something that is definitely percolating in the Beltway and potentially in New York.
It highlights a schism that's happening right now in the Democratic Party that is going to be an ongoing issue, especially ahead of any further election. Who has the gravity of power? Does it end up with sort of more centrist Democrats that have been in Congress for a while? Or will it be the AOCs of the world? And you saw that with rallies over the weekend, and you saw that with Chuck Schumer saying, look, we just didn't have the leverage. And there isn't necessarily the ability for us to do this, and this is my job, I take the fall. This is going to be a schism that they're going to have to reconcile before the next election.
Agree or disagree with the economic policy proposals coming out of the oligarchy tour? Agree or disagree? Why are they popular? They're popular, I think, because they're focusing on economic policy. They're not focusing on identity politics, which is something the Democrats have really struggled with now for a number of years.
Bernie Sanders constantly talks about economic policy. He said, though, I'm in my 80s. I'm tired. I'm a senator from Vermont. But he's drawing crowds of people because he's talking about economic issues, which he has always talked about.
Bernie Sanders filling some big stadiums. Let's turn to this story. A U.S. delegation led by Second Lady Usha Vance is heading to Greenland later this week as President Trump continues to discuss purchasing the nation. White House National Security Advisor Mike Waltz and Energy Secretary Chris Wright also part of the group.
So when it comes to the Second Lady, she's going to, I think, also be going to a dog sledding event. So many people are looking at that and they're like, okay, we can get on board with that. I'm talking about individuals in Europe. But then you hear that the National Security Advisor, Mr. Waltz, is going. And then also Chris Wright, the Energy Secretary. And you think, wow, maybe there's actually more movement behind Donald Trump's rhetoric about wanting to acquire Greenland. The sense I got from Mark Rutte 2 weeks ago in Washington, D.C., the NATO Secretary General, was that he's not envisioning a future where he needs to get involved in two NATO countries going back and forth to each other. But clearly the U.S. sees this as strategic, and they're going to be making more trips there.
Style versus substance. I think we can critique style all you like, because this is kind of bizarre, right? This has come from nowhere for many people. Substance really has refocused the minds on the geostrategic importance of that part of the world. This is coming up in conversations now in many ways where it really wasn't in the last several years and perhaps should have been.
This is true. My question is, and I was trying to figure this out over the weekend, what could the U.S. do if it, let's say, owned Greenland that it can't do now? Because it has a lot of sort of power over that region with respect to a base, an army base there, as well as the right to engage from there. So there just raises a question, what would be gained by taking it over?
I did ask someone this. Whatever you have in mind, the administration, but what you want to do with Greenland, why can you not do it within the framework of NATO? And they said, well, that's bureaucratic and it'll take years. So I think for them, it's about speed.
Got some earnings to talk about as well. Those numbers just dropped in just moments ago. BYD reporting after announcing new cars and chargers that power up in just 5 minutes. Bloomberg's Craig Trudell joins us now for more. Craig, at first look, it looks like an upside surprise. What do you see and what were we expecting from this company?
Yeah, I think what we're seeing from the company is a beat both at the top line and the bottom line. And as you alluded to, I mean, this is a company that not only is coming off a really incredible year, but is adding to the momentum with real, tangible progress on product and innovation. Maybe of the sort you would have expected to see from a company like Tesla years ago. You're seeing that from the Chinese now, and I think, with BYD's announcement last week of 400 kilometers worth of charge in 5 minutes, with Xiaomi really gaining momentum in China, and they're out today with plans to raise more than $5 billion to fuel their EV expansion. You're just seeing the Chinese competition for Tesla just sort of going from strength to strength here, and we're seeing in these BYD numbers actually. Them retaking a lead over Tesla in terms of annual revenue. So just real strong numbers out of China and out of the companies that are sort of, taking the fight to Tesla in that market.
Craig, for a long time, we said the US innovates, Europe regulates, and China imitates. I'm not sure that works anymore. China has been at the cutting edge of technological advancements that we've seen announced now for the last several months. Craig, and we're seeing that again with BYD, with the developments that we've been talking about regarding the fast charging and the immense range that these vehicles could have in the future as well. I've said repeatedly, Craig, and I know you have as well, that this is the most competitive market on the planet, the auto market in China. Is Tesla getting squeezed, or can they compete there?
I think even Elon Musk would say and has said that this is the most competitive, and I think he still has articulated this belief that Tesla is still ahead of these companies, and yet that's where his competition is toughest. But when you look at what BYD has been doing the last few years and the lead that they've built in that market, the momentum that they're managing in Europe, even in spite of the tariffs, I think it is still the case that this is a manufacturer that is highly reliant on its domestic market and is having some challenges with growing overseas. But we are seeing here in Europe, BYD really continue to grow in spite of the fact that they are getting hit with higher tariffs. We've seen those tariffs really slow some of their peers, some of their Chinese compatriots, but BYD is really continuing to grow in lots of markets across Europe.
Craig, is BYD's vision a little bit more too good to be true than it is actual reality? And I ask this with respect to their promise of selling cheaper cars with chargers that can fuel up, power up cars in just 5 minutes. Are these things safe? Are these things viable on a mass production scale?
I think that's a really important sort of set of questions to raise. And, of course, we've seen over the years, automakers stage these events where, everything is sort of set up just right, and these are effectively stunts. I will say that, BYD does have a sort of track record of not necessarily getting out over its skis and over-promising and under-delivering. There's also questions, as you allude to, of is this the type of charging you want to be doing, routinely and regularly? The answer to that is probably not, but that applies to electric vehicles on the market today, that, you use these superchargers, or, BYD would refer to it as flash charging. You use them when you absolutely need to, when you're on a road trip and you don't want to, spend, 30, 40 minutes or more waiting to power back up. But for the most part, I think, EV owners are living their lives in a way where they don't necessarily have to use these quick chargers all the time. If you can charge overnight, it's better for your battery and better for the longevity of your vehicle. But there are a lot of sort of caveats and questions that we're going to have to sort of tease out just how big of a deal last week's announcement was.
Craig, it was over a decade ago, but in 2011, Elon Musk told Bloomberg Television that BYD as a company has pretty severe problems in China, and he thinks that they need to focus in on China and make sure they don't die there. Well, actually, BYD is not dying. They're thriving right now. How does Tesla respond to this?
I think, one of the things that Tesla, has really sort of dug in its heels on is this idea that, a narrow and really, small focused lineup is sort of the way to go. And I do think that you have to sort of second guess that strategy given the lead that BYD has jumped out to. how many more models BYD has to offer, how much more diversity they have in their lineup, and how much more affordability they bring to the table. You know, there are a half dozen models that you can buy from BYD that are, you know, substantial discounts to the cheapest Model 3 that you could buy in that market. And, you know, there's a real question of just how much Tesla can compete. Will they maybe stick to this in the sense that, you know, perhaps they can, you know, be more profitable or stand a chance of greater profitability by sticking to this more premium strategy? Perhaps, but that means giving up some real growth, and that, you know, is only going to sort of feed into this broader trend that we've been seeing from Tesla, which is on a global basis, this is a growth company that is no longer growing.
Hey, Craig, appreciate the update, sir. Thank you. Craig Trudell there of Bloomberg on the latest with BYD, a B on the top and bottom line from that major car manufacturer out of China.
At the same time that we've seen misses from Tesla with respect to deliveries, and particularly the performance in China, it just goes to the question that you asked, the sort of, you know, innovates, regulates, and then over in China imitates. How much are we seeing true innovation in China, like what we're seeing this morning from Ant Financial potentially, that challenges what we see in the United States in a significant way?
And an industry that benefited from massive barriers to entry over the last several years, which is an argument that some officials in this administration here in Washington might make the argument.
That if you have this idea of potentially increasing those barriers, that might be helpful to ours, or potentially could stymie some cross-pollination. Honestly, these are ongoing conversations, and I don't have an answer to them.
Force people to manufacture there, force people into joint partnerships. There was always the accusation they were taking their technology to get a foothold, and here we are, they're making advancements, and I think that's the real development out of China. We've talked about imitation for a long, long time in that country. Now they're making these technological value-added advancements in a way that you'd expect to come from the United States. They're coming from somewhere else.
And I think China has a long-term view. When it comes to the batteries, they own the entire supply chain, not just 80, 90% of the raw materials, but the processing of those raw materials to make the battery. Their long-term view, I believe, is you can't just buy our batteries anymore if you're Tesla or someone else and want, say, even a five-minute charger battery. You have to buy the car, and we will be Detroit for the world.
Geopolitically, that makes the rest of the world incredibly vulnerable as they push towards net zero and the green efforts of the last decade or so. Now, you can make a climate argument for that. Of course you can. Can you make an international relations argument for that? I think things become a little bit more dicey on that front.
So this really goes to the whole, how much, if there is a big barrier, does China sell cheap goods into the rest of the world? That much more. I will say to your discussion, though, to your point, it's a really interesting one, that if China benefited from getting some U.S. ideas by forcing them to bring factories there, is the U.S. going to miss out on getting Chinese ideas if those barriers are up in a significant way?
That's the latest on BYD. Let's get the latest on stories elsewhere. With your Bloomberg Brief, here's Yahara Hecker. Say, Yahara.
Hi, John. Israeli airstrikes killed 2 members of Hamas's acting cabinet on Sunday. The once 20-member governing body now has just 9 remaining living officials. Hamas confirmed the deaths, saying they were among hundreds of fatalities from the new Israeli military campaign that followed the roughly 3-month ceasefire that expired earlier this month. And on China, Chinese Premier Li Cheng says China is ready for shocks as the world prepares for President Donald Trump to announce more tariffs next month. He told foreign business leaders gathered in Beijing on Sunday that countries should open up markets in the face of growing economic fragmentation. And U.S. officials asked Italian egg producers if they can ship product to the U.S. amid shortages ahead of Easter and Passover. Italy's Egg Producer Association head was surprised to hear the request and, quote, thought he was on candid camera. This comes as the U.S. experiences its worst ever bird flu outbreak, hurting supply. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, a feature, not a bug.
This amount of uncertainty is not the bug of this where we are in the cycle. It is the feature of the cycle, and we just have to learn to live with it.
Up next on the program, we'll catch up with Sharon Miller of Bank of America, live from New York. This is Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Morning, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Bloomberg has the Fed decision under surveillance, with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Equity futures session highs on the S&P 500 up by 1.2%, on the Nasdaq 100 this morning. We're positive by close to 1.5. Under surveillance this morning, a feature and not a bug.
This amount of uncertainty is not a bug of this where we are in the cycle. It is the feature of the cycle, and we just have to learn to live with it. A lot of consternation about what happens on April 2nd. Indeed, April 2nd is going to be a very important day. We'll know a lot. But we also will not know a lot. It's a start. It's not the end of the resolution. It's not the end of the uncertainty.
So here's the latest this morning. The companies on the front lines of policy uncertainty. Bank of America publishing its newest small businesses checkpoint. The team writing the following. Despite continued optimism, small business uncertainty is on the rise. According to aggregated credit and debit card spending data, small businesses are slowing their card spending across the board. Sharon Miller, the president and co-head of business banking at Bank of America, joins us now for more. Sharon, good to see you.
Good to see you too. Good morning.
Let's talk about the little spots of weakness that we're starting to see emerge. Where are they and what's behind it?
Well, we are seeing weakness in manufacturing firms, especially the smaller manufacturing firms, so those with 500,000 in revenue and below. But as you look at the larger companies, we're still seeing strength there. We're seeing strength in retailers, with the exception of furniture.
Which really shows the sort of ad hoc nature of some of the threats and how different companies are responding to it. Before we dig into the specific sectors, I'm wondering the difference between big and small businesses. You said small businesses are slowing their card spending across the board. Is that the right distinction to make, small versus big?
I would say small versus medium-sized businesses. So when you think of our segment, it's anywhere from startup to 50 million in revenues. So you have small and mid-sized companies within there. But generally speaking, we're talking about $1 million and below company when we're saying smaller businesses.
What's the standout? What industry has been very strong at the moment?
Well, we are seeing strength in retailers, with the exception of furniture, but restaurant spending is strong. We are seeing strength in shopping, going out to eat, all of those types of retailers, e-commerce. So I think that there's some trends there. And so you have to see what the data is telling you, not necessarily what the consumer is telling you.
Is this a leading indicator? Are these card data tending to point to strength or weakness depending on where we are in the cycle?
Well, I think it's a wait-and-see attitude. I mean, there are things on the horizon and some dependencies that businesses are thinking about, whether it's tariffs, the political environment, taxes. How is all that going to come to life as they're thinking about CapEx for their business?
Let's sit on CapEx. How do you get a decent idea of whether those CapEx decisions are being delayed, pushed back, or just totally derailed? Which one do you think it is at the moment?
I think it's delayed. I think it's a wait-and-see attitude where you're still seeing people spending on their business, albeit not as strong as we had seen last year. So there is some wait-and-see out there because they don't know what's going to happen. And so as I'm talking to clients around the country, that's what I'm hearing as well. We do want to expand. We do want to invest in our business, but we're holding off just a bit to see what's going to happen.
Sharon, as you know, these companies have a massive role to play in employment in this country, and we're starting to focus even more on the hard data, the employment numbers that come in every week, jobless claims. Now, if you go into a wait-and-see economy, how long before you start to say, we're not going to hire, we're going to fire? Is there a lag time? Is there a typical framework timeline to think about this, or are we in no man's land?
I wouldn't say we're in no man's land. I mean, we've got to watch the data every week, every month, and what's happening in the economy. But I would say that in business formation and those that are actually putting together plans to hire businesses, we are seeing an increase in the number of new businesses opened that are talking about, I'm going to employ people. And so that is good news as you think about where we are today versus, pre-pandemic levels.
Are there significant exceptions? We were talking about sort of the ad hoc nature of who gets hurt and who doesn't. Are there areas, small pockets, where you are seeing real deterioration?
I would say we are seeing a little bit of deterioration in manufacturing, especially in those firms less than $500,000 in revenues. In furniture, that's the only retail category that we did see a decline. And so those two areas are areas that we are watching.
I find the retailer point absolutely fascinating, and I think it reinforces what Chairman Powell said just last week, that you can read too much into the sentiment survey data to look at what people are doing. And right now for him, for many, for economists too, they're looking at the hard data and it's still holding up, but there's not much to see here.
When you take surveys online, there have been studies that show that people tend to say that they feel less good. And a lot of these surveys are online. And so they all rant online. I feel terrible. Why? And then they say, oh, I'm going to go shopping. And this is sort of what has been bearing out.
Retail therapy.
Exactly, in the data.
That sounded personal, Bramo.
I'm just saying, it's always, those texts that you send to people where you're just ranting and then you're like, okay, now I'm done and I move on.
Is that how people approach you, Mitch, when it comes out on Friday?
You want my opinion on the world? Pretty much.
Sharon, it's good to see you, as always. Thanks for being with us. We appreciate the update. Sharon Miller there of Bank of America. Up next on the program, Jean Bavin of BlackRock, Dana Taussey of the Taussey Advisory Group. We'll catch up with Kathy Boshansik of Nationwide and Troy Gajewski of FS Investments. The third hour of Bloomberg Surveillance up next.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
What about
artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
At some point, we know some kind of direction where this administration is going.
Most investors we speak with are not baking in tariffs.
I don't expect that the inflation effects of the tariffs would meaningfully last beyond this year.
Each tariff is a one-time hit to a price level, but the effect on growth is probably much more long-lasting and significantly more consequential.
The projections for growth are not consistent with a pro-growth president's agenda.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now with equity futures near session highs on the S&P 500. Your scores look like this on the S&P, up by more than 1 full percentage point. On the NASDAQ 100, higher by close to 1.5. Perhaps we can avoid a barrage of tariffs next week. That's according to our reporting over the weekend here at Bloomberg, that maybe the April 2nd Liberation Day effort might be very targeted. We'll get another read on how people feel about those tariffs later this week. Consumer confidence. We look to you, Mitch, to see how people feel on Friday.
Yeah, do we? I guess that's the question, because Jay Powell sort of poo-pooed that as being a major metric, considering that it hasn't complied with some of the forward hard-looking data that we keep getting. That said, at what point will the soft data catch notice and catch stock investors to take notice? Because right now, people seem to be pricing in volatility, not necessarily any kind of economic downturn.
It's a fluid situation. And next week, ahead of April 2nd, I think we need to remember what we've heard from officials saying that they're currently in negotiation mode with some countries. And maybe the tariff barrier won't be as high if they're coming in with a deal and saying, we're going to lower our threshold if you don't come out and hit us aggressively on April 2nd. I think one caveat, maybe the scope won't be as big. But when you're looking at targeting 10 to 15 countries that have massive deficits when it comes to the United States, they can be very harsh if you're just looking at 10 to 15. What is the secondary effect, the dominoes of what this can all cause?
How many times have we seen this movie? We get one post by the president, market swings the other way. Is that how vulnerable we are again this morning? Just that one post from the president who says, no, we're going big next week on April 2nd?
To that point, I'm thinking to myself this morning, who trades on these headlines? I mean, really, how much credence can you give them if you really are betting your portfolio? And there are going to be traders that do it on the margin, but I wonder how much other things are playing into this. And you mentioned DeepSeek. And I just wonder, Ant Financial coming out and talking about new technology that could potentially also increase the efficiency of certain artificial intelligence models. Look, that is its own story, and there's a question around how believable it is, what they actually did. Again, how much are some of these other stories driving things and people attributing everything to trade?
Other things going on here. Take a peek, get a cheap ticket for Snow White, sit back for a couple of hours.
You think that's moving the market?
Meditate.
People watched it and they sold.
I'll tell you what, should move things for Disney. It's brutal.
Did you watch it?
Absolutely. No, I haven't watched it.
You did channel checks,
I watched the trailer. Look, we're anticipating this bombing ever since we had that original press tour. Do you remember with the lead actress a number of years ago?
When the prince was called a stalker 2 years ago?
And she said it was weird and, et cetera, et cetera. Sandra, this was always the direction of travel for this movie.
All I can say is I watched Anora over the weekend, and it's a fantastic movie. I'm not going to tell you what happens at the end, but I will say that, you know, honestly...
Can you tell us what it's about?
It's about an exotic dancer.
Okay.
Who speaks Russian.
All right.
Who gets on with a Russian oligarch's son.
Okay.
And what happens then? I think it's fantastic. My point is, it was very original.
Happen next?
Well, I'm not going to tell you. Stop, please.
Okay.
Anyway, it's good, and I recommend it, but it was original. And when are we going to move away from nostalgia to originality? I love it.
Okay. No spoilers. Unlike Shogun. Never forgiven for Shogun.
I'm never going to bring up movies again.
You will never be forgiven for spoiling.
I didn't just spoil Adora. I gave the very bare contours of the basic understanding of what it was.
I always get nervous when she starts talking about film.
Session highs in the equity market on the S&P, up by a little more than 1 full percentage point. Coming up on the program, Jean Barvan of BlackRock on hopes for targeted U.S. tariffs, Dana Telsey of Telsey Advisory Group on the outlook for retail, Troy Gajewski of FS Investments warning investors should buckle up. We begin this hour with stocks higher on reports of a more targeted U.S. tariff approach. Jean Barvan of BlackRock writing, we stay overweight U.S. equities on our tactical horizon of 6 to 12 months as policy uncertainty should ease over the period. John joins us now for more. John, good to see you.
Great to see you.
More confidence being long stocks versus bonds. Just help us understand the why.
Well, on the bond side, I think we are high conviction that we are observing right now a resetting of global rates higher. It's a big story. I think we see fiscal spending being everywhere. This is in part in reaction to the foreign policy of the U.S. And that has still to play out. So I guess being underweight bonds is high conviction. On the equity side of things, we remain of the view that we are at uncertainty right now is maxed out. Never seen that before. Along many policy levers, objectives are not clear, and so all that together, I don't think can last forever. I mean, that's not good for anyone. So we think over the next few weeks, as we get more clarity, I think markets will be able to get on with whatever is the destination, and that's the overweight.
Markets where? Markets in the United States? What about markets elsewhere that have actually rallied into this decision? I'm thinking of China. I'm thinking of Europe.
Yeah, so I think right now this has been the opposite, right? So we've seen the rest of the world outperforming the U.S., but on a 6 to 12 month horizon, we expect to go back to the U.S. taking the lead. I think this is partly because on the European side, even though we are a bit more positive, we turn neutral. We used to be underweight. We think this is more of a narrow story. It's military spending, it's banks, and it has some momentum for a few months, but we don't think this is yet a macro story that's going to carry Europe for the next 12 months. So we expect to revert back to U.S. taking the lead as a result.
If you put these two ideas together, the idea that we're seeing a structural repricing of rates and that you still are overweight the U.S. or expecting the U.S. to take the lead later this year, do you think overall equity returns are going to be constrained by this repricing of rates globally?
So we don't think rates are coming down. We think the 10-year yield in the U.S., which has been rallying, is not the story we're going to see going forward. So there's going to be an adjustment. But we think that, there's like deep forces that will reassert themselves. AI, we still are, very bullish on AI being a powerful source of drivers' returns. And as a result, we think it's possible to withstand higher rates, moderate increase in rates, and withstand those for equity. If we get a very significant adjustment in rates, which is not impossible given the uncertainty we're facing, depending on the policies that will be put in place, then it would challenge the view on equities, I guess, for the U.S.
In the United States.
Yeah.
Do you think that the U.S. is going to be the main beneficiary from this AI megatrend that you've been talking about for quite a while? Or do you think that increasingly you and your colleagues are starting to think about China as also being maybe not as much of a beneficiary, but a significant one with some of the advancements that we're seeing currently?
Yeah, I think both are set to benefit from the AI story. I think both China and the U.S. We think this is where it plays out. There's a bit of a Middle East story as well, but it's not a global story. So we think this is more powerful in the U.S. I think the U.S. eventually provide an environment where we're more comfortable with, I guess, on the macro perspective. So the AI story is playing in both places. I think the macro backdrop eventually is more positive in the U.S. That's why the combination of macro and AI favors U.S. over China for us.
It's interesting you mentioned the Middle East. We just had Sheikh Tahnoon down in Washington, and the UAE saying they're going to invest more than $1 trillion in AI, but a lot of that is almost contingent on them being able to get access to these chips. Is that all the leverage the U.S. holds? They have all the power?
I think that's part of it, right? So it's first of all, it's a story that is a very, very high barriers to entry, a massive amount of capex that is needed to be a player in that space, and I think so. You need big firm with big balance sheet. It's possible for other countries with deep pockets to play a role in there, but I do think that the U.S. does have the upper hand on this at this stage.
When you see positive news like that, but then you also see banks coming out and potentially raising their probability of U.S. recession, how do you weigh the two?
Well, I think right now the part we haven't talked about, we've talked about the 6 to 12 month horizon with our view that eventually we get back to a better place. But for now, as I said, the uncertainty is kind of peak level. I don't think I've ever seen so much a range of views on what might happen. The commentary on the outlook is as wide as I've never seen. It's as political as I've never seen it. And as a result, that is holding back people. And the longer it lasts, then I think we don't think a recession is in the card. We think there's a lot of resilience. In fact, I don't think the recession is the biggest risk. I think the biggest risk is long-term decision, infrastructure decision, and so on. That if they're put on hold, we're going to see a lower structural growth rate in the U.S. eventually, and that's much bigger deal than a recession.
You keep talking about how later this year we'll get to a better place from some sort of policy level or from a certainty level. What does that mean at a time when we keep talking about uncertainty being a feature and not a bug of this administration?
I mean, I'll give you one example in the tariff. I think, right now there is a debate, there's uncertainty about what will be the impact of those tariffs for the U.S., for the trading partners. And you can make an argument that it's going to be minimal, it doesn't hurt the U.S. Once the evidence comes in, I think the leverage of this bargaining chip will be waning. And so I think one way or the other, we're going to see a reduction. It's going to be harder to dismiss the damage from tariff. It's going to be harder to just make bold statement about we're going to go with even higher tariffs. And I think you get to see a convergence someplace as a result.
Is that the moment to buy bonds when we actually start to see that? Or is there another reason why you just don't believe treasuries are going to play that role this time around?
I think the underlying forces, we don't think inflation is resolved. I think the Fed last week has painted the most optimistic scenario and they've included that in their forecast on the tariffs.
You don't buy it?
I don't buy it. And then I think the fiscal side, I mean, we'll need to see, but we have hope of tax extension coming in, so we know this is going to make the deficit wider if that's the only thing happening. The saving is much more uncertain. So I think the fiscal story remains one of deficits and putting pressure on yields.
When you open up the SEP and you look at those forecasts from the Federal Reserve, which piece of that jumped up to you and said, that's aspirational, I don't buy it?
Well, to me, the most revealing part of the SEP and the press conference last week was when asked about whether this is a one-off story inflation. I think the chairman was very careful to say, well, we don't know for sure. Last time it was. But when he answered a question later about when they would get concerned about inflation, he said, well, if we were to see inflation appearing as part of the economy that have nothing to do with tariff, then we would get concerned. That's, to me, like doubling down on this is a one-off. They see the tariff as being a one-off, and so that definitely stood out for me.
Do you not think it is a one-off?
I think it could be, but and it was last time because it was very targeted. If we're talking about broad-based resetting of global trade, I think there's going to be adjustment. I think the cost of doing international production will be higher, and it's not like just a tax or a tariff. It's the broader adjustment, higher cost of production for some time.
You've heard the argument from economists that because employment anxiety is higher now, the second round effects will be dampened. People won't be able to ask for a raise. You won't see those second round effects of that spike in prices. What do you say back to those people?
I think we have a very tight labor market. I think that the Fed sees it as being balanced. I think we have seen over the last few years immigration playing a massive role in helping the labor market cope with a lot of tightness. I think that is the big story going forward. So I'm not sure that the bargaining power for wage negotiation will shift that much.
Ask for a pay raise. Good news.
Okay, really? Yeah. Really? You're on really a mission. Man, I wonder what...
I don't like that psychology shift
that
shifts away from the, towards the employer. And,
yeah, well, I mean, keep fighting it.
Not asking for a bowl of whatever.
Yeah.
It's not Oliver. John Barvan of BlackRock, thank you.
Thank you.
Please, can I have another? Another what? What's he asking for back in the day?
I don't remember. It's just like, please.
Oliver Twist, can I have some more? All right. Let's give you an update on stories elsewhere. Let's get you Bloomberg Brief. Here's Yahara Hacker. Say Yahara.
Hi, John. The tariffs President Donald Trump is set to announce next month will be more targeted than he has indicated. Sources telling us the president's upcoming April 2nd Liberation Day tariff announcement is set to be more focused and could exclude some countries from widespread reciprocal tariffs. Meanwhile, 23andMe is moving forward with bankruptcy proceedings in the U.S. to help facilitate a sale. The personalized DNA testing company plans to continue operating during the process. 23andMe was valued at $3.5 billion when it went public in 2021. Now court documents show it has more than $277 million in assets and over $214 million in liabilities. And London's Heathrow Airport has defended its handling of Friday's unprecedented shutdown, saying it would not have been able to operate uninterrupted. The statement comes in response to comments from the National Grid CEO, who told the Financial Times there were enough alternative power supplies to keep the airport running. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Thank you very much. Up next on the program, the Morning Calls Plus, Dana Towsey of the Towsey Advisory Group on her outlook for retailers. That conversation up next, live from New York City this morning. Good morning.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The opening bound 1 hour and 13 minutes away. Equity futures on the S&P still near session highs, up by more than 1% on the S&P 500. On the Nasdaq, up by 1.4. Let's get you some morning calls. First up, Goldman downgrading Supermicro to sell, citing AI server competition and margin pressures. That stock is down by close to 0.5%. Your second call from Jefferies, upgrading FedEx to buy, noting the shipping giant is executing on cost-cutting plans. That stock is up by 1%. And finally, Morgan Stanley initiating coverage on General Mills with an underweight rating, seeing a stable backdrop but more secular headwinds. That stock is lower by 0.7%. Let's stick with the consumer. Investors looking ahead to consumer confidence later on this week. Dana Towsey of the Towsey Advisory Group writing, frenetic is an apt word to describe the current environment. Key measurements such as consumer sentiment and volatility in the stock market reflect the anxiety out there. Dana joins us now for more. Dana, good to see you as always.
Nice to see you. Thank you for having me.
Are people pulling back? That's what we want to know. Do you see it in the channel checks?
We are seeing it in the channel checks. When you look at the earnings results that are coming out from retailers lately, the fourth quarter almost feels divorced from what you have in the first quarter and going forward. You look at the guidance that companies are giving out in the consumer space for the first quarter. In essence, we always know the consumer area is a third and fourth quarter weighted. But now the first quarter is expected to be, for the most part, weaker than consensus and what consensus had out there. So you need to accelerate even more rapidly. And that word frenetic, the reason I like it, I looked up the definition, anxiety-inducive activity in a wild and uncontrollable way. And that's what it feels like today.
Consumption has been super resilient for the last several years, but beneath the surface, beneath the headline numbers, it's been very bifurcated. Low-income consumers have been squeezed for quite a while, a number of years now. High-income consumers have held up. Is that still the case? Because if they start to go, this is over, what's the story?
I think the higher-income consumers moderated their spending a bit. You look at what Delta Airlines said a few weeks ago, and Delta is the premier airline with a premium price of 20% or more. You're still seeing the Uber high-end doing very well. You look at Hermes's results and the double-digit increases. But everyone else out there, it's a state where it's not as robust as it had been. And consumers are discerning. Look at what Costco said, where they've seen a shift to people eating at home. And we're seeing more evidence of that type of behavior. What do you need to win? You need newness, you need events, you need activation in order to drive interest. I was on Friday and on Saturday, I was downtown at the opening of the new Printemps department store, the first one here in the U.S. The wait was around the block. So there's interest in newness.
Do we have a sense then, just to that point, of who might be using this as an excuse? The idea that there's consumer hesitancy, so why not kitchen sink it, throw all your problems out there, clear the decks, and then do what you want?
I think some of the companies overall who have been performing poorly, you're able to do that. You've certainly taken a look at some of the lower-end department stores that have had some of those issues. But many of the others, they're hoping that they can still see that sell-through. The ones that are winning, brand leaders, discounters, and off-pricers. You definitely see even some weakness in some of the luxury brands that haven't been as strong. You look at some of the European brands like Kering, doesn't have the same robust posture that they had before, and they just found a new Gucci designer, so we'll see what happens. It'll be interesting to see LVMH's sales results when they report in mid-April.
Who do you think is going to be really caught in the crosshairs when it comes to tariffs?
The areas that are being impacted the most from tariffs, it's definitely some of the footwear companies, some of the dollar stores. And the speed at which you need to diversify, you can do three things. You diversify to other areas, you split the cost with the manufacturers, and you raise prices. But diversifying and paying the cost of manufacturers or them diversifying, it takes time. There's a reason companies went to China. It's fast and the labor knew what to do, and it's cost effective.
But when it comes to April 2nd, we're going to get this, quote, Liberation Day. Maybe it's going to be more selective than a broad scope. How are these companies preparing for that? They're not going to be able to move manufacturing in a matter of weeks.
They're including it in their guidance. For many of the companies, the guidance that you've seen for 2025 includes the tariff implications at the point until which they know how much the tariff is. Anything else, it is basically they'll need to reset again. And for the most part, in the early runnings, you're right, it's not a lot of the apparel world, but it is many of the other areas that raises prices for the end consumer.
So we've heard reports about certain companies, I'm thinking about Walmart in particular, that have gone to Chinese suppliers and said, all right, cut your cost by 10%, eat it. And they say, no, thank you, not going to do it this time. How much are you seeing that across the board, these sort of efforts to jawbone suppliers into absorbing it, not getting that, and so ultimately they will have no choice but to raise those prices?
I'm hearing about it from some of the bigger players, the smaller players also. They're all looking at other areas in which to diversify manufacturing, not in the U.S. because of how expensive it is. Going to South America, going to Africa are some of the other areas that we're hearing companies work to do that.
Macy's has Macy's problems. Their stock is down by another 20% so far year to date. Do we need another luxury department store in New York City? You mentioned Printemps. Do we need another one?
Overall, I mean, the location is a little bit different on Wall Street, but in saying that, There was people down there, certainly when I was there, around the block.
I noticed the same thing down there over the weekend. I just wonder if that lasts.
We'll see. We'll know in a month or so, but I think that location is a little bit odd to get regular visitors all the time.
But they don't want to be known as a department store. I think the French are very upset about this. Yes. So how are they communicating that?
5 restaurants.
Hang on a minute. What are they upset about?
They don't. Printemps doesn't want to be known as a department store.
What are they calling it?
Experiential. They want to be experiential.
Purchasing of items.
They basically have
like
5
a
restaurants.
Selfridges, like a Harrods,
but
right?
much smaller. I mean, when you're thinking 55,000 square feet, it's 2 floors. Not all the restaurants are open yet.
The reason why is exactly because of the way that you asked that question. Do we really need more department stores? You have to wonder. A lot of people are thinking the same thing because Macy's was not a pleasant experience because it didn't really do it well.
Downtown's a bit of a ghost town on the weekend. We got enough footfall down there to make this work?
That's going to be the big question. They do have exclusive brands from France that are there. Since it's hard to get in, it's going to take time for everyone to see it and go back on a repeat basis.
Yeah, I'm willing to go downtown to go see it, especially knowing there's lines, and there's probably even more lines during the week.
They've got one.
Right. Well, I agree. I will go back there to check it out to see how they're differentiating themselves. You would think there was other locations like that Barney's building, but that's much bigger than 55,000 square feet, and you need an anchor to bring people up Madison Avenue.
Oh, the old Barney's building.
Yes.
I used to like it there.
It's empty.
It's still empty, right?
It's still empty.
The one you're talking about, the one on Madison, not the one downtown.
Yes, Madison and 61st.
They need to do something about that, Dana. We'll sort that out. Dana Towsey there of the Towsey Advisory Group. Dana, thank you.
Thank
you. Good to see you. I was downtown. The Beekman was full. Lots of people there having lunch, doing drinks, all of that stuff. Then you go to Prince Hobbs, round the corner. The line literally going round the block.
25% of the brands that they're bringing in, you cannot get in the United States. You literally have to go to France to see them. And I've been to Printemps in France, and I love it. So I'm very excited about this because finally you get access to
That's
these
the
brands.
attraction.
I think that's the attraction. That's how they're going to win, potentially, and maybe the restaurants.
Once you get in.
Yeah, but the experience aspect is important. I mean, I think about that with my own younger cohort of sample size at home, and they talk about the experience of going to certain places and why they are willing to go to the place. It gives you a place somewhere to go. It's interesting.
You're socializing with friends.
Exactly.
Couldn't care less about the experience. Sort of like, I just want a friction-free transaction. You know, just want to
There's
go
something
in
for
direct.
everyone.
Yeah, I was about to say, if the whole world
I don't
were
want to
you.
talk to people. Just let's get the size and let's go.
These shops
all right?
must really see you coming in and run. I'm the type of person that they offer you some champagne, then that's I'm buying another blazer.
You're more expensive. that's taking a hit on the margin. I'm just direct. I'm much easier. They
I
see
want
me
the
coming.
wow of seeing something new. It's very exciting.
Make the sale. Coming up on the programme. Dana always got to say
Thank you.
Kathy Bonjancic of Nationwide, Tony Trogayeski of FS Investments, Anne-Marie, who cost them, how much money does it cost before you buy anything? They're like $200 deep.
Yeah, but then you end up buying more.
Yeah, but then she takes out that plastic, and
Okay.
let me tell you.
Just going down there once.
Yeah, exactly.
Yeah, great. From New York City, good morning.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The opening bow 60 minutes away. Equity futures positive by more than 1 full percentage point on the S&P 500. On the Nasdaq, we're higher by 1.5. If you are just tuning in and waking up this morning, welcome to the program. There is a reason why equities have bounced so hard this morning. Reporting over the weekend from the team here at Bloomberg down in Washington, D.C., that on April 2nd, that much-anticipated Liberation Day, when the President of the United States said he would unveil some major reciprocal tariffs, we understand, based on officials familiar with the matter, that maybe that effort might be more targeted.
Liberation Day light, maybe, potentially. It's going to be selective when it comes to the countries they care about, but maybe it is those 15 countries, dirty 15, as Scott Bessent, the Treasury Secretary, spoke about. How harsh are the measures going to be on those countries, I think, is the question we need to be asking going into next week.
We should stress this is a snapshot of where the administration is right now, and things can change, and we've used this word repeatedly throughout this morning. Things are fluid. They are always fluid in a Trump administration, and they will continue to be when it comes to things like trade. A busy week of data also on deck. Joining us now is Michael McKee, our economics and policy correspondent. Mike, looking forward to your interview a little bit later with the Atlanta Fed President, Raphael Bostic. What else is in store later this week?
Well, we've got a pretty busy week ahead, John, although it's a little back-weighted towards the end of the week in terms of economic data. Nothing today. Tomorrow, however, consumer confidence from the Conference Board. It's going to be very interesting to see if they track what we've seen from the Michigan numbers. A lot of disappointment among Americans in terms of what's going on. Then we get durable goods orders, and then Thursday we start off with some of the bigger stuff. Advanced trade, we'll see what the trade deficit has done and how that affects Donald Trump's mood. And jobless claims, of course, we watch that every week. And Friday, income and spending and the PCE inflation report, which is, of course, the one that the Fed follows, and we're expecting it to go up a little bit, something we can ask President Bostic about today. And then also you get the final Michigan sentiment numbers. So we'll have an idea of how people feel about inflation and the economy by the end of the week. We'll see if the Fed officials who are speaking this week are going to have any more clarity on what's going on, because we've basically got 2 a day, like the football training camps, 2 a day of Fed speakers, including Raphael Bostic today. He'll be joining me at about 1:45 Wall Street time this afternoon, and we'll be talking about things like how do you know anything at this point about which way the economy is going until April 2nd.
Mike, looking forward to getting some more Fed speak this week, and I'll tell you why. When you go back to last week, a lot of attention was paid to an unmoved median dot for 2025. You were the first to point out to me, sent me an email almost straight away saying that look at the distribution of the dots, and they started to skew hawkish. Mike, could you just break that down once again for us and maybe explain just how much daylight there might be between some speakers on the FOMC and what we heard from Chairman Powell in the news conference?
Well, we had two in December. For the December dot plot, we had two people who were above the ideal. In other words, fewer than two this year for the Fed. And now we have 8. So we have a leaning on the Open Market Committee towards not even getting to 2 rate cuts this year. A couple of them say none. And so there's a hawkish, I guess you'd call it hawkish, but it's really sort of a pessimistic view that the Fed won't be able to cut rates anymore this year. And it wouldn't take much to move them in that direction if inflation stays the way it has, or stays sticky the way it has.
Mike, appreciate the update and looking forward to your conversation a little bit later with the Atlanta Fed President, Raphael Bostic. Not many people talked about that hawkish distribution, that hawkish skew that we saw in the dot plot last week.
Yeah, because that was just erased by Fed Chair Jay Powell's transitory word, as well as his idea that probably it's going to be tough, but they will be able to see if the tariff-induced inflation is just going to that particular area. I do think it's important, though, because if you take a look at the center of this committee, they see stagflation as an increasing likelihood, and that is a very, very difficult recipe for the Fed to fight.
Let's stick with the economy. Kathy Bosjantic of Nationwide Mutual Insurance writing, if downside risks to our baseline forecast continue to build, the FOMC may shift its focus from inflation to slowing economic growth and potentially deliver a rate cut earlier in Q3. Kathy joins us now for more. Kathy, welcome to the program. That is the #1 question that so many people have. If the Federal Reserve has sticky and above target inflation, are they in a position to respond to downside risks materializing in the economy? What gives you the confidence that they can do that later this year?
Well, good morning, John. And I should highlight first our baseline forecast is that they don't, that they wait until the fourth quarter and we only have 1 rate hike for the year. But what I was illustrating is that we continue to see downside risk building, right? You're seeing in the economic data, even if these tariffs, which you're talking about, maybe are more targeted and not as negative for growth or inflation, you still have a lot of uncertainty out there. I think even after April 2nd, it will have a little clarity, but still uncertainty. And that uncertainty is corrosive to economic growth. So my concern is that there's downside risk to our baseline and that the Fed, maybe they do need to come in the third quarter. Now, they have to balance things, right? Inflation versus growth. But if they believe, now Chairman Powell opened this, the genie bottle, right, and said, let the genie out, said transitory. If they really do believe that, then they can shift to growth because they're going to look through the tariff impact. But, tremendous uncertainty at this point.
Kathy, right now the market's baking in almost 3 rate cuts through the remainder of this year by the Federal Reserve. Do you think that increases the risk of inflation picking back up in the scenario that you just laid out where growth is slowing, inflation is sticky, and some of it or a lot of it can be attributed to tariffs?
Yeah, financial conditions, I think, overall are a bit volatile, and a lot of that due to the equity market, but we're also seeing corporate bond spreads widen a bit, not alarmingly so, but widen. So even though the bond market's pricing in more easing, the fact is I don't think overall financial conditions have really eased that much. And if you look at the 10-year yield, it's quite volatile, but it still remains high. Mortgage rates are high. So I don't see that, easier credit flowing through to the economy and really jazzing up things. If anything, maybe it provides a little buffer, but I think there's still a lot of headwinds, hitting the consumer, hitting businesses at this point.
Which raises the question, Kathy, of whether Fed rate cuts will actually be effective at boosting growth. Will they be the same kind of put, if not on asset prices, then on the economy that they have been traditionally?
Yeah, it's. I think that what the market really wants is that Trump put, and we don't seem to be getting that as much, or at least the strike price is lower. But again, there is good news that the tariffs that will be announced on April 2nd could be more targeted, and those sectoral tariffs, maybe not on top of that. But again, we don't know. But I think with the Fed, I think we have to be careful to think the Fed is just going to come to the rescue. I think they could support growth if needed. But I think, so much really is coming out of the White House. The economic policy changes are really kind of swamping the Fed effect, I think, at this point.
Kathy, is it too early for Jay Powell to call it transitory when, one, we don't know how harsh these targeted tariffs are going to be, and we don't know the retaliation those countries may take on the United States?
Yeah, I kind of, probably like many people, kind of shuddered a little bit when I heard transitory, because we don't know. And we could continue to get like this stripping out of tariff announcements. And that could mean that the inflation impact lasts for longer. Even if it's not as big, it could last for long, and that complicates things, I think, quite a bit. So I think it was a little premature, and I think, they could, the baseline, their forecast is what it, is. Like, it does show a temporary increase in inflation and then growth slowing, but I think, putting that transitory stamp, I think that was a little premature.
Kathy, I think some people are confident because they believe the labour market's not as tight as it once was. And the potential for second-round effects, the potential for people going out and saying, I want a bigger paycheck, and the company actually following through and delivering one, is somehow been dampened by the increasing employment anxiety that we've witnessed in some of the surveys over the last month. We got some pushback, actually, from BlackRock's Jean Bavin about 20 minutes ago on that point, and I think it was actually credible pushback. He said, you've got to think about the lack of immigration we're going to see over the next several years, and this labour market could well be tighter than people think, alongside that tariff effort, and which would make us vulnerable to second-round effects. Kathy, how do you think about the labour market dynamic? Because I think that point is probably the most important one.
Yeah, no, I think that's a great point. Like, yes, it's harder to go in to ask for a raise. Employers have more power right now. But on the other hand, just as you pointed out, John, less immigration means, all else equal, a tighter labor market. If you look at the household survey, they dissect foreign born and kind of indigenous, domestic workers here, and all of the jobs that were created according to the household survey last year on net were for foreign-born workers, because we have a demographic issue here, right? We have people who are retiring, the baby boomers. So we do need immigration to kind of keep the labor market fluid, and it could get tighter than we all think, especially in certain sectors. Now, whether that transcends to the whole labor market, wage growth going up, maybe a different story, but certainly where immigrants are prominent in the agriculture, retail, home working situations, there you could see some wage pressure.
Hey, Kathy, appreciate your view, as always, and the clarity. Kathy Bodjancic there of Nationwide. We came out of the pandemic and got a lot of things wrong. It was a humbling moment for a lot of people that were in the business of making forecasts. And I think going into this, you've got to be really open-minded about what the consequences might be in the coming years.
Yeah, Jean Bovin's point, and I think it's a really well taken one, is that the U.S. economy isn't falling off a cliff. They think that the U.S. will reassert itself. And in the process, there is a supply-demand dynamic in the labor market that will allow people to keep asking for wages. It's unclear to just assume that these companies won't be able to pass along price increases. Mohamed El-Erian has talked about how companies have figured out that consumers are less price sensitive and less aware of what the price of certain things maybe should be.
So keep asking for that pay raise. Seems to be the conclusion of our conversations this morning.
I think that that's the conclusion every day.
Don't give up that
of a conversation.
Troy Gajewski of FX Investments joins us now for more on the markets. Troy, welcome to the program. Troy, you say buckle up. Why?
Well, I think we came into this year with an extremely low, even a 0% probability of recession. And obviously, we're going through a substantial rebalancing of the U.S. economy, where the president and the Treasury Secretary are openly talking about recession risk and potentially a far worse recession. And it just takes, or a far worse correction, and it just takes more time to rebalance from a consumption economy to one where there's so much more domestic fixed investment. And as you said before, humility is clearly a term that should be utilized now. And that's one of the key reasons why people embraced asset allocation, so they don't have to overreact when you go through these rougher patches for markets.
So, Troy, let's talk about the data first, and then we can get to the market outcomes. Clearly, the sentiment surveys have been shaken up. We've seen that over the last month or so. There's a question about the inevitability of that pouring, bleeding into the hard data. How do you see the former informing the latter? Do you see it as necessarily one means the other one breaks, or do you think we can avoid that state?
Yeah, I think we can avoid it. I mean, again, recession risk has gone from basically non-existent to maybe 15 to 20%, still a low probability. In times of uncertainty like this, it's best to go back to the hard data and just look at the contributing factors to GDP. And what we know is that consumption is going to be lower. It was already going to be lower this year. It'll probably be slightly lower still, informed somewhat from the soft data. But when you look at the hard data and you think about business fixed investment in particular, and you see this in the Atlanta Fed Q1 GDP forecast, we're talking about 8-9% growth from quarter over quarter. And we're probably going to have somewhere between 55 and 75 basis points of additional business fixed investment in the U.S. So that's a very strong data point. And again, the consumer is certainly weaker than they were 2 years ago, but the labor market's still tight. You look at withholding tax growth, it's growing 6% year over year. Initial claims are still incredibly low. Continuing claims have come up a bit, but they're still very low by historical levels. So when you put that all together, it gets back to the Fed's forecast with all the uncertainty. We're going to have slightly lower growth with slightly more inflation. The Fed is more than likely going to have to sit on their hands, maybe cut by 25 to 50. Not the end of the world, but certainly a much more challenging environment than 23 and 24 for U.S. equities.
In that kind of picture, Troy, do you agree with Jean Bovin of BlackRock in that probably yields are going to remain higher and possibly higher than where they are now? And I'm talking about long-term yields, given the fiscal borrowing over in Germany, but also the fact that in the United States we have both of the deficit concerns and, frankly, we continue to have inflation that likely will remain somewhat sticky.
Yeah, I'll tell you, if we were long a ton of duration, I'd be very nervous right now. And the reason is partially what you stated, but also think about what we just went through. We went through a significant rebalancing or recalibration of recession risk. And the 10-year only dropped to 4.2, 4.3. Right? And we know the Fed is going to cut over the next several years, not dramatically, but dramatically enough to cause a re-steepening of the yield curve. And so we do think there's more risk now to the back end of the curve as the economy continues to go through this transition point. So, yeah, be ready for a yield curve steepener. We've seen it already, and we're going to probably get more of it going forward. Now, obviously, the offset to that is how much spending can be cut. That's still a very open question, as you know. And again, the supply dynamic is still very, very problematic. You know, over 70% of all the treasuries that have ever been issued are going to be issued over the next 10 years. The Treasury is obviously playing with the maturity dates there to keep pressure off the back end of the curve, but that's a lot of supply that needs to be absorbed over a very long period of time.
To Anne-Marie's point earlier this hour, was it incorrect for this Fed chair or perhaps premature to use the T word, transitory, at a time when potentially what you expect, the steepening of the yield curve, is an implication that the more the Fed cuts now, the stickier inflation will remain over a longer term?
Yeah, I liked her term, but I sort of cringed myself when I heard transitory again. Back to the humility point, there's just so much uncertainty right now. So stating that, you know, after April 2nd, you're going to have this very clear picture is just not true, because we'll put in a first round. Obviously, we're maybe going after the dirty 15 as opposed to every trading partner we have. And then from there, you're going to have retaliatory tariffs. So there's a lot that needs to play out. And again, you know, when you think back to asset allocation and you think about why investors embrace alternatives or even still own some fixed income despite, you know, the relatively paltry yield and clear risks that we've discussed, a lot of that gets back to when you're going through periods of uncertainty, you want to have investments that can continue to perform and not have the same degree of volatility that the equity market has gone through recently.
Hey,
and
Troy,
by the way, it's gone through the last 5 years and the last 25 years.
We've got to go, but it's good to hear from you, as always. Troy Gajewski there of FS Investments. Troy, thank you, sir. This is the big debate of the moment. Is April 2nd that point of peak uncertainty that we can move on from, or just the start of a new phase, a new wave of it?
And what does that look like if people are hoping for a better circumstance later in the year for all of these investments to come together? It goes to M&A that's been put on hold. It goes to capital investment, which have also been put on hold. And frankly, it goes to hiring decisions, which also have been somewhat stagnant. Is there going to be a resolution moment?
It's going to answer some questions. It's not going to answer all of them. Because what happens when it comes to the retaliatory effects of the April 7 effects on even it's just the dirty 15, what happens to their response? And then also the sectoral tariffs. When are those going to come into play? Because Donald Trump has talked about the fact that on Liberation Day, what he calls it, we would have both. And it looks like now we're only going to have one.
Equity futures right now on the S&P, and near session highs up by 1.2%. The opening bell 43 minutes away. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Congressional Republicans returning to Washington today will tackle their toughest test yet. That's negotiating a massive tax bill to deliver President Trump a legislative win. It faces multiple challenges, including the overall size of the deal, what elements to include, and how to offset the costs it will incur. Meanwhile, BYD reported sales that surpassed the 100 billion mark last year. According to its results, in total, the Chinese EV maker's revenue came in at $107 billion, beating analyst estimates and leapfrogging Tesla, which reported nearly $98 billion in 2024 revenue. The last time BYD surpassed Tesla on revenue was back in 2018. And United Airlines is set to begin charging customers more to access its airport lounges. According to the company, individual United Club memberships will now cost $750 or 94,000 reward miles a year for Mileage Plus loyalty program members. The move aims to combat a rise in overcrowding in lounges since the pandemic. That's your Bloomberg Brief. John?
Yahara, thank you. Stopped using lounges a long time ago. Find a nice restaurant in the airport terminal, get better service.
Hold on a second. This morning we're getting...
United Lounge is absolutely abysmal. Why would you want to pay up for that?
We're getting a John Farrow Guide to Life. He's going to write a book.
That's amateur hour. You show up 20 to 15 minutes before your flight starts boarding.
Don't use the lounge.
Then you avoid everything.
Okay. I can't, I'm not cut from that cloth. I can't do that. I have too much anxiety. I'm sort of like, get to the airport 2 hours before.
You would hate traveling
least.
with me.
I know. That's why we don't travel together. I got 2 hours, guy. 2-3 hours, maybe sometimes for long haul.
I love that we're getting a guide to the John Farrow way of life.
Like those lounges,
you go
Delta
to a store,
and United, just absolutely not.
You just go in. Lounges, absolutely not.
Direct.
You go direct.
Transactional, like the president, just sort of in and out. You know, you get what you need, I get what I need. Up next on the program, setting you up for the week ahead. Lots of economic data and Fed speak too. Live from New York, this is Bloomberg.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
Go.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The opening bout 37 minutes away. Equities near session highs at 1.2% on the S&P. Bouncing back nicely on the NASDAQ, up by 1.55% going into the opening bout. Trade very much in focus. Economic data will be too in the next couple of hours at 9:45 Eastern Time. S&P PMI data at 145. Bloomberg's Mike McKee will be catching up with the Atlanta Fed President Raphael Bostic. Look out for that on Tuesday. Consumer confidence. Wednesday, durable goods. Thursday, a read of GDP plus another round of jobless claims. And on Friday, core PCE and UMich consumer sentiment, which is now less important after Chairman Powell last week?
Collectively, the sentiment surveys will color the information that we get. Look, how much is it going to be? Any additional tea leaves that we get from the White House that will dictate things? Although I do want to say, to temper this week's gains, or this day's gains, the NASDAQ 100 has underperformed the S&P 500 for a fifth straight week. It has been an ongoing underperformer. Maybe this is just a little catch-up.
Been tough for the NASDAQ, that's for sure. Later on today as well, at 2 p.m. Eastern Time, you'll hear from the President of the United States, Donald Trump, delivering remarks alongside the Governor of Louisiana, so look out for that too. Joining us now from Washington, Bloomberg's Tyler Kendall. Tyler, what are you expecting to hear from the President later on this afternoon?
Well, John, you said at 2 p.m. Eastern, that's when we're expecting those anticipated remarks with the Louisiana governor. There is reporting that Hyundai is anticipating to announce an investment announcement here today at the White House. There had been local reports earlier this year that the company was looking into building a steel mill in Louisiana. That's prompted speculation that the governor's visit to the White House today could coincide with a potential announcement. We know that automakers have been lobbying this White House particularly hard for exemptions and carve-outs when it comes to those tariffs. And one of the prerequisites has been to move production to the U.S. and also to make these investment announcements, something that this White House is keen to tout as a way that their tariff progress is already working. John, we should say that if those sector-specific tariffs do not go into place on April 2nd, that would be a welcome development for the auto industry.
Tyler, I've got 20 seconds left. What's it like to travel with Anne-Marie?
Oh my goodness. You have to be prepared with everything just in case that we are cutting it a little too close.
There you go. Is it worth it? Tyler Kendall, thank you, from Washington, D.C.
You're living on the edge.
That's living on the edge, is it? Missing a flight in Washington, getting stuck at the airport for longer than you need to.
Sounds like
Washington if you're lucky.
Edgy type stuff there. All right, coming up tomorrow, Cameron Dawson of New Edge Wealth, Libby Cantrell of PIMCO, Abby Yoder of JP Morgan, and Krishna Mamani of Lafayette College from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Miami Open update for Bloomberg TV and radio from Tennis Channel. Alexandra Ayala clinched the biggest win of her career as she took out Australian Open champ Madison Keys in a major upset in the women's draw. The 19-year-old is a former junior US Open winner and trains at the Nadal Academy in Mallorca. And her reaction on reaching the round of 16 was there for all to see.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
What
what legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice then to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of science. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
All right, kicking off the week with a little bit of optimism here. 30 minutes, though, until the start of cash trading. I'm Matt Miller.
And I'm Danny Berger. Sonali Basak and Katie Greifeld are on assignment. Bloomberg Open Interest starts right now.
Kicking off the week with confidence, traders bet President Trump's reciprocal tariffs will be targeted on April 2nd rather than sweeping. And China steels itself for shock. CEOs including Tim Cook and Albert Bourla are in Beijing as Chinese leaders prepare for tariffs that exceed expectations. Plus, BYD beats. The Chinese electric vehicle maker posted more full-year revenue than Elon Musk's Tesla, even as it sold fewer cars. Let's take a look at where markets are trading. As I said, we're looking at some gains this morning on futures. S&P futures now up 1.2%. NASDAQ futures up 1.5%. You really do have tech stocks leading the way, like Tesla, like Meta, like AMD, all putting up big pre-market gains. The 10-year yield rising back up to a 430 level right now, so investors selling treasuries on hope that Trump's tariffs will be targeted. Let's take a look at the auto sector in particular would benefit from more targeted tariffs. You can see Tesla, the biggest gainer today, up 4%, and retail investors just piled into Tesla over the last couple of weeks, even as the stock sunk. BYD just out with earnings, over $107 billion in full-year revenue. The stock trading for $106.50. And we're looking at General Motors and Ford also putting up gains on hopes that President Trump's tariffs will be narrower than expected. Danny, what are you watching?
It's much of the same story, Matt, because it's not just autos that are one of the sectors that might be spared. If we don't get those sectoral tariffs, if it's just more reciprocal on countrywide type tariffs, semis is another one of those. Semis across the board, leading the way higher for tech. Micron, Broadcom, AMD, Intel, all up at least 1%, getting a lift again on targeted tariffs. Now let's stick with that because President Trump has been setting the stage for his big announcement next week.
April 2nd is going to be Liberation Day for America. We've been ripped off by every country in the world, friend and foe. That money's going to be coming back to us in the form of tariffs. They're tens of billions. It's going to be numbers like nobody's ever seen.
So as far as we know right now, those tariffs might actually be more targeted, potentially sparing a number of specific industries, including the automakers and semiconductors. Let's get the latest from the White House with Bloomberg's Tyler Kendall. Tyler?
Yeah, hey, Matt, it appears the White House is narrowing its focus ahead of April 2nd. As you said there, Bloomberg News reporting that we might not get those sector-specific tariffs. This has changed as recently as last week, where we heard President Trump saying that those sector-specific tariffs could have been stacked on top of the reciprocal tariff plan. Now, those industries, as you know, are the ones that you're talking about and the ones President Trump has singled out when it comes to autos, chips, pharmaceuticals, and lumber. Also, importantly, this Bloomberg News report going on to say that those reciprocal tariffs might be a little more tailored and that some countries could be excluded if they have no tariff barriers against the U.S. or they run a trade surplus. But this really is a shift in at least the messaging from this White House. You had Kevin Hassett, for example, on Friday saying that the markets need to change their expectations because not every country cheats the U.S., as he said. But really, we didn't start to hear this rhetoric until last week when Treasury Secretary Scott Bessent outlined that the so-called Dirty 15, the top 15% of countries that run this trade imbalance with the U.S., could be targeted. But to be clear, Matt, we are still expecting tariff levels could reach their highest levels in potentially decades. And this White House is banking on that tariff revenue, but it is a market shift.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall reporting live from the White House. Meanwhile, China is hosting its annual development forum. Global executives arriving in Beijing as the nation moves to reassure everyone it's open for business. The Premier, Li Qiang, saying, quote, instability and uncertainty are on the upswing. At this time, I think it is even more important for each of our countries to open up our markets. For more on the forum, let's bring in Bloomberg's Justina Lee. So, Justina, we know at the same time, that's not Justina. That's Isabel. Let's get to Justina Lee. Justina, we know that at the same time as saying, you know, we're open for business, they are prepared for shocks that exceed expectations.
Yeah, that's right. And it's pretty clear who the audience of this message is, because they said, you know, they're prepared for these shocks, but they also emphasize that, you know, it's mutually beneficial for the U.S. and China to kind of move toward kind of cooperation, that kind of further fragmentation of economies is not good for anyone. And I think you can see that both sides kind of came to Beijing with pretty strong stances, because on the other hand, we have Republican Senator Steve Daines also in Beijing, and he kind of told the Chinese side that you know, the U.S. would have to see more progress on stopping the inflow of fentanyl ingredients into the U.S. before kind of any further progress on those talks could be made. And I think kind of given that China kind of feels like they've done enough, you can see how there could be a bit of an impasse there.
Justina, considering that we're going to be getting reciprocal tariffs next week, is there also a sense that it's not just American executives that are turning to China, but it's those that are being targeted by the U.S. looking now to China as more of an economic partner than perhaps they would have in the past?
Yeah, and I think, you know, that is definitely what China is hoping for, especially with kind of progress on the AI front, kind of putting China at the center of kind of this global technological transformation again. And at the same time, in a sign of its preparation for these tariffs, China recently has talked, you know, about kind of increasing kind of stimulus on the consumption front and kind of making sure that China is prepared economically kind of for these tariffs.
Justina, thank you so much. Bloomberg's Justina Lee there. Now back to tariffs and their impacts on autos, semis, and metals. Now joining us for real this time is Isabel Lee here with a closer look. Isabel, really great to see you. So we got a rally underway. What are you focused on?
So equities are really gaining ground on signs that Trump's tariffs will be more measured than previously expected, especially those with global exposure. So let's look at autos. We have Tesla, GM, Ford, and Stellantis. So they're the big three, and Tesla. So look at those automakers. They're all edging higher. They've really been struggling to come up with a game plan to get ahead of levies. Some are ordering ahead, or some are canceling orders. And any relief will just really buy them more time to adjust and to really look at what their new year would be. And these automakers have aggressively sought to halt or revise Trump's tariffs over concerns about what they call catastrophic effects. And we have a lot of estimations online saying that this might add tens and thousands when you buy a new car. So that's automakers there.
Yeah, absolutely. Costs and chaos is how Ford CEO Jim Farley described the wake of tariffs. I want to talk, though, about semiconductors. The SOX index has had a pretty rough start to the year, down almost 10%, so it's been decimated in terms of U.S. Semiconductor makers. What are you looking at?
But you look at those chips, we have Qualcomm, Broadcom, Intel, it's generally just green on the screen, and substantial tariffs on chips will really increase the price of chips one way or another, and will increase the price of electronics for Americans. So when you buy a new cell phone, Matt, it'll be more expensive. And Trump has argued that tariffs are actually giving the same outcome as a CHIPS Act that his predecessor, President Joe Biden, did. And when it comes to chips, at least in the U.S., Malaysia, and Singapore will be more affected. But for now, shares are edging higher. We have NVIDIA CEO saying, though, that tariffs won't affect them so much, but I guess it comes more with their production.
Could we just put a bow on this with one of the other sectors, maybe the final sector that's really been under concentration, and that's been metals. I mean, looking at the price of copper, finally above $10,000 on the LME, there seems to be some real optimism for the sector.
Lots of optimism. So I was reading BNs, and they call steel the gray metal. So there's a lot of optimism there. We have a United States Steel, Nucor, Alcoa. So a lot of nations aspire to have a robust steel economy. We have Trump, as we know, looking at it as a symbol of manufacturing might. And of course, you see those three edging higher. So, but we have Matt Maley in his note today. He said that it's really not about tariffs why we are seeing optimism, but really earnings. So I think it's still a guessing game on what's driving equities, at least for the past few weeks, with a headline shocker day after day.
Isabel Lee, thanks so much for joining us. Isabel covers stocks for us on the other side of the building here. Yeah, really the focus on earnings is, I think, parallel to the focus on tariffs, right? Mike Wilson also came out with a note from Morgan Stanley saying that the dip in the dollar is good. It's off, I think, 3.8% year to date. But it's also good that downward earnings revisions have bottomed out, especially for the Mag 7. And now we can start to see them at least stabilize, maybe climb.
This is the problem for earnings, though, Matt, is that there's this really fascinating study from S&P that looked through, I don't know, about 500 different earnings transcripts. Companies aren't incorporating tariffs into their outlooks because they have no idea what they're going to look like. They're not incorporating tariffs, which means maybe once they do, we start to get those downward revisions, that it starts to look more painful. So that's just one of the risks, just relying on earnings as it is now for saving the day when there's so much uncertainty.
Yeah, absolutely. Did you know, by the way, that if you look at ECAN, E-C-A-N, go on the Bloomberg, you can put AI-powered topics in the top and then look at mentions of tariffs for many different indexes. So I'm looking for S&P 500 mentions, and they're 514 in the last quarter. So they at least are talking about it compared to 0, 2 years ago.
Yeah, they're talking about it. Again, that's such a great function to show that because they're worried. But again, they don't know what they're going to look like. So that's really the rub when it comes to it.
All right, Danny Berger is going to continue along with us for the next couple hours. My ECAN man, Joe, is out today. So
ECAN man.
When Joe's here, we see a lot more of that on the screen. Coming up, Chinese EV giant BYD surpasses Tesla in 2024 revenue. We'll discuss the global EV hierarchy next with Craig Trudell. He's been around the world covering autos, and he comes to us next on Open Interest. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty.
into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Getting out of high interest, look at what's making headlines around the world. Chinese consumer electronics company Xiaomi kicked off a secondary share sale that may fetch as much as $5.3 billion to fund its expansion into electric vehicles. The Beijing-based company's 750 million share offering is fully subscribed, according to people familiar with the matter. And that offering comes just weeks after EV giant BYD raised a further $5.6 billion, building on what's shaping up to be a bumper year for share sales in Hong Kong. Speaking of electric cars, Elon Musk fanboys have flooded X with mentions, and they are buying the shares of his EV maker as they fall. Individual investors have pumped $8 billion into Tesla stock over the past 13 trading sessions through Thursday as the shares fell 17%. That's the biggest retail inflow over a buying streak since record-keeping began in 2015. And back to BYD, it is now the largest pure-play EV maker in the world by sales. Full-year revenue at Shenzhen-based BYD was more than $107 billion in 2024. That beats out Tesla's $98 billion without even entering the U.S. market. Net income at BYD rose 34% year over year to $5.6 billion, beating analyst estimates, though Tesla earned a little more at $7.1 billion for the year. Let's discuss the shifts that we are seeing in the auto sector hierarchy. Bloomberg's global autos editor Craig Trudell joins us now from London. And Craig, it's pretty amazing that BYD puts out these kinds of numbers. They sold fewer actual autos. They don't sell cars in the U.S. or really Europe in size. How are they doing it?
I think it's a matter of supplementing the pure battery electric vehicles with plug-in hybrids. I think that's a huge and sort of underappreciated aspect of this company's business, where, you know, in China and you know, among some you know, researchers of the industry like Bloomberg New Energy Finance, our colleagues at BNEF, they you know, sort of loop plug-in hybrids in with battery electric vehicles. And I think a sort of huge trend that we've seen is as battery electric vehicles have had a bit of, you know, growing pains, even among the likes of BYD, you know, the growth that they've had of late has really been driven more so on the plug-in hybrid side. We've seen a huge response in you know, a sort of improvement in technology there, where you really can sort of solve the range anxiety issue by offering you know, a plug-in hybrid that has, you know, hundreds of kilometers of range in BYD's case for many of its models in China.
Well, there was also that news last week that for one of their EV models, they have this new technology that you can charge it in as little as 5 minutes time. Craig, there's also this fascinating story from the FT that BYD was delaying their outroll of a Mexican autos plant because they were fearful that the Americans would steal the technology. It's a complete reversal of what usually happens with America fearful of China stealing technology. Have the tables turned, Craig? Is BYD now the leader and completely outstripping the U.S. in developing these sorts of things?
I mean, my reaction to reading that was, that this is, sort of a continuation of something we've already seen and already known, in the sense that, you think about a company like a Tesla or like a Ford. What have they been trying to do the last couple of years? It's been trying to get CATL, the big battery giant in China, to license their technology for their U.S. factories. A lot of U.S. executives have spoken to this idea that if you want to be more competitive in electric vehicles, if you want to be able to offer lower cost EVs, you need to be able to tap China for their expertise, for their technology, and for their cost advantage. And the U.S. manufacturers have tried to scale up. I think Washington tried to give a big boost in the form of the Inflation Reduction Act. But when you have this sort of back and forth of will we or won't we support this industry, from one administration to the next, you don't have that inconsistency in China. This is a long-term project, and one that the Communist Party is absolutely fully committed to.
Craig, in terms of tariffs, what do you expect, both in the near term and further out? I guess right away, it won't be a surprise if Trump puts 10% tariffs on European autos, but could we end up in a world where European tariffs on U.S. autos drop considerably?
I think it's going to be a huge point of contention, this issue of cars. It's been something that when Trump, rails about how the U.S. Is being treated from a trade perspective, it's one of the first things he turns to. He talks about how many Mercedes and BMWs he sees on Fifth Avenue relative to the number of Cadillacs that you'll see, say, in Berlin. But I think the likelihood that we see some tariffs as a result of that being such a point of emphasis seems fairly high, and yet we've seen the industry really launch this all-out push to try and talk him out of it. I think there's even been cases where just a few weeks ago, I'm sort of remembering a Truth Social post from him where he alluded to the idea of essentially just let tariffs happen. He's really going to need to be talked out of this, because he really feels as though there's a sort of deal to be brokered here that will enable U.S. manufacturers to sell more in Europe. I think what he may be missing in his analysis is just how little presence some U.S. manufacturers have over here. GM essentially has pulled out of Europe, and so just how much there's a sort of opportunity to for U.S. companies to grow in Europe when they already have capacity to feed this market, right, or they've pulled out and sort of thrown in the towel.
I mean, no European automakers make pickup trucks, but that's because of the chicken tax, right? If it didn't exist, indeed, you might be able to build the market. Craig, great to have your expertise. Craig has covered autos in Asia, in Europe, and in Detroit, so he really knows what he's talking about. Quick check on futures ahead of the opening bell. We have big gains. These are powered in part by Tesla, as those shares are up 4% in the pre-market. S&P futures gaining 1.2%. NASDAQ futures more than 1.5%. We are less than 10 minutes until the opening bell right now. Joanne Feeney joins us next with her top stock picks amid the current market volatility. This is Open Interest.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week, More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's been exactly 25 years since the onset of the dot-com bubble. That's when the S&P 500 posted a record level again at 2000 of March 24th, and it's a level that it wouldn't see again until 2007. So, Matt, obviously we have to relook at this, but I mean, 25 years. It'd make more sense if it was like the 30th year anniversary.
Right. Well,
it's
no,
a little
I
bit
think
arbitrary, but everyone's freaking out at this moment. Are we at another bubble? Is it unpopping at this moment? So people love to look back to this.
That's why. You'll hear so many people talk about the parallels between what we're seeing now in what could be an AI bubble and what we saw then, which was like the telecom fiber bubble. Because companies were rushing to spend as much CapEx as they could, laying down fiber and setting up, the original internet. And you have the same thing possibly going on now, although the argument is there's a lot more return on investment.
Well, you could also argue that the bubble isn't just AI, it's America. It's American exceptionalism. And what we're seeing now is not necessarily just the waning of American exceptionalism, but Germany catching up with spending and China catching up with the spend and effort that they're putting into technology.
Right. Well, that's by design out of the White House, right?
Right. Yeah, I guess it's a feature, not a bug. So what do you do all this with some of the joy coming out of equity markets, though we are on track to gain 1% when futures open? Joining us now is Advisors Capital Partner Joanne Feeney. Joanne, can we start with that? Is there a fear that there's still this kind of bubble popping sort of scenario leaking through markets? Or is this a buying opportunity with us finally last week getting the first week higher in equities in 5?
Yeah, it's certainly the case that the market, is expensive relative to history. And there's been a lot of chatter about whether this is another moment like the dot-com bubble and bust. I think things are quite different now. The source of the rise in particularly those AI-related stocks is very different. And moreover, the potential for them to keep growing has a much better foundation than what was happening during the dot-com era, when a lot of the companies were simply slideware and they didn't have revenues, they didn't have earnings, and they just had hope. That's not what's happening now.
So what do you think is happening now? I mean, if we see, $2 trillion spent on AI CapEx over the next 5 years, is that all worth it?
Yeah, let's look at the comparison, Matt. I mean, when you look back at the dot-com era, there was a lot of spending on the fiber side, right? And that's what we saw sort of blow up. And they said, okay, we've got the fiber laid. It's going to be dark for a while. Is it going to be used? That's not what's happening here, right? The AI chips from NVIDIA and others, those co-designed with Broadcom and Marvell, these are chips that are being used. The question that a lot of people are asking, though, are there applications that are going to make companies money, or are they going to give up on this at some point? So that's what creates the fear, that we might be seeing another bubble. But what's different now is we're seeing more and more applications develop. Even if they're not making companies money as of yet, we are seeing some make money. Look at ServiceNow. They're deploying AI. Look at Salesforce. They're deploying AI. Their customers are using it. They're finding efficiencies in it. And so we're at a point where we don't know exactly how much in applications will emerge, but we're still at a point where
Joanne, we'll talk about all that and more next at the opening bell.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that, not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We are moments away from the start of trading, and Bespoke Investment tells us this will be the biggest gap higher on a Monday since 2022. I'm Matt Miller. This is Bloomberg Open Interest. You can see futures are up more than 1% on the S&P 500. That has to hold for that fact to be correct. The NASDAQ 100 futures are up 1.5%. So not at session highs, but hovering around that level on really optimism, on hopes that Donald Trump's tariffs on April 2nd will be more targeted than sweeping. You heard the bell on the New York Stock Exchange. If you look down there, you can see Liberty is ringing the bell, and this is a stock that's down 26% year to date, but it has quintupled over the last 4 years. So they are killing it. Down on the NASDAQ market site, you can see Ionis ringing the bell. Their stock is just down 26% over the last 5 years. So if you invested in that, you've lost an average of 6% per annum. In terms of the equity indexes here, you can see at the cash trade, we're looking at the same levels as we were on futures, a gain of more than 1% on the S&P 500, 57.28. The NASDAQ up over 20,000 again. And remember, Mike Wilson from Morgan Stanley, we're going to talk about this in a little bit. He says, now may be the time to buy, as that great rotation we had out of the U.S. and into international developed market stocks, that could be turning back around because of a weaker dollar and a bounce in earnings, or at least a bottom in earnings. The small caps, just for those of you who are still in, up 1.5% there. In terms of specific stocks to watch, really the auto sector at large is one that I'm watching, because BYD has leapfrogged Tesla in terms of full-year revenue, over $107 billion in sales at BYD, only $98 billion at Tesla for 2024. So maybe we're witnessing a shift in the EV hierarchy, because they don't even sell cars in America. They don't really even sell cars in Europe, and still they're doing better than Tesla in terms of revenue. Craig Trudell says that's because they sell hybrids. They sell EVs that have range extenders. GM and Ford obviously sell everything, and they're doing well today on hopes that we see these tariffs targeted. But of course, if you get big tariffs on European autos, that helps these guys with sales as well.
It's remarkable. Tesla up more than 4.5%, even with that BYD news, even though they're getting absolutely trounced in China. It just shows the kind of optimism that we have right now, that tariffs aren't going to be those sectoral tariffs. So Matt, I'm also watching basically the same thing with semiconductors this morning, because again, it's this hope that when we get reciprocal tariffs, per the reporting, it's not going to be on individual sectors. So Micron, AMD, Broadcom, Intel, all up at least 1.2% this morning. Again, are Trump's tariffs going to be more targeted than originally thought, providing relief to this sector? that, Matt, as you pointed out, had really been struggling in past months.
Yeah, certainly U.S. Semiconductors have had a real problem. Obviously, we've seen NVIDIA come off more than 20% from its highs, but Intel has been a story of failure, really, in terms of U.S. exceptionalism. Wall Street strategists getting more bullish on U.S. stocks, though. As I mentioned, Morgan Stanley's Mike Wilson saying a weaker dollar could improve earnings, and Goldman Sachs' David Kostin says foreign investors will continue to buy U.S. stocks for that very reason, putting about $300 billion into U.S. equities again, which is what they put in basically last year. So some optimism coming out of these big strategists.
That last one, though, David Kostin's reason, is almost a reason to say things haven't bottomed, because people have kept buying. If you look at the flow data, as we've sold off, it's mostly been hedge funds. Retail investors are doing crazy things right now. They're buying record amounts of ETFs. They're buying things like 3 times levered QQQs. We haven't had a bottom in the flows. In fact, we're only down about 7.7% from the top. So given Kostin's note, too, the fact that we have foreigners buying, is this really a bottom in sentiment yet?
Yeah, or you could also ask if people are going to buy the things that they haven't been buying. I bring that up because our guest, Joanne Feeney, has one recommendation on the list that's really underperformed a lot of the others in her group. Let's bring her back in, Joanne Feeney from Advisors Capital. And Joanne, I'm talking about Amazon. Not that it's done terribly, but it hasn't done nearly as well as NVIDIA or Tesla or even Meta or Microsoft or any of the other Mag 7 stocks. Google, you know, it's underperformed all of them. Is that why you like it?
Well, we would prefer it if it had been outperforming all of them, but we still like it here for future positions for our clients. We've owned it for a long time. And the reason I think why Amazon, hasn't done as well as some of the more pure play AI companies is because it's two companies. It's both the Amazon Web Services, where it's obviously, leading the market in providing those capabilities, but it's also an online retail company. And so it's going to move around based on what folks think of the consumer. And when, the consumer is threatened by potentially higher tariffs, slower growth, that becomes a bit of a headwind for them. But, look beyond that to how much share online is still gaining, and Amazon is the leader there.
Joanne, if we do see this pattern continue, that is dollar weakness, do you relook at some of your picks? Do some picks look more attractive if we indeed are entering this environment where the dollar is unable to sustain some of its gains against its peers?
Yeah, I think it's hard to invest based on what you think the dollar is going to do. You look at exchange rates, they're pretty much a random walk. And so, they could shift at any time. And trying to figure out what the dollar is going to do is, I just think it's counterproductive. Find good companies. A lot of the companies that have international currency exposure are going to be hedging that currency exposure. And so, movements from day to day, month to month in the exchange rates, will have some impact, but most likely it'll be muted. So I don't think that's the way to go. I think you're better off finding companies with strong drivers of sales, deep moats that protect their margins. And right now, margins are a big question with potentially those tariffs coming online.
There's a story out about Ant, Jack Ma's company that's developing AI with cheaper chips, apparently, with Chinese-made chips. And through that, he's saved reportedly 20%. We saw, obviously, the DeepSeek news in January that was similar, but I guess bigger in terms of its effect on the markets. How do you think this shakes out for NVIDIA, for Broadcom, both of which you like?
Yeah, clearly the U.S. and China are, splitting up, and we're putting, our government and previous administrations have been putting more and more restrictions on exports of chips to China, which forces Chinese companies to find solutions, within their own countries, and that's what we're seeing happen. Claims of performance based on, those chips, they're going to keep coming, and they're going to have to make do. That doesn't say, though, that the NVIDIA chips, the AMD chips that are coming online, those co-designed with Broadcom, are not better and will not allow for more applications and more, really deep understanding, more reasoning models, as Jensen has talked about. So I think, we're still in the lead when it comes to chips, and therefore, NVIDIA's, Broadcom's, AMD's chips will still be seeing shortages for looks like some years to come. So that doesn't dim our expectations for those companies, but it doesn't also rule out China's progress, which I'm sure we're going to continue to see.
So it still helps this U.S.-American exceptionalism narrative, Joanne, but as we wait for April 2nd, as we get a drip feed of reports, and let's be honest, there's still so much opportunity for headline volatility as we get to next week. Where do you hide? Where do you stay? What do you buy that helps shield you somewhat for volatility that feels almost guaranteed?
Yeah, Danny, you're absolutely right. Almost guaranteed. We're certainly seeing a lot of it. You know, there's a lot of risks out there. In fact, policy risks have only been higher during the great financial crisis in recent years and during COVID. So investors really do need to understand their own tolerance for risk. You know, in our balance strategy, what we do is build in a lot of higher than average dividend yielding companies so that, you know, investors can ride out some of the volatility, and that might lead them to having in their positions, in their portfolio, some positions that might be boring, whether it's a Philip Morris or a Duke Energy or a Kinder Morgan. These are high dividend payers, and you can ride out the stock volatility by owning some of those higher income companies. But also, you know, go to places that are going to be resilient, even if the economy slows down, even if tariffs come on board.